so on, ease of living, so that businesses can do their business of working together with the GST with a great ease.
Well, that's the finance minister late night announcements, and absolutely historic. India has ushered a new GST regime. That's point number one, big rate rationalization. Government's big consumption boost. I mean, the across the board GST cuts. And by the way, as CNBC TV18 reported, so it has been across the board, every single item. Will this lead to a big consumption boost, especially on the mass market side? That's a big question. And of course, the important bit, rate cuts are from the 22nd of September, which basically means that they capture the festive season. They're not, very delayed. They're not sort of to be implemented from a far out date. They are from the 22nd of September. That's very important. And of course, two-slab structure, 5%, 18%, in terms of where the rates now stand. The 12 and 28 is gone. Most of 12 is in 5. Most of 28 is in 18. No cess, 40% for sin and luxury goods. So very few items in the 40% category. We will talk about that as well. But there is no cess on top of it. 40% is the maximum rate. And as I said, all CNBC TV18 news breaks confirmed from the first to the last, every single one of them. And I think it's a proud moment for all of us here. You're with us here on a slightly early start on Bazaar Morning Call. We are coming to you live from the CNBC TV18 Motira Oswal studios. I'm Prashant. With me, my colleagues Surbi and Nigel. Guys, good morning.
Hi guys, good morning. What a GST bonanza, a GST blockbuster. I don't think we have enough adjectives. It was announced on the 15th of August by the Prime Minister from the ramparts of the Red Fort. It's been delivered. And you know what really stood out for me? This was supposed to be a 2-day meeting.
Yeah.
It all got wrapped up in day one. And, all kudos to Timsy out there because she told us exactly what those proposals were going to be. And it's, I think digit by digit, percentage by percentage, that's exactly what the council has approved.
Well, that's right. Timsy has been bang on over the last few days, and we here at CNBC TV18 have report almost everything that actually did come out officially, and we were reporting late into the night. But today, the markets got what it wanted. So, Prashant, let's get straight to the action.
Absolutely. Surbi, by the way, you stayed up the wrong night. The day before yesterday, right?
No, I was awake. Watching. And you know what? The Prime Minister, remember the last council meeting? She must have said, you guys made so much of fun of the popcorn business and the caramel and the salted. I'll give you the big one this time. And that's the way she announced in the press conference.
Absolutely. Let's take it from the top then, right? In terms of what you need to know. The big major GST rate rationalization announcements are through. That's essentially point number one. And we'll get into individual stock sectors in just a bit from now. And of course, as we told you, all our news breaks are confirmed. So the new GST structure is effective 22nd of September. So the government's been cognizant of the fact that they don't want purchases to be deferred because, there'll be lower rates sometime down the line. They're right now, which means that the start of the festive season. And in that sense, they've thought that through as well. Expect improved affordability to give a fillip to consumption. I mean, of course, the question really is how much, and that will depend from sector to sector, company to company, and we will get you a whole variety of responses to this as we go along. 12%, 28% are gone. 12's mostly moved to 5. 20 has moved to 8. New 40% slab for sin and ultra luxury goods, but there is no additional compensation cess above the 40% rate. And I think this is a very important point. So the maximum rate here now is 40%, which is I think crucial and critical. So GST rates either remain unchanged or go lower for most items, except maybe, apparels above a certain value and things like that. Otherwise, across the board, it's either a cut or they remain where they were earlier. So I think this is very, very good. As I said, we'll get to stock sectors in a bit. I just want to tell you about US equities, etc. as well, slightly higher. So no real headwind from there. US markets were sliding a little bit, starting to crack a little bit, but 0.5%, 1% on the S&P, NASDAQ respectively. The 10-year was down about 4 basis points. Dollar index was down about a quarter. Oil prices, they went down 2.5%. And there were reports, Reuters reported that OPEC is meeting on Sunday. They may consider another output increase. So maybe oil's got more to go here, which is not exactly a bad thing. Now, just the levels, right? Tying in the levels. Nifty yesterday closed slightly above the 20-day moving average. Maybe the market got a bit of a whisper. So starting 130 yesterday, the Nifty zoomed. it was a two-day meeting. Announcement came late last night, but maybe the market got a bit of a whiff, at least at the index level. Immediate resistance is the 61.8% retracement of the fall. The recent fall, by the way, which is 24,878. That's the first stop. And we'll see if we've got enough in the tank. I think we do for the market to at least get to the upper end of the range. Support stands at the low, which is 24,404. The Nifty Bank resistance, again, is a 61.8% retracement of the recent fall, 54,777. And the support stands at 53,561. So I think we are in for a good session on a headline overall basis in terms of individual stocks. We'll have to see, depending on pre-positioning, what has done well, what has not done well, etc. GIFT Nifty is indicating a 150-point higher start. Let's get the F&O set up. Positioning, I think that's important. Nigel is standing by. Nigel.
Well, that's right. The markets have got what it wanted, right? And that's why the GIFT Nifty is suggesting a gap up. But at the end of today, you'll want to end with these gains. The question is, will this GST rationalization be enough to trap the bears on the wrong side? That's going to be very, very important. And in today's trade, a couple of sectors will be in focus. NASDAQ ended higher. You normally see a bit of a positive rub-off on the Nifty IT index. As it has been an underperformer. Yesterday ended lower as well. So that will support one end, while the consumption stocks as well should do well. But the big mover really will be if the Nifty Bank, that after a while outperformed yesterday. We saw a bit of a short covering bounce that played out there. That's the key. Can the Nifty Bank find its form and at least move in line with the Nifty, if not lead the way? That's going to be the important mover for today's trading session. What happened in trade yesterday? Well, the institutions for the last few trading sessions, they have been net buyers. And yesterday was no different because the DI buying it offset the FI selling. And that's been the trend for the last few trading sessions. So that's a positive. But in the index futures, we're looking at what did they do? What did the FIs do? Well, in fact, there was no short covering yesterday. On the whole, there was some short addition that we saw. The short positioning is at an extreme level of around 92%. And in the last few trading sessions, we have seen a bit of a bounce. And actually, the FI net short positions from around 1.68 lakh contracts, that's gone all the way to around 1.82 lakh contracts. So that big short covering bounce that we are talking about, that's yet to take place. And that will give bulls some kind of hope that that's still in the offing. Even if you don't see the big cash market buying in from the FIs, these shorts in the system should hold us in good stead. Moving to the options data, then you have a couple of strikes that were active. The 24,700 call. Well, there was some addition in yesterday's trading session. From the high, actually, there was some unwinding. So that's going to be the crucial mark. While on the downside, the 24,050 put, that did see a good amount of open interest build up. So going by the options data and going by the recent resistance, we did a U-turn from around the 22,750 mark, 24,750, 24,800. That's going to be the important mark, while support comes in at around 24,400. The Nifty Bank, the 20 and the 100 DMA, that's the range that you're looking at in terms of a resistance mark. So we'll keep an eye out on that. While the stock that we're looking at is, yesterday towards the end of trade, we said RBL Bank is likely to move into the F&O ban, and that's precisely what's happened. So that's a stock we'll keep on the radar.
Okay, all right. Globally, just remember one more headline to keep in mind, that the US administration has moved the Supreme Court. There's no date yet as to when the court will rule on that 50% on the overall reciprocal tariffs, but it should happen in the next couple of weeks. Let's straight away get to the big story, which is leading to this 150-point pop on the Nifty as of now in terms of the implied open. We have our sector specialist standing by to decode the impact of the mega GST cuts. We've got Mangalam to talk FMCG. We've got Sudarshan revved up on autos. Nigel in a bit will tell us more about cement, and Upasna and Vamakshi also joining. Upasna and Vinny also joining in with their sectors. Let's get started. Nigel, you take it away first. As expected, 28% goes to 18% for cement.
Well, that's right. That was a long-standing ask, and that's what's come about. Jeffries has said for the government itself, they lose close to 20 to 25,000 crores in terms of revenues. But what's the impact for cement? Well, it's a sentiment positive, actually, that's coming out. Because cement demand, as we all know, demand is inelastic. Because the cost of making an affordable house, only 12 to 14% comes in from cement. And for a modern house, in fact, it's only around 5 to 6%. So effectively, this cut in terms of GST doesn't move the needle too much for urban housing in particular. It could, help in terms of rural housing. The GST cut, well, if GST comes down, the price in all probability should be cut down in a proportional manner. But part of this pricing may not be passed on, and that's why the street is optimistic it will flow through to margins. It could lead to people consuming premium cement, which comes at a higher realization, so that's important, and it could help volumes as well. The duty on coal, that's moved up, but it's unlikely to hurt them because there was a cess of close to around 400 rupees that's going to be done away with. So net, it's no impact on the negative side for the cement consumers. And finally, one overhang could be the states will get relatively less GST now. From around that 14%, they'll get around 9%. Will it hurt some part of the incentives? But otherwise, net, it's positive for the cement sector. Hopefully, volumes pick up.
All right, Nigel, thanks very much for that. So that's cement, maybe a fillip to volumes we will see, and we'll get your reactions, as I said, across all these companies. Auto components and tires. Sud is standing by. Sud, morning.
Good morning, Prashant. So it's a big GST reset, and auto is expected to be one of the biggest beneficiaries after GST Council's approval for the GST rationalization. So first headline, it would be a GST rate cut across the auto segment. Second, smaller cars, bikes up to 350cc capacity and auto parts move into 18% slab from earlier slab of 28%. Now, third, luxury cars or say bikes having capacity of more than 350cc will move into 40% slab. But effective tax rate, even at 40%, would be lower than the tax rate that it used to be earlier, because earlier it had the compensation cess, which goes away now. Second, big headline, EV will remain in 5% slab. And last headline is tractor and the parts used in tractor will come down and move into 5% slab. So which all companies will be biggest beneficiaries? First one is Maruti, because it has the huge exposure in small car segment. Also amongst beneficiaries are Tata Motors and Hyundai. In the bike segment, Eicher Motors will be the biggest beneficiary because almost 86% of its total contribution come from bikes having capacity less than 350cc, and followed by that Hero Moto, Bajaj Auto and TVS Motor. In three-wheelers also move into 18% category. Bajaj Auto and TVS will be biggest beneficiaries. Armored vehicles move into 5% category, and Tata Motors and Bharat Forge are expected to benefit. Bus also moves into 18% category, and Ashok Leyland and Tata Motors are biggest suppliers in the bus segment. Tires also move to 18%. So Apollo Tyres, MRF, Seat, Balkrishna Industries will benefit the most because tires used in tractor segment will move into 5% slab. And last one is auto parts. Uniform rate is going to be 18%. So Endurance Technology, Bellrise, Sona BMW, Motherson and Crado are some of the companies which are expected to benefit. So it's all looking very positive for the auto sector today.
Okay, all right. Sudarshan, thanks very much for that. Let's move to apparel and textiles, because the finance minister announced yesterday that a lot of the inverted duty structure that was bothering the sector, that is getting ironed out with the GST changes. Vinny, tell us more.
Hi, good morning. So yes, in terms of apparels and textile side, there is a rate reduction that's come in for across those value chains, right? The input products that were used, that has now been reduced. So whether you look at yarn, sewing threads, man-made filaments, all of them have now come to 5%. So there is a uniform 5% rate for most of these inputs now. Man-made fiber earlier was 18%, moved to 5%. Man-made yarn earlier 12%, now moved to 5% as well. Now reducing these rates will obviously benefit and lead to a reduction in the manufacturing costs for the finished products as well. So other than that, we're seeing a reduction even in terms of finished products. So whether you look at carpets, rugs, bath linens, even apparel products, where we've seen a reduction coming in terms of the GST rates. For finished products, there's a reduction coming to 5% as well from previous 12%. Specifically for apparels, there's a GST of 5% on apparel products not exceeding 2,500 rupees. This turns out to be positive for Wellspun Living, Indocount, KPR Mills, Gokuldas Exports, Vardhaman Textile, Nitin Spinners, among some of these textile players.
All right, Vinny, thank you very much for that. Consumer durables is what we're going to focus on next. Upasana is here with impact on stocks. Upasana, over to you.
Good morning. Well, it's a big consumption boost with the onset of the festive season especially. Let us look at the key categories that will be in focus on the back of the GST rate cut. AC, large TV above 32 inches, dishwashers, solar water heater. The GST on this is reduced to 18% from 28%, while other categories such as smartphones, refrigerator, small screen TVs, washing machines, microwave continue at 18% slab. Now, this big consumption boost is likely to increase the affordability for the consumers, especially ahead of the festive season, and lower GST directly stimulates the demand for ACs and large TVs, expanding the market size for domestic producers. Now, according to Elara Capital, RAC demand may rise minimum by 10 to 15% on the back of this, and RAC OEMs like Amber Enterprises, PG Electroplast, EPAC Durables may see spurt in volume growth on the back of this. Now, coming to TV category, there is no direct beneficiary here, but Dixon Tech will be in focus as it assembles TV for numerous brands in India. This might see a spurt in volume on the back of this in H2 FY26. Solar water heater, lastly coming there, it is a growing market in India, though it's not that substantial, but it is picking up, and key beneficiaries here would be V-Guard and Havells. So overall, it is a positive move for consumer durable sector.
Okay, all right, got it. Thanks very much, Upasana, for that. Back to Vinny. Pharma, healthcare, a whole range of medical equipment or consumables in hospitals. The GST has gone down on all of them. Vinny, fill us in.
Absolutely. So in terms of GST on medicines, all medicines has now come to 5% from previous 12%. There are 33 life-saving or important drugs that you could call, right? Out of that, 30 drugs are oncology drugs where there was a 12% GST previously. Now it's come down to nil. And there are 3 other life-saving drugs across different categories, which has been reduced from 5% to nil as well. So nil on important life-saving drugs. Now medical equipment, that's an important one as well. GST has been reduced from 12% to 5% for these medical equipments, whether you look at diagnostic kits, blood glucose monitors, surgical devices, bandages, among some of them which I'm naming right now in the medical equipment have seen a reduction as well. Now, obviously, this turns out to be positive for Polymedicure. Diagnostic companies also will benefit from this. So, Dr. Lal, Metropolis Healthcare, and other than that, companies that are domestic facing pharma companies that are domestic facing. So, Torrent Pharma, Abbott, Cipla, Zydus Life, Lupin, Sun Pharma will also benefit from the change in the drug prices.
All right, Vinny, thanks very much for that. Fertilizers and chemicals next. Vamakshi's got that. Vamakshi, morning.
Good morning, Prashant. Good news for fertilizer as well as agri-chem companies because, the inverted duty structure in chemicals has been corrected by reducing GST from 18% to 5% on sulfuric acid, nitric acid as well as ammonia. Now, this in turn bodes well for companies like Deepak Fertilizers, GNFC, Chambal Fertilizers, Coromandel, RCF, National Fertilizers, Paradeep Phosphates, FACT, Southern Petrochem, etc. Other than that, micronutrients as well as agri inputs, the GST out here has been cut from 12% to 5%, and this in turn is positive for companies like UPL, PI Industries, Rallis, all of these agrochemical name, Bayer, Crop Science, Dhanuka, Best Agri Life, etc. Now, keep in mind that these rates will be effective from 22nd of September onwards, and if we look at the impact, the reduction in input cost as well as the working capital relief as a result of correction in the inverted duty structure means better margins for fertilizer companies. And the second important impact is that it also improves affordability as well as demand uptick for micronutrients as well as agri inputs.
Okay, it's a turbocharged booster shot across sectors, across companies, but how can we end without talking about FMCG? Those hair oils, the Maggi noodles, the chocolates, so on and so forth. Manglam, big day.
Big day. All the staples have been, brought under the 5% mark for GST. And that's a big positive. Why do we say that? Even if the companies go ahead and pass on, as is expected, all the benefits to the consumers, we will see increased boost coming, especially in the staples space. And that's what the FMCG stocks have been expecting over the last 10 or 15 days or so as well. So we have, HUL, Dabur, GCPL, Imami. Don't lose sight of something like a Bikaji as well, because all your bhujia and pre-packaged namkeen, etc. would come down from 12% to 5%. For nearly the entire portfolio of names that I just spoke about, all the rates have come down to 5% from 18%. So hair oil, shampoo, toothpaste, toilet bar, we have toothbrushes, shaving cream, all of them down from 18% to around 5%. Biscuits stand to benefit as well. The bigger benefit comes in from ITC, that's, because one, there is no incremental tax on tobacco. And secondly, some of its products, the likes of pencils, sharpeners, crayons, pastels, exercise books and notebooks have come down to nil. So that's a positive for them. The only fly in the ointment here would perhaps be something like a Varun Beverages, And the reason why I say that is because aerated beverages have been moved to 40% as against 20%. So the stock may be slightly negatively impacted, but a large part of the street, in fact, the entire street was penciling for that already. So barring Varun Beverages, all the other companies stand to benefit as the taxes are down to 5%.
And Mangalam, just very quickly, specifically on ITC, when it comes to cigarette taxation, no changes because I think there the compensation cess continues for some time.
The compensation cess continues. So currently what the regime is 28% GST, plus you have the basic excise duty, you have the NCCD, and you have the cess, which is basically a function of fixed and ad valorem, which is a proportion of the prices. Now, with the 28% having gone to 40%, there will be concomitant changes made to the other part of the taxes, so as to the overall incidence remains the same. Because if there is more incidence of tax on tobacco, then perhaps, there is risk of illegal or contraband gaining further market share and the government itself losing some sort of revenue. So it's only mature that it is tax neutral, and that's exactly what is understood so far from the details that we have.
All right, Mangalam, thank you very much for that. Just want to put out some views which are coming, and actually there'll be lots of views through the course of the day, but some street views, right? So this is Vikas Jain of CLSA, who writes this morning. He says the estimated reduction in the tax burden or increase in disposable income for consumers from these cuts equates to 30 basis points of GDP. This comes after a large income tax cut and multiple interest rate cuts over the last few months. This is the third significant consumption boost and gives impetus to our call for consumption stocks over capex plays. It goes on to say that lower indirect taxes will lower working capital needs and raise resources for ROEs, beg your pardon, for SMEs in the trade chain, boosting consumer confidence. The key direct gainers from these tax cuts are autos, FMCG, durables, cement, insurance, quick service retailer, that is QSR, and alcohol players as well.
Okay, so that's a view from CLSA coming through. Let's get you one from Jefferies as well. This is a view from Mahesh Nadurkar, who says the government's GST bonanza has come through and the government has moved swiftly to announce the GST cuts, with September 22nd being the implementation date. Festive demand hence should see a positive boost, though some negative demand impact would be felt in September. Most GST rate changes were expected or were on expected lines. Positive surprise came in for staples and ITC. Cement stocks haven't really moved since the August 15 announcement and should bounce now. And so should M&M, a strong positive for other autos also, but stocks have already moved up. So cement and M&M specifically, Jefferies calls out, should see a further leg up.
All right, let's just, and we'll get you more, right? So this is CLSA and Jefferies, but this is Finance Minister Nirmala Sitharaman addressing the media late into the night post the 56 GST Council meeting. Listen into some of the top announcements from the FM herself.
This reform is not just on rationalizing rates. It's also on structural reforms. It's also on ease of living, so that businesses can do their business of working together with the GST with a great ease. Rate rationalization, of course. We've reduced the slabs. There shall be only 2 slabs, and we are addressing also the issues of compensation cess. Ease of living, simplifying registration, return filing and refunds. Levied on common man's daily use items have gone through a rigorous looking into, and in most cases the rates have come down drastically. Labor intensive industries have been given a good support. Farmers and agriculture as a whole will also benefit by the decisions we have taken today. Health related also will benefit. So the key drivers of economy have been given a prominence. Man items such as hair oil, toilet soap, bars, shampoos, toothbrushes, toothpaste, bicycles, tableware, kitchenware and other household articles have all come to 5, whether they were in 18 or whether they were in 12. Similarly, reduction of GST from 5% to nil. 5 से 0 में जाने वाले आइटम्स इंडिकेट कर रहा हूं. अल्ट्रा हाई टेम्परेचर मिल्क, द UHT मिल्क, छेना और पनीर, all the Indian breads will see nil rate. Reduction of GST from 12% or from 18% to 5. इसमें फूड आइटम्स बहुत सारे हैं. नमकीन से भुजिया है, सॉसेस है, पास्ता है, instant noodles है, chocolates, coffee, preserved meat, cornflakes, butter, ghee, ये सब 5% में आ रही है. From 28 to 18% on small cars and motorcycles which are equal to or below 350 cc. Reduction of GST from 28 to 18 on buses, trucks and ambulances. Uniform rate of 18% on all auto parts, irrespective of their HS code. Three-wheelers from 28 to 18 again. Reduction of cement from 28 to 18, क्योंकि घर बनाने में मिडिल क्लास के लिए सीमेंट इतना आवश्यक है, इसीलिए 28 it has come down to 18. Insurance services from 18% currently will go into 2-3 different categories. I'll say that to you. Exemption of GST on all individual life insurance policies, whether term life, ULIP or endowment policies, and reinsurance thereof, to make insurance affordable for common man and increase the insurance coverage in the country. Exemption of GST on all individual health insurance policies, including family floater policies and policies for senior citizens, and reinsurance thereof to make insurance affordable for the common man and increase the insurance coverage in the country.
All right, let's take that forward then in terms of insurance. Yash joins us to tell us how does it impact the insurance space. Morning, Yash.
Morning, Nigel. So, of course, let's address the headline first. GST on individual life insurance and health insurance has been exempted. Also, what has come along with it is that exemption has come as far as GST and the reinsurance cost of procuring that life insurance and health insurance policy is concerned. So that is as far as the GST rate is concerned. Now, as far as the sector is concerned, it would be one of the only sectors which has had its rate go down from 18% to exempt, but still won't be happy today. That's because it's a double whammy which has come with respect to the announcements yesterday for the insurance sector. One is that there is no input tax credit which has been announced by the government. The category of exempt does not give provision for input tax credit, which means that it will contain or restrict insurers' ability to offset any cost which they incur in procuring the life insurance or the health insurance premium. That is the first negative. The second negative which has come in is that the inverted duty structure has only been sort of corrected for the reinsurance cost which has been exempted. That is just 30 to 40% of the total cost which the insurance company incurs in procuring the health insurance or the life insurance premium. The balance 60-65% cost is commission as well as claims, but that's where the inverted duty structure still remains, which means the 18% GST on those services would still remain. I've been speaking to the industry players and worked out some numbers myself. Now, if the reinsurance cost would not be exempted on the reinsurance part of it, then it would have led to a 7 to 10% increase for insurance companies on every policy. But now, since the reinsurance cost has been exempted, that expense or the deficit on every policy comes down, but it still remains to be about 5 to 7% for insurance companies. Now, of course, there are three scenarios. Either the insurance company takes that hit on its own books of that 5 to 7% if that entire 18% benefit has to be passed to policyholders, or it shares that cost with distributors like Policy Bazaar, in terms of the commission.
Yash, thank you. Thank you very much. It's a complicated, I think out of all the sectors, insurance in terms of the GST cut impact is the most complicated one. But that's good explanation, and we'll talk to companies as well. But we are joined by Anish Shah, Group Chief Executive Officer and Managing Director of Mahindra & Mahindra. Anish, good morning. Great to have you with us here. Glad that you're able to join us. Rajesh Jajurikar is also with us, ED and CEO, Auto and Farm Sector at Mahindra & Mahindra. Rajesh, great to have you with us bright and early as well. Anish, if I can start with you, these are big rate rationalizations. You're smiling, you're happy in terms of what has been done. So your first reaction to what is done, and then specifically if you can tell us, Anish, what percentage of your fleet would now fall in the 18% slab, and what percentage of your fleet would be in the 40% slab. 18 and 40, the two relevant rate slabs now. Go on.
Let me start first with the overall impact on the economy. And to me, that is the biggest factor in this change. It is a very dramatic one. It ushers in a new era of simplification and possibly a new era of ease of doing business as well. It will have a very significant impact on consumption. And this is something that should, in some ways, create that momentum that we were looking for in the economy. A lot of the fundamentals have been in place, but I think this is a very significant move that will create that momentum and propel India to an 8 to 10% growth rate overall. So that is the reason why we feel it is a very important milestone for our economy and sets it up in the right way. I'll let Rajesh cover the details from an auto perspective in specifics, but from an overall economic standpoint, this is a very, very positive move.
Fair enough. You're very positive in terms of the overall economic impact. Rajesh, if I can ask you then the specific bit, what percentage in the 18% slab and what percentage in the 40% slab? And of course, we will get to the tractor GST rate reduction as well, which I think is a big positive for Mahindra. Go on.
Yeah, so Prashant, like Anish said, we're delighted with the news overall. It's a huge enabler to demand and consumption. Markets have seen some kind of a slowdown over the last few quarters, and I think this will be a very good boost, timed very well with the start of the festive season. To the specific of your question, I actually want to, you got to see the auto and farm business, which is key part of the M&M Limited company, as a sum of three key segments. The tractor segment, which is tractors and farm machines, the commercial vehicle segment, and then the SUV segment. So tractors gets a big boost, 12 to 5%, which will lead to prices coming down 40 to 60%. And that on an average basis, we do about 35 to 40,000 volume a month. Then we have the pickup portfolio, which is LCVs less than 3.5 tons, which will move from 28 to 18, which is about 25,000. So I'm just giving you these broad numbers so that you get a context of the volume. Our SUV portfolio is in the region of 45,000. Roughly 40% of that will be in the 18% and 55-60% will be in the 40%. But we have to keep in mind that we also have EVs, which will be in the 5%. So overall, if you kind of, were to leave out the 40%, we have a very large chunk of volume pickup plus SUVs in the 18%. And then we have tractors and EVs in the 5%.
Rajesh, around 40% in the 18% overall. Would I be okay in the ballpark?
No, it will be higher when you add the pickups, the commercial vehicles. So it will be almost 65% when we add the commercial vehicles as well.
In the
when we
18% slab.
Numbers, it includes commercial vehicles as well. Prashant.
Okay.
Yeah. Mr. Jejurikar, hi, good morning, sir. And Mr. Shah, thanks so much for joining in, both of you. Mr. Jejurikar, if I could ask you, I know it's very early, but maybe your team has already done the back of the envelope calculations. If we talk about the full revenue of the automotive segment, let's leave aside farm equipment. So if you talk about full year revenue, then is there a way of gauging that, what part of the portfolio, with the volume breakup that you just gave us, what part of the portfolio or what percentage of that revenue gets a positive leg up because of the reduction to 18%? And what part perhaps, which will be few, which go into that 40% category? So that percentage of the revenue, perhaps you have to see how the volumes play out.
No, every part of the portfolio will get a volume up, Surabhi, because 40 is also benefit of 8%. So what was in 40 was 48%, including the cess. Yes. Even there's an 8% benefit. So every part of our portfolio gets a leg up. EVs are unchanged, but everything else gets a leg up between 8 to 13%.
Yeah. And the other question, and maybe Mr. Shah can also come in on this. Overall, sir, what's going to be the thought process? I mean, does everything get passed on to the customer, or will you have to take a slightly more nuanced call on this? depending on other input prices and other compulsions. I mean, how do you look at it? Should, for M&M and the industry across the board, do you expect all of this to be passed on or not? Mr. Shah?
We expect all of this to be passed on. This is meant for the consumer, and the GST cut should be passed on to the consumer in full.
All right. Hi, good morning, gentlemen. Thanks a lot for joining in. Rajesh, coming across to you, you said the tractor rationalization of GST cost will ultimately bring the tractor cost down by how much?
50 to 60,000, depending on the horsepower category.
50 to 60,000 rupees, right?
7%, yeah. 40,000 to 60,000, depending on the horsepower category.
Got it.
That's
And
the
in
12 to 5%, 7% drop.
Okay. All right. Got that. But what about in the interim? This comes into effect from 22nd. So in the interim, will that create some kind of uncertainty, postponement of buying? How do you see customer behavior move?
There will be transition issues, Nigel, and in any transformation, there's going to be transition issues. So, we would expect the next three weeks or so to see some kind of a wait and watch. There are some issues related to compensation cess, which SIAM will take up with the government separately. But overall, I think the sentiment is very positive, and we see this as a very long-term demand driver. There will be a little bit of wait and watch through September, which may affect September volumes as customers wait and watch for the effective date of 22nd September.
And Rajesh, you're saying including CVs, 60% of the portfolio will be in the 18% bracket now, right? That's what you said.
60% of the auto portfolio. If you add tractors, it's higher.
Of course.
Which is at 5%.
Yeah. Anish, can you give us a slightly top-down view on, what you began by saying, right, which is the consumption boost and what it does to growth overall? Because, the second derivative, third derivative, etc., can be quite meaningful, which is very difficult to immediately put numbers to. So just your thoughts there, Anish.
So what we've seen is the economy has grown roughly at about 7% or so for the past couple of years. And as a result, private investment hasn't gone up as much. Capacity utilization has gone in the 75 to 80% range for many industries. So, Prashant, as we think about the economy overall, I strongly feel that this could be the one factor that really starts driving that private investment. We will start seeing consumers get a much more positive view, and that sentiment is an important one. As that happens, companies should start investing more. We're already starting to think about how do we create the supply for this, because we will need to ensure that the supply is there for that demand. And that, in effect, would be one that really starts driving private investment, which has been an important factor that's been missing so far.
Anish, is there any way, and I'm not talking for specific numbers here, but is there any way for you to give us a sense of the multiplier effect of this on, say, auto volumes? And if you can talk about Mahindra and Mahindra, the leg up, as Rajesh said, every part of our portfolio will get a leg up pretty much. So in terms of volumes and the bump the volumes get because of this, in the ballpark, what's your sense?
Prashant, a little early to say that at this point. We've also been in a situation where we've been growing mid to high teens from an SUV standpoint, while the industry has been very sluggish. And for us, it's a product set that has enabled that to happen. So we will see a further growth rate increase, but the extent of impact is something that we will have to wait and see as to what the level of elasticity is to prices and how significant that will be. But again, from where we sit right now, we expect this to be a significant boost.
All right. Just one more question I had, gentlemen, because I wanted to ask about how the tractor inverted duty changes. The reason I ask this is because the GST is reduced for tractor, but the input of steel, there the duty is largely unchanged. So how do you manage this?
There are, Nigel, I haven't gone through all the parts, but we have seen a list of parts. So the government has tried to work on the inverted duty structure for tractors. And there are a list of parts which are tractor specific, which have been called out, which will be at lower duties. But I need to go through that full list to see what percentage of the input credit it impacts. It does lead to some kind of a working capital blockage, but that's insignificant in the context of the overall upside that will come out of this pricing boost.
Got it.
Mr. Shah, sir, finally, going back to the overall point, to what extent, I mean, how should we, interpret or imagine the sort of boost and, whether it's going to be a lasting boost to consumption and specifically to the auto sector that these cuts will yield? I mean, say, given your monthly run rate, of course, there'll be an immediate bump up, I guess, all the pent-up demand, maybe in the next 2-3 months, especially in the festive season. So by how much more than the average anticipation would you expect your volumes to go up? And then is it a one-time bump up? I mean, or how should we look at the longer-term impact of this?
So the basic impact will be is the fact that with prices coming down, demand should go up. In terms of specific numbers for us or for any particular company, it is going to be difficult to say, but it will be a longer-term impact. What I could say is, from a macro basis, I'd expect this to take our growth rate as an economy to greater than 8%, and for us to be somewhere between 8 and 10% over the next few years.
Okay, so so we're going to take that and pull that flash out that Mr. Shah thinks that the GST cuts can take India to 8% growth rate in terms of an economy. And again, Rajesh, if I could ask you the question, so if you were expecting X as your festive sales number, will it be X plus 20% now, X plus maybe 25, 30%, just so that we can wrap our heads around the size of the impact?
Yeah, you clearly don't give up, Surabhi. So.
Just trying.
I think, Surabhi, the reality, as Anish said, is there is limited time to capitalize the upside in the festival period. We are literally 20 days away from the festival period. We can't increase capacities or production outputs. Festival period is a 30-40 day period. So I honestly don't think we're going to get a wholesale billing upside in the short run. This is more a long-term game.
All right. I'm so glad that both of you could join us. Anish, thank you very much for being here on the channel, explaining the impact and what many believe is the one company which perhaps benefits the most within the auto space. Rajesh, glad you could make it. Thank you very much for joining us here on CNBC TV 18. Gentlemen, goodbye.
Thank you, everyone.
All right. Well, that's Mahindra & Mahindra with a rounded sort of perspective on the top down and, of course, a bit about the bottom up as well. So, and we'll, as I said, continue to get you reaction after reaction across sectors, cement, consumer durables, and so on and so forth. We'll take a quick commercial break here. As I said, with insurance, it's a little complicated, the exemption on policies, life, etc., health, etc., will that translate to premiums going down? The answer is not an easy yes. Niva Bupa Health joins us on the other side with exactly that. Stay tuned. by law.
Welcome back. Decoding the impact of all of those mega GST cuts. You just had heard a comprehensive conversation on autos. We'll get to insurance in just a bit. But in the meantime, let's also not forget there's a trading market and we have to look at what commodities have been doing as well. Manisha is joining in. Manisha, morning. What are your big headlines?
Well, when it comes to GST, I was talking to cotton and textiles and agri, and input costs clearly have been rationalized as far as GST is concerned. So a big cheer coming in from there as well. But when you look at the international markets, where the headlines still coming in from gold now, where it is a fourth straight day where you have record high continuing in case of gold prices. $35-70 an ounce has been broken now, and with that, we have seen the gold prices gain up by 37% in this year. Silver also continues to gain a new 14-year highs onto that one. And with that, silver is up 42% in this year as well. So very strong going when it comes to precious metal prices there. Markets are now looking at the soft U.S. jobs data, which is reinforcing expectation of a September rate cut. And if you look at the CME Fed tool, there is now a 98% chance of a 25 basis point rate cut in the month of September. In focus now is going to be the U.S. jobless claims, ADP employment, and then you have the most important Friday's non-farm payroll data coming in. So promises to be a very exciting next 48 hours in the international markets from here.
Okay, all right, Manisha, thank you very much for all the updates. As promised, let's now get to the insurance sector to understand what this means for companies and whether as consumers we indeed have something to cheer about or not, given that both life and health insurance policies have been moved to the exempt category. That's what the big announcement was. Also, GST on reinsurance cost has been moved to exempt. This confirms the CNBC TV 18 news break. We have Ankur Kharbanda, Executive Director at Niva Bupa, joining in. Thanks very much for being with us, Mr. Kharbanda. Now, this is just explain what your understanding is that now life and health policies, when we pay premium, it's at exempt. But the problem is, I think that, you don't get to claim input tax credit. So what happens? Will you have to adjust by actually hiking premiums? Will you look at absorbing it? Your first thoughts on this?
One is the customer will get this benefit. It's an 18%. It's almost 1/5 of the premium which customer was paying earlier. So he gets a big 18% adjustment over there. The second question, do we get the input credit? Because now it's into exempt mode. As of now, there is no big clarity, but assuming, we will get some more clarity after this. But we have three costs. One is reinsurance cost, then is our operating cost, commission cost. Reinsurance is also exempted. So hence some of our costs will get, there, which is waived. The rest two costs, which is the commissions cost or the other expenses, etc. cost, that is something which will not get the benefit out, and that's what we need to figure out. How do we manage this? Because we want to give the benefit to the customer. We want to give the full benefit.
So, if I can just make sure that we're clear, we're understanding this clearly. You're not looking to hike premiums. Whatever adjustments have to happen, whether it's with distribution costs, whether the company looks at it, the fact that reinsurance costs, that hit comes down, it'll not happen by a hike in policy premium. Is that right?
We're not looking at anything which is, giving on to the customer. We want to give this to benefit to the customer. We don't want to increase premium as of now. We still want to assess this, understand this in terms of what impact it has. But as I said that, this is an historic moment. We would see a lot of customers getting in. We would see a lot of...
Yeah, no, absolutely. Let me just ask you this. That's a very hesitant answer. You obviously would not want to hike premiums immediately. But does the math as it stands right now, do you need to compensate for the no input tax credit and the 0% on policies? Does the math necessitate a hike? Let me put it that way.
There are various factors we need to consider. Does it
just a short yes or a no, Ankur? I'm sorry to push you.
Immediately, no price increase.
Immediately, no price increase.
What is the definition of immediate, Ankur? Immediate is 1 month, 3 months?
We need to assess. We need to assess this. We need to get more clarity. But we want to pass on this to customers. This is an historic moment. We should celebrate this. We should
Absolutely. All
celebrate
right.
this.
Hi, Ankur. Good morning. Good to see you. When let's focus on what we know then and what we can understand from what we have. Reinsurance cost, that will come under GST exempt category, as you mentioned, right?
Yes.
How much does reinsurance cost form of the total cost, and how much does commission and claim cost form? If you could break it up for us.
So it depends upon various policy sets. For individual policies, it's different, and corporate policies, it's different. And we have reinsurance treaties every year. It changes. But if I have to give you just a guess, overall estimate in terms of how much is the overall cost, all input cost, assuming if it's 1/3 is reinsurance cost, and the 2/3 is other cost. That's how we have divided this as of now. 2/3 is other cost, whereby we do not get the input credit today.
Do are health policies reinsured?
Yes, for us we do that. Do that. It's dependent on each individual organization.
But
How do they
typically,
want to do
compared
it?
to other segments, the rate of reinsurance in health is lower, as I understand it. Is that correct?
Lower. Yes, it's lower. Yeah.
Okay. So in that sense, I mean, that benefit also perhaps is a little lower.
Correct.
Yeah. I'm sensing a premium hike 3 months out, Ankur, if I can put it that way. But
I can't
as you
say
said,
that, but I can just say that we want to pass the whole of this to the customers.
The other thing, of course, you will because I pay 118. You collect 118 from me. You give 18 to the government, so I'll pay 100 now. So that is there. But the point is, on premiums, there will still be we'll see how it goes.
Overall growth will go up. My operational cost will go down because of that. So there'll be some benefits also coming from there. So we need to adjust all of this before we can.
Although I must say, health you will take a health insurance policy. You don't wait for premiums up or down, right? It's a necessity. Those who want to.
Yeah.
So should this necessarily be a boost? It's great news.
It's a great news, yeah.
But it should not necessarily push up volumes or increase penetration in that sense, right? The cost aspect of it.
It will, not the cost perspective, but overall the business, the revenues will definitely go up because of this.
And also on that, Ankur, simple argument, but it just seems logical, because if the price comes down by as much as 18%, I mean, if you pass on everything, then more inclination to move towards more premium policies, the more value-added plans, etc. So within the mix, what are the changes you'd expect? And therefore, what can be the business impact in Q3?
I sense at Neva Bupa that there'll be a lot of things. Senior citizens we saw that they were reducing sum insures after some time. They would probably look at for a better cover and more sum insured. The young age, mid-age population who was seeing this as not a very important thing, a lot of new entrants will come. Tier 3, Tier 4, whereby it is not a priority today, health insurance, they will get into priority. A lot of value added, 60% plus of our cost is on outpatient. People were not buying health outpatient policies because there was an 18% tax on it. We see a lot of pull coming from the market on OPD as well, outpatient as well. So these are the few segments which we see will have a good uptake.
Yeah. Look forward to paying lesser premium on my renewal next time. All of us here, actually. all your customers, etc. as well. Thank you very much, Ankur, for joining us. And
Thank you.
We'll continue chatting depending on, what happens on the ITC, because that, of course, is the thorn with regards to insurance. And but for the customer, from a customer perspective, there is that 18% which goes away now. We'll take a quick commercial break here. We're going to come back. Deepan Mehta is going to be with us of Elixir Equities. He's going to tell us what to do in terms of stocks and what should do well on the back of what we've seen last night. Stay tuned.
Welcome back. Hope you're having a good morning. Well, it's good indeed because we have the GST rationalization that's going to be playing out in the month of September itself, and most of their questions have got answered late last night. Deepan Mehta, though, he's the man in the hot seat, Director of Elixir Equities, who joins us. Hi, Deepan. Near term, there could be some kind of skittishness with regard to demand, but in the longer run, this is going to be very, very good, right? Could you tell us, if you were to give us two stocks that would be the top beneficiaries going by what we have heard on the GST rationalization front? Could you name them?
Yeah, Nigel, good morning and thank you for having me on your show. I can name only one stock and you'll be surprised. That name is Bajaj Finance, because it is all encompassing all the GST benefits which come through, whether it is appliances or whether it is automobiles. That is one company which clearly benefits from higher demand for its loan products, because a lot of these items are bought on EMI. And that certainly is going to benefit the volume growth for Bajaj Finance. So it's the kind of the best way to play this GST cut is through a NBFC like Bajaj Finance, which is India's largest consumer finance company and a formidable player in vehicle finance as well. Having said that, it's a company which we and our clients are invested in, and so our views could be biased to that extent. And of course, the second company, if I had to name, has to be M&M. I heard the interview. The management is quite guarded, but I think that internally they may be rejoicing these cuts which have come, because they are clear beneficiaries over there at a time when there's good momentum behind their products and the new offerings have been received so well. This clearly is going to be a boost for M&M and may lead to even higher market share for them. Maruti will benefit, but as I said earlier also, that the cut in EMI for small cars not material enough to really drive growth.
Yeah, no, absolutely. What else, Deepan? On insurance, what is your sense? I don't know if you heard the Niva Bupa management, right? As one of the newer ones, but what we're picking up is kind of a mixed bag. So it'll be a strange situation if you actually see some red on insurance names this morning as we open up. I don't know, but what your thoughts, Deepan?
No, Prashant, you're right. There's no confusion. Okay, whatever services they are taking, whether it is telecom services, internet services, commissions which they pay, a lot of other expenses except reinsurance they're going to pay GST on it. So effectively, I'm not sure how much of a reduction we will see in our premiums, because initially I think they may bring it down to zero, but eventually when they recalibrate it, they may have to increase the insurance premium, because all of these GST inputs will not be available and they will just lapse. So net you will see, of course, the reduction, but don't expect like from 18% to zero means an 18% reduction in the premiums in the longer run. So that's my view. Apart from that, I think one segment which needs attention here is also the apparel segment. And retailing companies like V2 and Vishal Mega Mart, to an extent even D-Mart, they also benefit because the GST has been cut from 12% to 5% for a lot of the items which are below 2,500. That even benefits footwear companies, low cost footwear companies like say a Bata or something. And that could also be a boost for demand at a time when the festive season is also looking very good. The marriage season is looking good. So this is an additional trigger for retailers which are in tier 2, tier 3. I think Trent also may be a beneficiary because of its low cost offering. So that's also could be one of the stocks of sectors worth looking at and analyzing from a GST cut perspective.
Absolutely, yeah. I'm glad you put that on the radar as well. So, apparel below 2,500, footwear below 2,500, and V-Mart Retail, Vishal Mega Mart. I mean, these are the big names in that particular category at those price points. Deepan, just going back to autos for a bit, two-wheelers. Now, Bajaj, Hero, and Eicher. Let's take all of them very quickly. The biggest beneficiaries, I don't know, we know that Hero obviously is. Eicher, a small part of their portfolio is above 350cc. But from a stock positioning standpoint, and Bajaj Auto has been a big underperformer. So between the three, how would you spread your bets or place your bets? All three, 1, 2, 3, or none?
No, I think Hero MotoCorp, it's been an underperformer. And clearly, they benefit from the price-sensitive sector, entry-level consumer commuter motorbikes. So I would go with them. Valuations also are reasonable. And I think if the export pick up for Hero MotoCorp, you could see it inching up as compared to its competitors or peer group as far as stock returns are concerned.
And what about the Royal Enfield? I'll tell you what, Deepa, and just to give you a live, real case incident. To 2008, I went to buy a bike. I went to buy that the normal standard, which was 85,000. I ended up buying the Machismo, which was 125,000 at that time. 2008, I'm talking about the 500cc. So for Royal Enfield fans, actually, it doesn't make much of a difference normally. But what is your take on it? The stock is not very cheap as well.
Nigel, every time we have the discussion on Eicher Motors, and this is what happens, I don't think this is a trigger for Eicher Motors, but I think the company is on a roll. Exports are doing well, domestic sales are doing well, the expansion of retail network benefiting the company. And I think high valuations clearly justified. You can see the monthly numbers also coming through, really well for that company. Having said that, it's a company in which we are certainly interested in as shareholders.
Yeah. Deepan, what we'll do is take a break here. We want to talk about one more name, right? Aptus Value Housing. And we'll get your reaction. You talked about, briefly mentioned financials as a space. So stay with us. We are back in just a bit. Okay, welcome back. 3 minutes to go for the pre-open session. We have Aptus Value Housing, which should be in focus as well. Nimesh is standing by to tell us the reason. Nimesh, tell us.
Hi, Prashant. So the block is done in the block window. So it's a clean-out trade. Westbridge has completely sold out. They've sold their entire 14.5% stake in Aptus Value today via block deal. The size was close to 2,600 crores. So, so a couple of things. One, there is no leakage because it's done in the block window. Two, the supply overhang would be out of the way now that because it's a clean out trade from Wedgebridge. Again, I understand from a buyer's perspective, one large long-only fund was an anchor investor along with some domestic mutual funds. So disclosures will come in the evening, is my sense. But it's a done deal now, done in the pre-open itself. Westbridge has completely exited by selling its 14.5% stake in Aptus Value today.
Okay, so it's done, 2.5% higher. The pre-open will be with us in about 2 minutes and it'll give a sense of how things are starting. Nimesh, thank you very much. We'll get you some brokerage calls as well, which have come through in a bit from now. We're going to come back in just a bit from now with the technical trading ideas and also the management of Birla Corporation, because cement is in focus as well. Stay tuned.
Welcome back. Well, we are at 9 o'clock, so we'll start getting the pre-open rates, and the first of them are coming through. So if you go by the Sensex, and we'll wait for this to settle, the Sensex is up 1% as of now. Nifty rates will come in just a bit as well. Let's wait for them to come in and settle down. Let's look at, of course, more reactions, more commentary that's been coming in on some of these landmark GST cuts. ITC Chairman Sanjeev Puri has said that the proposed GST cuts can provide good momentum to the economy. He also believes that the tax cuts can boost consumption, which has been lagging due to elevated costs.
This is a very bold step that the government has taken. It's the Honorable Prime Minister announced it on the Independence Day. And I think it's going to have multi-dimensional impact, because it's not just about rate reduction. It is also about simplification. It is also about ease of doing business. So the changes are multidimensional, and impacts are going to be even more profound. I think it's certainly going to make things cheaper for the common man. So it will fuel consumption. It will lead to a lot more formalization of the economy.
Okay, so more reactions pouring in from the leaders of India Inc. Let's get to our technical experts now and see how you need to navigate a big day like today. Sudarshan Sakhani and Mitesh Thakkar are with us. Gentlemen, good morning to both of you. So we're gearing up for this gap up open. The question is, what do you do from that point onwards? Mitesh, let me open with you. Index trades.
Good morning, Subhi. So I think, we've been maintaining that the markets will possibly head towards the upper end of the range, given the fact that, we were oversold on the PCR levels, plus we were near the 24,400 mark, which has been an important support area. I think the midpoint, comes around this 24,800, 850, and that is, we might just open above that. That should suggest some kind of continuation, and we might actually even test 25,000. In case we see further strength, then 25,150 is the upper end of the range. I'm even looking at a possibility of Nifty heading over there. So in the short term, the bias is very clearly positive. The worry in the entire pack was Bank Nifty in the last 2 days, but the Bank Nifty yesterday gave first signs of reversals. So getting past 54,200, and obviously that will happen in the opening itself, would suggest that the Bank Nifty could also head towards 55,000. So all in all, good chance that we might actually head towards 25,000 or even 25,150 in the next couple of days.
Okay. So Darshan, morning. What would your approach be if we get this gap up as anticipated?
Yeah, good morning. See, there are two different trades. The first is for people who went and bought yesterday morning when that was a suggestion. For you, the trade is to take profits on half your positions and keep the other half. Just assume that you've bought it today, the other half. For those who don't have any positions, the trend is up. Look for a minor intraday dip and buy the Nifty. The chances are that we could, as Mitesh said, even I think we could reach 25,000 sooner or later.
And which is the better index to take that long trade, even if it's an intraday long trade, if you buy an intraday dip, which is the better index, Nifty or Bank Nifty, Sudarshan?
It would be the Nifty. It's much easier to predict and sort of decide on.
Okay. Mitesh, tell us if you concur, and of course, let's talk stocks as well. What's on your stock list?
On the stock side, I have all buy calls today. The first one is APL Apollo. Good crossovers on moving averages indicators suggesting upside. So buy here with the stop below 1652. Look for a first target of around 1720.25. Then a buy on Crompton. That's a stock which gave a breakout and then last 2 days has given a pullback. So gives a good entry point here. Buy with the stop below 328 for a target of around 345. A buy on Glenmark, which after good corrections, correction in the price is showing first sign of a reversal. So buy here with a stop below 1975 for targets of 2070. And Tata Steel, metals have been doing very well, and steel, the ferrous metal stocks have done extremely well. So Tata Steel made a fresh swing high. Buy with a stop below 165 for a target of 175.
Okay, all right. Gentlemen, thank you very much, both of you.
Sudarshan.
Okay, Sudarshan is, apologies. Gentlemen, morning. Sudarshan, your picks, what would you trade?
Well, I'll do it quickly. Oil India is a buy with a stop under 394. BEL is a buying opportunity with a stop under 371. Siemens is a buy. 3147 is the stop loss, 3147. And I have a common name, Glenmark. Glenmark is a buying opportunity with a stop under 1967. Stay long.
Okay, all right. Thanks a lot for that, gentlemen. Well, there's a big boost coming in for cement. GST on cement has been reduced to around 18% from around 28%. To help us out with what's the impact on the sector as well as on the company, Mr. Sandeep joins us, the MD and CEO at Birla Corp. Hi, sir. Good morning. Thanks a lot for joining in. Well, GST rationalization has come about. The entire industry was talking about this for the last many years. Firstly, how much do prices come down by? Because all of it would likely be passed on. And what kind of impact can it have on demand?
See, first of all, prices will come down approximately, as they're saying, 10 rupees. So it would come down in that region, I would guess, 10 or so. That's how broadly once it kicks in, that's after 22nd. But before that, one will have to see that you have to actually segregate between the short term and the long term. First of all, the next 2 weeks, I think it's going to be a slump. That's because, when the corrections are coming from 20th, trade down stocks, when you're seeing the prices going down. So September is not going to be such a good month for the industry, is my reckoning, both in terms of volumes as well as in terms of pricing. And thereafter, things will stabilize over there. And that will be, as you are saying, you'll probably see a correction about 10 to 15 rupees, depending on the region, depending on how the balance is.
Okay, got it. So, the broader view is that September could be a little bit softish, but because of this rationalization, it could spur demand. Earlier, you were talking about 7 to 8%, demand growth. Do you think that's possible right now, taking into account, that there's going to be some softness in the near term? And do you want to up that estimate?
See, first of all, it's too early to really make an prediction on the overall demand scenario. But I see the demand will get triggered not just by the correction of the cement duty. Where the monies will go into the hand of people is the all across reduction. So, be it in consumer goods, be it in other building materials. A lot of other building materials, as you know, they have also the duties have come down. So that will give more money in the hands of the home builders to go in for, and it should give a boost to the IHB segment. See, infrastructure demand would be by and large inelastic. I'm talking about the large infrastructure. Where you're going to see the difference is a lot of this will trigger the rural demand. It'll trigger the development expenditure in Pradhan Mantri Awas Yojana and those sort of projects. That will take out. There you will see a positive impact. But the bulk of the impact will come, I think, from the retail sector. And that is where people like us who have a high volume of blended cement, high volume of what we call the trade sales, as opposed to non-trade, which is the industrial, the big infra sector, they are to benefit a lot.
All right. So a couple of aspects here. The street believes that maybe there could be some margin, gain as well, because maybe all of it or most of the pricing will be passed on, but operating leverage will help and focus on premium sales will help. And as you said, I think trade sales for you is around 70% of the mix. Is that correct? And out of trade sales, close to around 55-60% is premium. So do you think people will go in for higher amount of premium now, premium products?
See, premium, when you talk of, there are two ways to look at it. If you're looking at it from your market standpoint, you have to see the people who are operating at the higher price band. And there are people who are operating primarily on the higher price band. So if they have a strong brand pull, they have a pan-India presence, you will see some of the benefits coming in there. And for smaller players who have a mix of premium and what you call popular or the value segment, obviously they could see an uptrend on the premium, which has been generally, as you will see, a trend not only in cement, but in a whole host of industries. There is a premiumization going on. And if things become more affordable, you'll find especially the individual consumers who are now more aspirational, they are going to opt for the branded and the quality products.
Okay, all right. So there'll be some kind of downtick in terms of pricing. Demand for the year, you're working with high single digit, right? 7 to 8% cement demand growth.
We'll really get to see the demand post the festive season.
Okay.
Because there are various factors, it'll be too early to talk of. The monsoons has an impact. Some say the monsoon, the heavy rains could dampen a bit of the agricultural demand, etc. So I would not right now rush to predict a demand upsurge, but it'll sort of balance out between everything. As you said, if there is a price drop, there'll be certain benefits for price drop to people. It's not all because the coal, that's a big ticket, I think.
So just want to clear, sir, two more points. One is on SGST, because states effectively, now they'll get lower amount of money via the GST route. So will it hit incentives for a company like yours? Do you see it as a risk? Point number one. And the second point, sir, is on coal. Coal, the GST has been up to around 18%, but they're done away with cess. So effectively, that doesn't, increase cost for you. Could that be positive on the margin?
Coal would give people who are highly dependent on domestic coal, I think it'll give them a benefit because of the cess removal. That's the big thing. Because the other GST is going to get offset, that's an input credit, which you will get by and large. So that increase is not going to hit the bottom line straight away, but that cess reduction, especially for people or regions where people are dependent on domestic coal, I think that will be a positive.
That will be positive, but the state GST, could it be a risk?
State GST is slightly more complex. There are two parts to it. Those are capital, capex-based incentive. You may have a short-term thing, but the overall the quantum of GST is not going to get affected as GST. And also, if there is a cap, most of the states have a cap, annual cap. So if people are already meeting that cap, it is not going to hit their absolute numbers in terms of number. In terms of the market, I think it should be healthy for the market because it will create a more level playing field. There are some players who were heavily dependent on incentive, and they will now have to be more prudent in how their pricing goes.
Got that. Thank you very much, sir. Thank you for joining us and running us through first thoughts as far as the GST cut is concerned. Let's get back to the market. 2 minutes to go for the market open. We're going to just revisit Mahindra and Eicher. Sur is putting the spotlight on these two names. Sur, over to you.
So two surprising factors in the auto pack from the GST Council meeting. One on the positive side is for Mahindra and Mahindra because now SUV GST has moved higher to 40%, but effective tax rate would be lower than the earlier tax rate because earlier, for example, on XUV 700, 28% plus 22% cess, so total effective tax rate used to be around 50%, which would be now at 40%. And now management is saying that 60% of companies' total volumes, including CVs, will be in 18% slab and 40% of SUV portfolio will be in 18% and rest will be in 40%. So overall, it's positive for M&M. Second, Eicher Motor. So almost 89% of its total volumes will be in 18% category. So that's positive. But one surprising negative factor is almost 10% of total volumes will fall into the bracket of 40%. So effective tax rate will increase from 31% to 40%. So that would be minor negative for Eicher.
All right. We got things opening up. Eicher is up 5%, as you can see. If we have time, let's just quickly put the stocks up. I don't think we'll have enough time. But
M&M 7%.
Yeah. So, and by the way, the Nifty Auto Index, I just looked, from 14th of August close, 15th was the Prime Minister's announcement that we'll go big on GST, is up 7%. But even after that, you got big opening gains coming through. 24,900 on the Nifty, 81,250 on the Sensex. And these are the first rates which are coming through. 190 points, almost 200 by the way. 24,900 is coming through on the Nifty at this point in time. The Nifty Bank is up about 0.5%, 54,318. And the mid-cap index is up about 1%. The small-cap index will come up on your screen, which should be higher as well. So across the board, of course, it's green. And I think all 50 Nifty stocks should be higher. Maybe the insurance names, but we'll see. The heat map should tell us that. We'll dive into individual stock sectors, etc. Right after that. The reinsurers, etc. are opening higher. Heat map on your screen. What do we have? Okay, not all. IT services and a bunch of others are lower, but otherwise it's all up. And Mahindra, I think, is leading the way once again. 160 points on the Nifty. Surabhi.
Absolutely. And M&M is looking really, really smart with a gain of almost 6%. But I must point out that even insurance, where there's the worry, right now, all insurance stocks have opened positive, including Niva Bupa. Niva Bupa is surging 7%, might I add. The company just told us that overall it's going to be very positive. They will be passing it on to the customers, at least as of now. And they expect perhaps higher value policies and a bigger sum assured to get sold because people have more money to just buy better and bigger policies. And that seems to be working in favor of the stocks. Anyway, coming back to the Nifty tally, apart from the individual beneficiaries like a Nestle, like a Lever, like an ITC or a Hero Moto, look at Bajaj Finance. The market is choosing to play this through some of the diversified financials. And we know Bajaj Finance obviously has a huge consumer lending franchise. And that stock is the next biggest beneficiary after Mahindra and Mahindra. Then come in some of the big cement names like Ultratech Cement. Nigel's been telling us that overall it's a big positive as well, with the cement moving to 18%. Eicher Motors, Nestle, Lever, ITC, Trent. Incremental gains between 1 and 2% on all of these stocks. And even the insurers within the Nifty, SBI Life is positive, HDFC Life is up 0.5%. So there is no big slam dunk on insurance at all. Perhaps the market had enough time to prepare for this. On the flip side, actually not too much. Reliance is a bit of a drag. It's a bit of a spoil sport this morning, down about 0.5%. Eternal is cooling off. And some of the metal names after yesterday's scintillating performance. Today, the metal stocks, Hindalco, Tata Steel, etc., is slightly lower. From a 200-point pop, now we're looking at a 160-point move on the Nifty.
Well, some of those hotels as well are doing well. Lemon Tree, that's moving on high volumes, up 3.5%. As Deepan said, Bajaj Finance, well, that could be the ultimate beneficiary because all the items that you're buying by taking some credit, well, their GST has come down. So that could be an indirect play. And that's why that stock is up close to around 4%. Solid move on that particular name. Dabur is up close to around 4.5%. So big move out there. Vishal Mega Mart is another stock that's moving on very, very large volume. So that one's up and about. The ones that are under pressure, you have Delta because the casino entry GST rate has been fixed at around 40%. And Varun Beverages as well. That one is down close to around 2.5% or thereabouts. Ashok Leyland actually is down close to around 2%. That's one of the notable names from the auto pack that's actually underperforming in today's trading session. Pull up Newland Laboratories as well. There was an IC note that had come in from Nuvama with a target price of around 17,700, I think so. So maybe we could get that stock up for the time being, it's up only around 0.5% or thereabouts. But otherwise, autos, consumption themes doing well. The market's holding at around 24,850. You'll want to hold on to these gains. The markets are net short. It could result in a bigger up move, but you need to hold on to these gains.
Well, that's the thing, right? 180 now, 150 actually. So just about getting things going this morning. We'll get to individual stocks and talk more about this, but let's welcome in Venugopal Gare as well. He's India Head of Research at Bernstein. Venu, good morning. Great to have you with us here. Thanks very much for joining us. Venu, the simple question is, how much is in the price and how much is not across sectors, across mostly consumption sectors? Rates are either flat or they are lower across the board. How do you think about this question? How much will this do to increased affordability as a fillip to consumption? Venu, go on.
Thanks, Prashant. Everything in life is relative to what it was earlier. So that's a broader principle I use. So if you were to look at consumption in general across the board from a broad-based standpoint, from an economic data points perspective, things have not been that great in the last couple of years, while we've essentially seen the other parts of the economy, including industrials, capital expenditure, essentially being the ones which have led the last few years. Now, what is essentially happening is broadly a forced policy push towards consumption. And this is not the first point at which this is being pushed. We've been sort of seeing the change in theme from the fag end of last year with the direct tax cuts announced with effect from April, a $15 billion sort of a positive cash flow to the middle class, which is a recurring annual sort of a cash flow. And on top of that, you have this GST impact, which purely from product standpoint, when we look at the impact is more than $20 billion. I'm just ignoring anything on the services side, which again is a pretty large number. Remember, that doesn't stop at this. We also have pay commission impact, which is a pretty large number again next year. Lower inflation this year in the second half of the year, lower rates, higher liquidity in the system. All of it broadly needs to be factored in when it comes to the potential positivity when it comes to consumption relative to every other sector. So that's the way I would look at it. At the margin, incrementally, the sector would outperform. Quantum-wise, of course, remember that the limitations, if at all, would be the fact that economy in general hasn't been that great. And plus, you have the export impact, which might sort of impact a bit of jobs here and there. We need to negate that as well. So these are the counterbalancing sort of aspects to the extent to which you will see a push.
By the way, I just want to point out that the market today, today's level of the Nifty is a couple of notches lower than where the market closed on the 18th of August. And why do I talk about 18th of August? Because that's when the market reacted to the announcement, Prime Minister's announcement, which was made on the 15th of August. The market that day closed at 24,876, exact number on the Nifty, 876. Today we're at 852. And Venu, that's my question. So much positivity has been thrown at the market. This big, government spent a lakh crore, right? That's the revenue loss from these GST cuts. And there's hope of a good festive season, good monsoons. But why is the market in such a funk? It's simply sort of refusing to see or get too excited about the positives. So what do you think this is? Is it just because of the extent of selling? Or what's happening here? Why not the kind of excitement that you would anticipate after a move as big as this one?
The way I would look at it is that the economy has not been very strong for almost a year. Ignore the base effect aberrations and catch-ups, which led to a recovery in the March and June quarters. But on a broad basis, domestic economy has been weak. The second main part is, of course, you're still seeing some concerns on the geopolitical side of things, the overtures India is trying to do with China, US-India relationship spoiling. We've essentially moved to a 50% tariff. After the GST announcement, 2 weeks later, we had moved into that higher tariff rate. So putting all this into perspective, remember that a lot of what is essentially happening on the policy front are offsets to economic weakness. And of course, what we are seeing today is slightly larger than an offset, but the reality is it's only neutralizing some bit of the negative impacts. The other thing, remember, is purely from a flow perspective, there are two main things to note. One is we've not essentially seen EM money or FII money essentially too excited about India. Part of that is because there were great opportunities elsewhere. And more importantly, economically, things were a bit more weaker, along with valuations being higher. So that is something which needs to reverse in the second half of this year for you to see markets to go to higher levels. And we do believe later in the year it would, because once all these moves essentially lead to an improvement in the economy is when you essentially see FII money flow in. And whatever domestic money is flowing in, you're also seeing the IPO pipeline as well accelerate. So there's a lot of selling as well happening in both the primary and secondary markets, which is sort of digesting that bit of a flow. So it's a combination of all that. I wouldn't really worry too much about it 6 months from now, but don't expect any immediate gains just because of this move.
Hi, Venu. Good to see you, Ben. No, but it's encouraging to see at least the centre taking note of the slowdown and acting on it. And monetary policy as well has been pro-growth. So I think both those two at least, they acknowledge the problem and trying to do something about it. That said, the two big beneficiaries, going by the reactions on the stocks, going by what most brokerages are saying as well, autos as well as FMCG. Now, FMCG actually, the staples part of it has underperformed. How do you approach that pack? What do you like from FMCG, the discretionary spend, or do you think staples as well, you'll give it a look? And from autos, which category do you like?
Okay, so, on an overarching basis, when we headed into this year, we had a change of view in terms of how we positioned our sectors. So this was the first ever year where we had consumption overweight on a broader basis relative to industrials. Now, within consumption, FMCG as a space, I had upgraded about, I would probably say 1.5 to 2 months back. And that is a sector which is essentially underperformed for a fair bit of time because of volume growth concerns. This is a space, I guess, given what has happened to GST changes today, is a positive surprise, honestly. I didn't really expect some of those categories to move to 5% rate, especially when things like shampoo, soaps, I thought probably it'll be still at 18. So it is a positive surprise. So FMCG pack in general, I guess, still has some legs because it's not really done well in the last couple of years. Within the small value discretionary, I think we shouldn't miss out on that fact, which is durables and other areas, ideally should also see some degree of lift in terms of demand. Remember that just because a consumer is saving, let's assume the $20 billion number based on whatever he was purchasing earlier, that money doesn't need to go into the same sector. That could perhaps be used for buying any other product, or maybe even invest or repay debt, whatever. I mean, from a quantum standpoint, one can discuss. So that is a very important factor as well when it comes to taking an overarching view on consumption rather than a particular category. Yeah. Coming to autos, very clearly, it's a benefit across the board for ICE players versus EV, because the gap between EV and ICE tax rates are narrowing. And within ICE, we've been in general positive on small cars, which has essentially seen a run. We're also positive on the tractor sort of slash SUV space. So these are relatively more preferred rather than an entry level motorcycle, because we do believe that wherever penetrations are lower, there'll be a larger propensity to see a broader volume impact, as against sectors where penetrations are already high. You should ideally see a lower impact in terms of volumes. So that's a broad way I would put it.
I just want to quickly highlight that if you look at the auto space, right, it is Mahindra at one level, everything else is far below. Eicher is also just up about 2.5%. Mahindra continues with its 7% pop. not very much else really in a big way, which is sort of starting to show through.
And on auto, the actual beneficiaries or the ones that were supposed to be big beneficiaries like Maruti or Hyundai, the stocks have also not moved too much. Those stocks are up between 1.5%.
Surbhi, it's a sad thing, but as someone said, and I think it makes sense, right? That, like at the lower end of the EMI difference, for example, a Alto or the entry-level kind of cars, the EMI difference is so small, it's actually a few hundred rupees on a typical auto loan. So if you could not afford a EMI, for the entry-level car before, would a few $100 make a difference to push demand?
Yeah.
Right? That's the. I think it's a relevant question to ask. Hopefully it does, but I don't know. Yeah.
No, absolutely. And in fact, I was going to ask Venu exactly about this, about financials and the way we need to think about it. Because, of course, Bajaj Finance is a clear beneficiary straight out. But overall, on financials, would you expect...
I think Venu wants to say... Venu, you want to add something? I can sense that you want to come in. Go on, Venu.
I just loved your comment on the quantum of EMI impact. If you were to extrapolate this to every product category, then there's going to be zero impact on anything. So a 20 rupees soap, why should somebody buy? Because it's 2 rupees cheaper, right? So I think we need to look at it from a broader context of...
No, you're agreeing with me, or you're being sarcastic, Venu?
I'm being sarcastic with you, not to the market.
Sorry, what is that?
I'm being sarcastic on your comment rather than on the market and the benefit. I do believe you need to think of need to look at things from a very holistic overall impact perspective, right? So this $20 billion number is, I don't want to nitpick on particular categories. Honestly, 100 to 200 rupees saving is very meaningful for a particular individual who's buying a two-wheeler. A 5 rupee saving might be quite meaningless across the board on a soap for anyone, right? So, but the saving is a saving, right? And it's going to feature somewhere in terms of some incremental volumes. That's the way I would probably present it. And also remember, Prashant, that Maruti...
No, Venu, my point, the point is you're aggregating all the savings, and that is saving in the hands. It'll go somewhere. But my only point was, can you say this segment is where it's going to see a bump up? I mean, that was my point. So for entry-level cars, will demand go up significantly because you got a couple of hundred rupees in terms of EMI savings?
The price of the
car
I'm not itself sure. is down 10%, right? We have to take that on board as well. That the price itself, if it's passed on entirely, like Eminem said, the price of the product does go down by 10%.
That's what I'm saying. Yeah. But calculated as EMI.
As EMI.
It's 700-800 rupees.
Yeah.
That is my point. I'm saying, will it really move the needle for that product category? I'm not sure. Go on.
Prashant, fair point. In fact, just a couple of minutes back, I had commented this, right? Saying that a saving in a particular category does not mean you invest in a particular category.
Exactly.
You would probably invest in saving somewhere else, in any other category.
Yeah. That I agree. Completely. Yes. No, I think we
also remember that stock prices have moved very differently. Maruti had moved ahead of this particular announcement quite materially. It was below 12,000 rupees just about a month back.
That is true.
So
that is true.
Think of that fatigue as well, right? And
absolutely.
had not moved much 2 weeks into that previous GST announcement after the Independence Day. So maybe that is the other aspect to look at it. Plus, this incremental thing is tractors also have happened. So that is also playing more as a positive sort of a spirit.
No, absolutely. And everything doesn't need to happen on day one. When you take that point, I mean, the manufacturers themselves have told us, right? This will eventually play out. They'll ramp up their production and they'll see what the debate that you and Prashant are having. I think we'll have exact clear answers within 2-3 months on whether the customer behavior starts changing, because the headline number of that particular vehicle itself is down by 10%. But I just want to get back to the point on financials. Whether we should look at beyond something like a Bajaj Finance, whether we should look at banks differently. Do you expect a leg up in financing to show up? And if yes, across what kind of lenders?
Yeah, I mean, honestly, the financial sector is in a situation where credit growth has been fairly weak. In fact, deteriorated all through the beginning of this year. As you see the second half of the year, there are clear positive signs of why credit growth should improve. We're essentially seeing a lot of liquidity come in the system. And more importantly, I think the regulatory system is more or less keen on pushing up consumption leverage back again a bit at least, or leverage in the economy a bit more, right? So these are all positive signs. You want to play it through a bank, you want to play it through a pure play durable lender, or you want to play it through, let's say, even things like affordable housing companies. It's across the board. You can pick and choose where you're more comfortable from a valuation standpoint. See, I am on an overarching basis overweight in financials. apart from my consumption overweight here and there. And as you know, I'm underweight industrials in other areas. So I would be probably playing a bit of financials as well from a standpoint of leverage.
And which category? I mean, spell it out. You just named a couple of them, right? But where is it likely to show up the most? Specific niche NBFCs catering to consumer, housing, what, where would you really expect the impact to be?
Exactly. The consumer parts of each of these entities. Some companies would be more, NBFCs would be a bit more leveraged to that. So they'll probably benefit a bit more than an overarching large bank, which is doing a lot of other things. But then my call on financials is not purely linked to GST and consumption. It's more led with overall credit growth improving from where we were earlier. So it's tough for me to, remove myself from that broader thought process of overall credit growth and not just consumption-led credit growth.
So financials, right, where economy, the financials are lenders, they're economy-facing, and so you don't have to choose. I don't know, you can't pick stocks, but I'm saying something like Bajaj Finance, right, consumer lender. I'm assuming with exposure to multiple sectors, but on the consumption side. So it should show up in those kind of names.
Yeah, I mean, look, it's all about relative growth as well, Prashant. So if something is growing at 25, it goes to 27, does it really lead to much impact versus something growing at 8-10% credit growth going to becoming 12? I guess the impact is much more for that, right? So it's you can't basically take a particular stock and say the impact is only going to be on them.
You're being very cryptic today. We'll need to. We'll.
I wanted to avoid
You're saying this and that. But anyway, we'll leave it there and we'll talk again and come back and we'll talk again. We've got lots of GST companies to talk to as well. Appreciate your time here as always, Venu. And thanks very much for joining us as always. So that's Venugopal Garre, Bernstein, with his perspective. We spoke with the top management of Mahindra & Mahindra. That by far is the biggest gainer on the Nifty. Anish Shah, Rajesh Jejurikar. Listen to what they told us. Basically, every part of the portfolio, according to the Mahindra management, will get a leg up. Listen.
Ushers in a new era of simplification and possibly a new era of ease of doing business as well. It will have a very significant impact on consumption. And this is something that should, in some ways, create that momentum that we were looking for in the economy. A lot of the fundamentals have been in place. But I think this is a very significant move that will create that momentum and propel India to an 8 to 10% growth rate overall. So that is the reason why we feel it is a very important milestone for our economy and sets it up in the right way.
Tractors gets a big boost, 12 to 5%, which will lead to prices coming down 40 to 60%. There is limited time to capitalize the upside in the festival period. We are literally 20 days away from the festival period. We can't increase capacities or production outputs. Festival period is a 30-40 day period. So I honestly don't think we're going to get a wholesale billing upside in the short run. This is more a long-term game.
Okay, that's a take from Mahindra, and Mahindra stock is still looking rock steady and solid, 6.5% higher. Overall, the Nifty, it dipped to about the gain being a 150-point gain, but now again, you're seeing a second wave of buying come in, and overall, it's looking really good. A lot of consumer stocks, by the way, Nestle, there is ITC, there is Lever, there is Trend, plenty of names. Actually, let's look at some of the others as well, like Dabur. Yeah, Dabur's up 3.5%. So many consumer names on the upswing. Colgate 4%, and I named some of the others as well. In fact, on that note, let's bring Mangalam back in to look at specifically ITC to understand, because it has lots of different parts of the business. For some, obviously, the rate goes down, but what happens with tobacco? So overall, what does this mean for ITC, Mangalam?
Well, from all the details that we have so far, it looks like it is a positive for ITC, and here's the reason why. Because if you look at the current cess and situation or taxes on tobacco itself, it is 28% GST, plus there is a specific and ad valorem cess, which totally amounts to about 53 to 55% of the MRP of a cigarette that one buys from the street. What is proposed that this compensation cess will actually be subsumed. This 28% turns 40%, and GST will be 40%, which will be charged on MRP versus the transaction value, versus what it is right now, 53 to 55%. The government has said it will be tax neutral. So what this means is that we need to know whether the NCCD or the National Calamity Contingent Duty continues or not. If that does continue to the rate of around 10 to 15%, that means it is absolutely tax neutral, and that is what the analysts are expecting. So no increase is definitely a positive. The second part is that a large part of their other portfolio, non-tobacco portfolio, FMCG staples products, they've been bought under the 5% slab. So that's positive for the volumes out there. And then they also get a fair amount of revenue from notebooks, the ITC Classmate business. And that, the exercise books, notebooks, etc., have been brought down from the 12% slab to nil. So the tobacco portfolio, there is no fear of increased taxes. And the other portfolios, there are lower taxes. So all these, with the fact that the stock is trading at around 25, 26 times 2-year forward earnings, makes it, stand out in terms of beneficiaries from the GST rate rationalization.
Okay, all right. So ITC climbing on the back of all of that put together. So net, nothing negative. And in fact, incrementally for some of its businesses, including FMCG, notebooks, etc., there are incremental positives coming through. However, AC stocks are actually, slightly under the weather, can I say, because there's not much of a euphoria. Voltas is down about 0.7%. Blue Star is up about 0.3%. Though, of course, there has been there's been a build-up. So if you look at a longer-term chart, let's pull up Blue Star, and if you see, say, 6-month chart or a 1-month chart, this week itself, going into the GST meeting, there was a little bit of a, so there was a bit of a pop that showed up. The question is, what happens from now? Because the GST cut has indeed come through from 28%, ACs, washing machine, a whole range of consumer durables, television sets, everything has moved to 18%. So let's discuss this. We have Mr. B. Thiagarajan, Managing Director at Blue Star, with us. Mr. Thiagarajan, thank you so much for joining in. Now, very interesting, right? I remember all our conversations. It was a rough start to the year with a washout, monsoon season, tough first quarter. But now you've got a big bonanza coming in from the GST Council. So help us understand this, sir. I mean, but, ACs are also, it is also a seasonal business to a large extent. What is the immediate implication? Do you expect any sales in the festive season? Because some parts of the country, including here in Mumbai, October can be fairly warm. So, what is the impact near term and then medium term?
Good morning, Shirbi. It is a pleasure interacting with you. So as we had discussed, the summer season was bad. But whenever summer season is bad, the festival season always does well because of the latent demand. So one would have anticipated 15 to 20% growth during the festival season. But when the announcement was made on August 15th, as you can imagine, the consumers would wait, and they have been waiting. I think they will wait till September 22nd. Rightfully so, they are entitled to this benefit. So I anticipate that from September 22nd onwards, till the new year, it should be a great season ahead for multiple reasons. Significant reduction of around 10%. It is anywhere between 2,500 to 3,500 rupees, depending on the model one wants to buy. And never in the history there had been such an increase through one announcement. There is a energy label change that is coming up on 1st January 2026. Therefore, there will be a rush to purchase the products before the prices go up. And the third part is that there will be significant amount of shift in the consumer behavior. Someone who wanted to buy a 3-star will end up buying a 5-star. Someone who wanted to buy one air conditioner may even consider buying 2. So therefore, this is a period. You see, also I must tell you, the disposable income is going up on number of friends actually.
Oh, absolutely. Absolutely. Because there are savings across the board. Depending on apparel, etc. So we'll need to see where the consumer really decides to spend more. And it might be different for different categories. But sir, you said that earlier you were working with a growth of 15 to 20% this festive season. Now with the cuts coming through September 22 onwards, what is your estimate for festive season? Could it be higher? Could it be 25 to 30%?
It should be higher, but not in Q2. But if you take Q3 together. See, I will also tell you, we had shared the figure that even though the summer season was washed out, the year began with an expectation 25 to 30% growth in FY26 is possible.
Yes.
But when the summer season had been a washout, we felt that 10 to 15% growth only is possible. Now I would say the industry can look forward to even 20% growth for the full year. And it is indeed possible, even though the summer season was a washout.
And how much in the festive season, which largely is going to, fall in end September Q3, but again, festive to festive comparison. Earlier, you were expecting 15%, 15 to 20%. What's your expectation now?
I think it will be 30.
30%.
Generally in India, when an announcement is made like this, there is a huge rush. And this will indeed be taking place. And the intention here is to pass on the full benefit to the consumers, right? And that's what we will do.
All right. Hi, Mr. Thiagarajan. Clearly, you're sounding quite optimistic about how things will pan out from here on. But I just want to ask you how the 20% GST in the current inventory will adjust itself?
Nigel, an intelligent question. So there are products which the dealers have bought at 28%.
Yeah.
If the rate would have remained unaltered, there is no issue. But here he will have a higher input tax credit. It is not only air conditioner, the GST rate has dropped, but across consumer durables. So therefore, the dealers will have a working capital burden. We have done the calculation, possibly for about 2 to 3 months they may have the burden. And there is some compensation that may have to be considered in terms of that interest burden they have.
So then near term, it will be a bit of an issue for those that are already sitting on that inventory, right?
In our case, it is around 30 days more than what is required. That is the inventory. But that's manageable. See, nothing in life comes without going through some hardship, right? But I'll tell you one more thing. The entire portfolio, the demand planning will change, right? We would have planned for certain quantities in October, November, December. We have to wait and watch and produce more. The next part is connected with there will be a significant shift. A person wanting to buy a 2-star will end up buying 3-star. Yeah, some other brand someone want to buy may buy a premium brand. And a 3-star buyer may ask for a 5-star. So there is going to be some work to be done in order to reap the full benefit of this reform.
Okay, got that. We'll leave it there, sir. Thank you very much for joining us. It's a pleasure. And very sort of good insights in terms of how this may play out for the AC sector. So there's a clear bump. There could be upgradation in terms of aspirations of what people want to buy, the kind of ACs, the number of ACs, etc. on the back of this. We'll take a quick commercial break here. We'll be joined by the managements of Poly Medicure and Metropolis Healthcare on the other side. We'll talk about, of course, the impact of GST. Poly Medicure, of course, has also made an acquisition. So there is that as well. Coming up.
Welcome back. Well, GST on medicines have been cut from 5 to 5% from around 12%. In fact, GST is reduced to 5% for from 12% for diagnostic kits, blood glucose monitors, various devices, bandages as well. We're now joined by Himanshu Baid, the Managing Director at Polymedicare, as well as Ameera Shah, Executive Chairperson at Metropolis. Hi, ladies and gentlemen. Good morning. Thanks a lot for joining in. Well, Mr. Baid, coming across to you first, you've also done an acquisition. We'll talk about that in just a bit. But, duties coming down should spell good times for your business. I think a third of your business comes in from India. So tell us your reading, what kind of a positive impact it could have?
I think, we have three different structures, 5%, 12% and 18%. Everything gets collapsed to 5%. So I think this will spur demand, especially for essential healthcare products, so especially used in, home care, area like thermometers and glucometers and all that. And for hospitals, the cost for medical devices will come down from, let's say, because of reduction in GST. And as they are nil rated, so they don't get any benefit for higher GST rates. So as the GST comes down, I think the cost of treatments for patients will also come down. So it's very, very positive for the industry.
Okay, all right. Got that. We'll try to get some numbers out of you, Himanshu, in just a bit. But Ameera, coming across to you, diagnostic companies, well, they should benefit because of lower capital cost and lower raw material cost as well. Do you believe it's a possibility? You could quantify it, in terms of basis points, the outlook on the whole?
See, this is a landmark reform that the government has done, and frankly, at Nat Health and obviously from all of us, we've been pleading with the government for a long time, saying because we don't charge GST to the consumer, we have all these input costs with no actual offset. So this actually gives an opportunity now to be able to have a lower GST input cost. Because medtech has come down and reagents and chemicals, the GST has come down from 18 to 5. That will certainly expand access for the industry. It will create a fairer competition playing field between the unorganized and the organized. And also, as Himanshu mentioned, the rates were all across the board earlier. I think that will definitely aid in ease of doing business because you have now one GST slab versus multiple. And the biggest one, I think, which is the most beneficial for consumers, is that with insurance, GST coming down from 18 to 5, as well as from, like you said, glucometers and other areas, this actually is a direct benefit to customers, right? It significantly makes it cheaper for them. And I think it'll really expand access to health insurance through this.
Ameera, on diagnostics, will we see price cuts, price reductions for consumers on tests, etc.?
It's difficult to tell because diagnostics has already been obviously a very, very competitive pricing already because of competition. You have to remember that GST was not really applicable to the consumer at all. It's only on the input cost, and that also not everybody in the industry has actually been bearing it. So actually, more than anything else, it will create a little bit more of a fairer platform for people. And hopefully it will create a better sustainable healthcare ecosystem where you can make more investment in the industry.
Ameera, just to understand now, for any diagnostics lab, whether it's surgical equipment, gloves, consumables, I think bandages also. So on a lot of these items, testing kits, and on a lot of these items, the GST gets lowered. But as customers, we don't pay individually for these items. We just pay for the cost of the test. So how will the benefit be passed on to the customer?
Like I said, it's difficult to tell at this point of time. Like I said, there's two different separate, right? On the retail insurance and on the glucometers, there's a direct benefit to the consumer, right? Because the consumer was paying 18%, now it's 5%, there's a direct benefit. In this case, it all depends on whether the hospitals or the buyers of these reagents and chemicals are able to see benefit in their P&Ls and are therefore able to pass on part of it. You have to remember that the organized sector or the ethical organized sector, which was actually paying GST, was making significantly lower margins than obviously the sector that was just not paying GST at all, which was actually majority of the sector. So this actually creates more of now a level playing field versus anything else. So whether or not you're going to land up seeing a big, dip in prices is very difficult to tell at this point.
So if there is no dip in prices across diagnostic chains, then there should be a margin improvement. Either one has to happen.
You're right. Either one has.
Yeah. So should we expect better margins for Metropolis or for the overall industry if there is no cut in pricing for tests?
It really is too difficult to tell at this point because I think the news has just come out. I think everybody will have to go back to their companies and really look at what is going to be the impact for them and what is going to be therefore a potential benefit that could be created for the consumer or whether it's going to be a margin expansion. I think it's, I think the next 15, 20 days, everyone will do their own analysis and make their own courses.
Okay, all right. Let's come back to you, Mr. Baid. Then you have done an acquisition in Europe as well. You've done it at roughly EV upon sales, I think it's around 2 times. What's the plan with regard to this acquired business? It was doing around 10 million euros last year, and I think around 1.5 million euros of EBITDA. How do you see this business scaling up?
See, Nigel, if you remember, we started our cardiology business just few months ago. And to scale up globally, this was the best option for us because this company has all the regulatory approvals needed to sell products in Europe, and also it has a US FDA approval. So this gives us a leverage to enter the European market very quickly with our products. And also we'll be able to, get synergies and cost savings and R&D benefits across both the companies. So this company is also, doing R&D on some cutting edge technology, and some products are going to be launched in future also. So all in all, I think it gives us a huge strength in the cardiology business going forward, and we are looking at it as a strategic asset. And again, there are a lot of synergies in distribution network. We can leverage our network, global network. We can leverage their network, and there are a lot of partnerships coming with this acquisition. So this will help a lot in the long way.
Sorry, what does this, Himanshu, what does this allow you to do, Pendra Care Group?
See, they are in interventional cardiology there. So basically, guiding catheters, diagnostic catheters, using angiography, angioplasty. So these are products we have just recently launched in India. So we get a, full, range of products which is already established in Europe. So we don't have to go through clinical trials. Or if we had to go through, we would have waited 3-4 years for this. But now we have a direct access into the market immediately with these products, and we can help them to reduce costs also. And, help up improving the margins. And also whatever we are developing in India, this will become our let's say, our springboard for the European market.
It's doing margins of around 15% right now. You do higher margins. So do you see in the next 2-3 years, you're trying to bring this acquired unit, at par with what you are doing currently? And from around this 10 million euros, where do you see it headed? What kind of pace of growth?
So we are looking, Nigel, when the synergies kick in, we are looking at margin improvement, maybe 2 to 3 million euros of, let's say synergies coming through margin improvements across both the companies. And then if you look at the growth rate, let's say by 2030, we should look at, a growth rate, number close to around 25 million euros for this company in terms of revenue. So maybe a CAGR of 23 to 25%.
Okay, well, those are good numbers, which I think we'll watch out for. Himanshu and Ameera, thank you both for joining us. Really great to get those insights from the both of you at this point in time. So that's, medical equipment business and, of course, healthcare on the diagnostic side, getting you a sense of what's happening. 200 points, by the way, on the Nifty. We're at about 24,915. I think we should just look at what's happening in the market in terms of stocks, etc. as well. And I think right up, we were talking about Bajaj Finance with Venu earlier. Bajaj Finance is the top financial gainer, 5%, completely consumer-facing. It's up $40 on very large volumes. And Mahindra & Mahindra continues to be the top gainer across the board. It's actually M&M and Bajaj on the NSE, number 1, number 2 volume-led gains. Escorts is not doing badly at all, almost 7% at the number 3 spot. And they've got a bunch of these, FMCG names. Britannia I can spot, Colgate I can spot, and those are the others. Bata is up 6%, Bata India. So 1,230 coming through on Bata. Campus Footwear is up about 5.5%. We'll try and speak with some of these footwear companies on the GST impact as they see it as we go along. PG Electroplast, we just spoke with Blue Star. PG, of course, it had that big issue, and with regards to guidance, etc. They were talking about the huge inventory, industry and PG-specific inventory in the system. They said, well, it'll clear out on the normal rate only by about November, December, late this year. Maybe this helps in clearing out the inventory faster, but they'll, of course, take a hit on some of this inventory because it's priced higher, taxed higher. Godfrey Phillips is up 5% right now. And one name from yesterday, right? NetWeb was limit up yesterday. It's up another 6.5% at this point. So, there is a lot which is going on with regards to this. Actually, the other one is E2E, similar kind of space, 4.5%. E2E was also limit up, circuit up yesterday. So gains are showing up here once again. Surabhi.
As a woman, and like most women who love our shoes, this is great because now if something was priced at say 2007.99 or 2008.99, the companies perhaps will have a lot of incentive to move it to under 2,500 to get the lower GST, which actually, let's bring in Mangalam on this, because look at Metro Brands, look at Bata itself. Campus anyway has been, a lot of its offering is under that price point of 2,500. But the shoes are walking, and so is the rest of the FMCG sector, Mangalam.
Well, the shoes are running right now, and rightly so, because what was earlier 1,000 rupees has now been increased to about 2,500 rupees in terms of a ceiling. And remember the important part, that majority of the organized footwear industry in the country, no matter the prices that we pay for our shoes, etc., is sub 2,500. So in terms of volumes, this number subsumes nearly 95% of the footwear volumes in the country, and a large chunk of volumes coming in for the likes of Bata, Relaxo. In fact, nearly all of Relaxo, or nearly all of Campus, etc., would be under 2,500 itself. So this stands to benefit all of them. The only fly in the ointment would be for the ones who are looking at premiumization, so the kinds of Metro Brands, etc., where the average selling price is a lot higher than 2,500 rupees. They may have to, either take the price down to 2,500 rupees or bear a bit of a dent in terms of higher GST or no change out there. The important part, but from an FMCG standpoint, I heard Prashant speak about two names, Colgate as well as Britannia. Two things are common between them and the GST rate coming down. The first part is that for Colgate, nearly 95% of their portfolio stands to benefit and come at the 5% mark itself, because it's toothpaste, toothbrushes, etc., all of them down from 18-12% to about 5%. So that's a positive. Even for Britannia, we have nearly 85 to 90% of the portfolio, which includes the likes of biscuits, cake, cheese, rusk, etc., down to about 5%. So these are, standout beneficiaries in terms of portfolio weightage or portfolio exposure to the rates which have now come down to 5%. But the second part is both these stocks saw a big gash post their first quarter numbers as well. So there was also headroom for an up move on both these counters. And these are also products which are more sensitive to prices, because, in the Colgate form, the premium products, etc., which have been doing well. So mass consumption, there was a problem. There was a fair amount of competitive intensity. So prices coming down out here or perceived value increasing could boost volumes. And even the case for Britannia as well, 5 rupee biscuits, 10 rupee biscuits or 15 rupee biscuits, all of them are the ones which are most impacted by any slowdown in consumer sentiment and will benefit the most when there is a price benefit that comes by in terms of consumption as well. These are impulsive purchases, so there could be some volume increase or volume growth that we can see for both these counters.
Okay, all right, got that. Mangalam, thanks very much. Let's quickly get back to the auto space as well, because the biggest leaders of the rally are probably some of the auto names like Mahindra and Mahindra. We have Sud back with us. M&M really revved up, Sud.
So big GST reset, and the biggest one of the biggest beneficiaries, the auto sector. In the auto sector also, three segments which are the biggest beneficiaries. First, tractor segment, second, SUV, and third is EV. And that's the reason screen is telling you why M&M is top nifty gainer. Even stocks like Scott's, Kubota, Swaraj engines, which are mainly to tractor segment, are up almost in the range of 8 to 9%. Now, what did GST do? GST Council has approved reduction across the segment. So small cars, motorcycles up to 350cc, auto parts, all these segments come in the slab of 18% versus earlier tax rate of around 28% plus cess. So smaller cars beneficiaries include Maruti, Tata Motors and Hyundai. Auto parts beneficiaries include Bell Rise, Endurance Technology and these companies. Even Tire also comes in the 18% slab, and that benefits companies like Apollo Tires, Seat, Balkrishna Industry and so others. Tractor has come to 5%. And that's the reason M&M is up. And also tires and the other parts which are used in tractor segment, that also will come in the 5% slab. Apart from that, EVs remain in the 5%. Then tanks and other armored vehicles. So of that, Tata Motors, Ashok Leyland and Bharat Forge are the biggest beneficiaries. Then high-end cars move into 40% slab. But it's very important. Now, even after moving into 40% slab, effective tax rate would be lower than the earlier rates. Because earlier, for example, XUV 700 of M&M, 28% was the tax rate, plus 22% was compensation cess. So that's the reason effective tax used to be in the range of 43 to 50%, which now comes down to 40%, and that will benefit companies like M&M and also Maruti, because for Maruti also now almost 30% of total volumes come from SUV segment. Even Maruti is benefiting from small car reduction as well. Now for bikes, so up to 350cc reduction will benefit all the companies. So in this, biggest beneficiary is Eicher Motors, but there is a catch. For Eicher Motors, 11% of total volumes have the capacity of more than 350cc. Now, surprising factor has come because earlier tax rate used to be 28% plus 3% compensation. Now that has increased to 40%. So that is minor negative for Eicher Motors. So overall, it's positive for auto with minor few negatives.
All right, super explanation and great stuff there. Thanks very much, Sud. The sector is excited, and so is Sud with what has been done. So lots of reactions. We spoke with Mahindra, more coming up through the course of the day. We'll slip into a quick commercial break, and we come back once again and focus on the insurance space. PB Fintech's management will be with us. Shriram Finance is another management we will be speaking with on the sweeping GST changes which have been made. Stay tuned, coming up. Welcome back. We're now joined, as promised, by Umesh Revankar, Executive Vice Chairman at Shriram Finance. We also have Yashish Dahiya now joining us, Chairman and Group CEO at PB Fintech. We've been, of course, talking to a range of businesses, range of companies, and asking them what the GST cuts do for their specific business. Mr. Revankar and Yashish, great to have both of you here. Yashish, if I can start with you. We spoke with Niva Bupa earlier, and the understanding is that while this is great for consumers because that 18% goes away, from a insurer's perspective, companies are kind of circumspect because without the ITC, the input tax credit, will this actually lead to a slight increase in cost? And we put out some of these calculations earlier with Yash over the last fortnight or so in terms of feedback from industry. So looks like it's come to pass. I just wanted your thoughts as a as a platform. I'm assuming this does increase volumes for you. You're not in that sense affected by this. Go on.
So we are super enthused by this move. I think it's a great vindication for us, because for the last 17 years, we have been saying protection, which is health and term, are the most critical products for the consumer. And the government acknowledging that, and the government taking the GST away on those products is a very, very strong message. So I think none of us should miss the wood for the trees here. Whether there's a couple of percentage points of input tax credit or whether the price goes slightly below or slightly above, that's all fine. But the great message is that health and term, separated from many other products, are very, very critical for the consumer, and the government is not going to charge any GST on these two products. And thus, the consumer will definitely benefit, but more importantly, the message will get home that, look, these are important products supported by the government. And I think that is the key part here.
Yeah.
One can go through the mathematics of, look, think about it. In health insurance, a consumer can pay on monthly mode basis. And, there is the person can change the moment the transition happens. So I don't think there is any big difference. And yes, if there is some cost, I'm sure that there will be a discussion that the insurance companies will have with the regulator. See, the second point I will try to make is investors and analysts have read through most of this. And if you look today, almost everybody universally, whether it's LIC, whether it's HDFC Life, whether it's ICICI Life, whether it's Niva Bupa, whether it is Star Health, whether it's ICICI Lombard, and whether it is us, everybody's price across the board is up. That means people are seeing something positive. So I think the big message here is very, very positive.
Yeah.
And I don't think one needs to get too embroiled in the
couple of percentage points. And I think you put it well, woods and trees. But I just, with the forest. Yashish, just a quick point. On a practical basis, health policies, for example, again, if I can use your analogy, a few percentage points of the abolishment, will this help in increasing penetrations? I mean, I don't think you're saying that somebody is not taking health insurance because you got to pay 18% GST. So, but
I don't think there is any consumer out there who was not buying health insurance at 10,000 rupees, and just because it is 9,000 rupees will rush to buy health insurance.
Correct.
So I don't think it is about that.
Correct.
I think the bigger part is the message. The message is that this is very important for you. Even the government does not charge GST on it. And this is a very important product for you. And similarly, and even more importantly for term insurance, please appreciate this is the first time that term insurance has been carved out in a way, or something specific has been done for term insurance. Please appreciate it's a very small part of the overall life insurance industry is the pure protection element. And this is the first time that the pure protection element is being called out as term insurance is very important for you. The government, which used to charge 18% GST on term insurance, will not do so from 22nd of September. It's a very, very critical message. And I think that message should not be missed. And I think that message will go a long way in amplifying the importance of both term insurance and health insurance to the consumers.
Sure. No, absolutely, Yashish, take your point. It's a big, big step for policy buyers. It's a huge relief, right? And this is what we were discussing with Niva Bupa, with Ankur, just a while back. That, now that as a policy buyer, since I have the additional cushion, maybe I'll buy a bigger policy, bigger sum assured. Maybe I'll buy a more higher value-added policy. But the question here is that unless there is a tweak and this input tax credit business is resolved, who bears the brunt? Who bears the pricing? Now, one company we spoke to said that we're not going to hike the premiums just now. So will it be borne with the distributor? Could it be, and you're a big sort of player in the entire ecosystem. So could some of it come to you as well? What happens in the interim? There's this 18%.
I think totally missed point, I would say. Really focusing on an irrelevant matter compared to the big matter. I think for us, it's a question we haven't even thought about. And it's perfectly fine if there is a plus or minus that happens on that. The clear message that you can see both from the markets and from us is that this is a super positive move for the messaging. I do not believe, unlike what you just mentioned, I do not believe a customer buys a policy because it is 10% more expensive or 10% less expensive. I don't think that is the reason at all. I think it's the messaging which is very important. that, look, health insurance and term insurance are very critical for you. And I think as long as we focus on that, and if you look at, and that's what I said, right? If you look at the markets are rewarding everybody today.
Absolutely, because the larger point, like I said, and we've discussed that as well, we've highlighted that largely when the price goes down, you will insure more, you will buy more, because that need has been well understood. Coming back to you, Yashish, in just a second, let me also bring in Mr. Revankar into the conversation. So, morning, great to have you on. So the market is also very excited about all the financiers, right, who will be catering to whether it's auto demand, whether it's consumer durable demand. As of now, what do you anticipate? Third quarter, basically September 22nd onwards, when these cuts kick in, what can be the additional boost to the lending for you specifically on the consumer side of your business?
Yeah, thank you. What I believe, I agree with Mr. Yashish's view. It is the sentiment and messaging is more important. I think a positive sentiments and the messaging done will create a demand. That demand is not just because of the pricing point. Pricing point is not important. It is what is essential for you and what it gives you back. So I think the positive environment and higher economic activity will bring in more business. I believe the third quarter is likely to be much bigger compared to even the previous year third quarter, and because the sentiments will be much positive, and I think the environment can reinvent itself to a higher consumption.
So, sir, some indication third quarter. What is the growth in disbursements, overall AUM? What will you expect given this big bonanza?
I do expect, we have been planning for 15% growth year on year. We should be able to grow maybe a higher number at 17-18%. It all depends upon economic activity per se. But I think definitely we will cash on when the sentiments are better.
Mr. Yashish, this is Yash Jain. I want to come to you. You, of course, spoke about, not missing the forest for the trees. Clearly, it is a very big positive for policyholders, but, just not missing the shareholders for policyholders also. And from the shareholder point of view, I want to understand something. The government, of course, is clear that profiteering shouldn't happen after this cut, which means the benefits of that 18% cut when it comes to GST should be passed on to policyholders. Which means our calculation suggests that about 5 to 7% of cost will come to insurers on health insurance, and about 10 to 11% of cost will come on term life insurance. Now, if profiteering can't happen, then cost will, of course, have to be shared between the insurer and the aggregator like yours, because commission is still not exempt, which is paid to you. Can you help us understand this thing, how it will be shared between the two parties if it can't go to the policyholder? And second thing, I just want to understand what happens thereafter, because you said that volumes won't go immediately after this cut, right? Insurance is not a product like that. So is it a double whammy in the sense that volumes don't go up, at the same time some additional cost comes on your books?
Yash, every time I speak to you, I love the focus on commissions. Do you know how much profit we make? We make 1% of premium as our profit. Is that too much? 1% of premium. That is our profit. Right? Is that too much for everything we've done for the last 17 years? And our accumulated company is still in losses. Right? Yes, when we do 1 lakh crores of premium, of course, 1% will also be quite a bit. But it is 1%. That is what we make. Right? So it is not like one is making too much money or anything of that sort of profit. Terms like profiteering, etc. do not. Which insurance company is making crazy profits? And which distributor is making crazy profits? Right?
Yashish,
but sir, the point is it will have to be shared, sir. Sir, it goes back to...
Let me just finish off on that, right? If the benefit is 18% and the cost is 5% or 10%, a benefit is going to the consumer, is it not? Right? Whatever the...
No, correct. The benefit is going to the customer, the policyholder, definitely. And that's what I started with. But what happens to the company also? That's also important for the shareholders.
And you are already seeing the company reaction. There are people who are smarter than both of us who are actually investing. And they are all giving everybody a 3 to 6% increase in share price. So that means there is some benefit that we are missing that is actually going to the insurers and the distributors from this. And that is the benefit of the message. You know, whether you look at Star Health, whether you look at Niva Bupa, everybody's up today. Nobody is down. Neither is
Yashish, you surely are not. I know that you're not the one to look at stock prices and make determination.
No, but
today you're doing that.
It is an indicator of what the investors are thinking.
Yeah, I completely agree.
And Yash's point, reaction is. So I think we are very stuck on one point. Input tax credit,
It is. We began by saying this is absolutely great news. When I renew my policies, I will pay less. I'm delighted. And I think, most people.
Tell me one thing: would you buy a policy or not buy a policy because it is 5% cheaper or 5% more expensive?
I told you. I said it. You're repeating my words. I said no. I mean, that is not the point. This is a limited point which Yash was making, that for insurers, is there a cost to be absorbed? That's all.
Yeah, I think for media it is important not to focus on limited points and focus on larger points.
Okay, Yashish, I'll still continue with my point.
We can focus on how will reinsurance cost change, how will we can go into all these details.
No, correct. So it's well understood by the industry, Yashish. Though it's big positive for policyholder, there is some cost to be absorbed by insurers, and maybe some of it will come down to aggregators.
And that benefit will come from the higher volume. I think what Umesh said was very relevant. I think we will all have a great Q3.
Yes. Just Yashish, just one number very quickly. How much does health contribute to your value and revenue, and how much does term life contribute?
About 60% of our value is health insurance, and about 25% is term insurance. So these two products are 85% of what we do in terms of value. Also, 85% of our media spend is on these two products alone, health and term. So health and term, please appreciate, we have been in various government meetings for the last 15 years, always requesting that health and term have a separate carve-out. And we are really pleased that it has finally happened. It was like a baby who was making a noise. Nobody was it's finally been heard, which is very, very good.
I think also, if I could weigh in on the debate that you three gentlemen have been having, and I mean, as someone who tracks personal finance and has only the policy buyer's interests in mind, and we've seen this, happen day in and day out, that when that premium is, say, no longer 15,000 rupees and it comes down by 18%, the industry has a way of adding more goodies for the same price tag.
Absolutely.
So we've seen product innovation, we've seen reassure plans, we've seen plans which give you no capping on room rates. There is so much product innovation going on, and that someone which has gotten attuned to paying 15,000 maybe will still pay 15,000 for a better policy. And maybe that's what the market is also picking up on, and we'll see how that plays up. But Mr. Revankar, he's been very patiently listening into this spirited debate. Sir, just coming to you specifically, because this is such a big change and it's going to be an ongoing change. Revise our memory when you talk about, say, consumer-facing finance, actual consumer finance for you. What percentage of your book would that be, and will the mix change in any way? When you talk about retail level auto, or even if because even on buses, etc., GST has gone down on everything. So, will your lending mix over the next 2-3 quarters change in any way?
Yeah, there is likely to be some change in the lending mix. Maybe there will be more new vehicles will be financing, because some of these segments, some of them who are not really upgrading their vehicle, they may come forward. So I have seen in certain part of the country, many people are postponing the upgrading of their vehicle, either buying new vehicle or newer vehicle. So that momentum will come, and that should really create a better credit demand. I see there will be a lot of change in the way people do business going forward, and better compliance itself will bring more business, because many more industries will not be happy to play safe with the compliance, and that will create. I think the MSME segment especially will get a very big boost, because there will be a lot of consumer item that has come into lower slab, and the consumption will increase, more compliance, more movement of goods. So I feel it is an extremely positive move to bring down the slab, make everyone comply, and grow the demand. I think sentiments will be very, very positive.
All right. Absolutely. One hopes that overall there is lots of savings and, this better affordability across the board, across sectors. And it shows up in different ways, as we've been saying. Boosts consumption, which I think is the need of the hour. Yashish, thank you very much. Always spirited. Always great speaking with you. Umesh, thank you very much as well. We'll take a quick commercial break here. We're going to come back on the other side and we'll get into some of the tax aspects, right? We want to clear some stuff. So MS Money of Deloitte India will be with us. Saurabh Agarwal of EY India will be with us as well. Stay tuned.
Welcome back. Well, let's get into the taxation nitty-gritties now. We've got MS Money, partner GST at Deloitte, and Saurabh Agrawal, tax partner at EY. Gentlemen, thank you so much for joining in. Mr. Money, it's a landmark day, right? And we've been tracking and tracing the history and the evolution of the GST framework with you for so many years now. I want to straight away get to the biggest debate, and if you could hear the previous speakers, I think you'll already know that. The question is, what happens to goods or services that have been moved to either the 5% category or the exempt category, and they don't have the benefit of input tax credit? Insurance is obviously one such big space, but how should we look at it, and how should we interpret this, Mr. Money?
Okay, so let me first speak on insurance, because insurance is very different from all the other products and services which have been moved. As far as insurance is concerned, what we need to understand is that the overall input tax credits for an organization are across all policies, and there are only few expenses which may be in respect of specific policies. So here what has been exempted are typically health cover and term cover. Now, health cover and term cover may have a few expenses which are directly attributable to it, on which obviously there is no question of an input tax credit. But there would be a large amount of other expenses which would be common for the entire organization. And the debate is in respect of the proportion of those common expenses that pertain to the health policies and the term covers. When we do that calculation and when we do that math, and it may not be identical for each insurance company, the proportion of their health policies and the proportion of their term cover policies sold may be different. It may be different in respect of health cover sold by general insurance companies and health cover sold by life insurance companies.
When they do that math, and I think it is a little too early for them to do the math because this has happened only last night, they will come across a proportion of credits that they may not be entitled to in respect of the common credits. Now, bear in mind, till now, we are not aware of anything in the 80-page press release that was issued yesterday, which says that there needs to be a reversal mechanism for the common credit, but that is expected in any case, to be there. Now, the proportion of credits that they need to reverse, once we have that number, is when this debate can actually have some numbers attributed to it. Is it going to be 2%? Is it going to be 5%? Is it going to be 8%? That number will need to be worked out. And as I said before, it will not be a uniform number. It will vary across the company depending on their product portfolio. But the larger issue is now all the insurance companies will now need to rework their products and go back to IRDA to get an approval of new products, because some of the old products cannot be sold after 22nd of September. So when they do that pricing, as was mentioned by one of the speakers in your earlier session, when they go back to IRDA, it's quite possible that the insurance companies bundle more services or more features in the existing products at the same price. And there may be some products where they pass on a larger part of the reduction to the customers.
Right? But net, to try and keep it simple, Mr. Money, in the current form, let's talk about a standalone health insurer. In the current form, because for a standalone health insurer, all the policies now go into exempt category. So will there be a hit or not? Because as of now, there is no input tax credit. There would be some cost that insurer would have borne to provide that service, on that premium. So will, say, a standalone health insurer in this case be entitled to anything, or what happens to the cost? Or will it just have to be either borne by the insurer or the distributor or eventually passed on?
You're bang on. So for a standalone health insurer, there will be a cost attributed to the exemption. There will be a cost attributed to the exemption. But when that cost is attributed to the exemption, the view is that, one, they might tweak the products and add some more features to the product. The second aspect which we have to bear in mind is, if a person is buying a policy which is costing, which has a premium of 1 lakh, and that product cost today to the customer is 1,18,000, because in real sense, the customer does not care 18,000 is GST or 10,000 is GST. The customer says, I'm paying 1,18,000 premium.
Yeah.
Now, this customer, if he even reduces the premium, and if the premium, let's say, comes down to 1,05,000, what's going to happen to the 13,000? Two things could happen. One, the product becomes richer by adding more features, coverage, something.
Yeah.
So it remains at 1,05,000, but for the customer, the remaining 13,000 goes into buying something else, maybe consumer durables, which have also come down.
Yeah.
So that is where the whole focus of this stage of GST reform has happened, because the intention clearly is to incentivize consumption. That seems to be the whole focus.
Absolutely. Okay, let's quickly move on and talk about the overall implications as well. Saurabh Agrawal is also with us. Saurabh, what's your sense? And also just throw light on the fact that for tobacco products and cigarettes, it continues to be tax neutral, right? And to that extent, I think for some time, the compensation cess needs to continue. So once again, I mean, what is the fine print, and would you expect any changes at all when it comes to taxation on cigarettes? Because this national contingency, calamity duty, etc., a couple of other things were also contributing to, say, the cost of one cigarette. So what happens there?
So, before I answer your question in specific, 5 words which I'll use: monumental step, commendable, unanimous, clear intent, proactive approach, with 2 themes which are overall overarching. First is trust, which is between the state and the center. Second, trust between the industry and the government by not coming up with anti-profiting provision. And the other theme is the India consumption story, which continues, which will ensure that whatever was the impact on account of global tensions on our GDP will get mitigated to a large extent. Now, coming to your second question around the tobacco and tobacco-based products, as of now, the fine print says that for them, the tax rates continue as they were till the time the final compensation on interest and loss with the state exchequers is settled. With respect to the clarity whether the compensation cess will continue or not, as on date, in the fine print, there's no such clarity available.
Okay, all right, got that point. Gentlemen, also just quick thoughts on overall the revenue foregone. I think is to the tune of almost 96,000 crore rupees. You can share the exact number. Do you think largely this will be made up by more buoyancy, more consumption of goods and services, or to what extent will this be a loss that simply has to be borne? What do you make of the revenue neutrality aspect? Because right now it's not revenue neutral. Quick point, Mr. Mani.
So the way I look at it, I'm very, very bullish in terms of, I would say much more than the revenue loss being made up. And whatever be the number, and I'm basing this on 2 points. The first point is the earlier time when we had such large rate cuts was in 2019, where a lot of products came down from 28 to 18, and that was, massive at that point of time. Now, if you look at the empirical data, you will see that prior to the cut, GST collections were averaging those times around 70,000 to 80,000 crores per month. And now we have GST collections which average between 1,80,000 and 2 lakh crores, per month. So I think the data indicates, the empirical evidence very clearly indicates that when you reduce rates, the consumption certainly goes up. And the consumption which goes up may not be in respect of the same product category. There may be some premiumization which happens. People could move to other product categories. Because of the income tax related changes a year back, people in any case have more disposable income. And when they have more disposable income and when the economy is growing, there will be an inherent tendency to have more consumption. And what this has done is to fire up that intent like anything. And that is the reason why I would say that GST to me today stands for a genuinely simple tax with a great sense of timing.
Would you concur, sort of very quickly? Mr. Mani is saying that the buoyancy, and he gave a great example as well, how the tax collection numbers have moved, that the buoyancy in the economy, consumption, will more than make up for the revenue that the states and center are currently losing.
I completely agree with Mani. If you see the tax base has doubled in last 8 years, it has moved from 60,000 registrations to around 1.5 lakh registration. I'm sure with the tax rates coming down, the number of registrations will further increase and it will lead to increase in taxable base. Further on the tax buoyancy also, if you look at it, has increased from 0.6 to 1 effectively. And if you see in the months of April and May 2025, we went in for the record collections of 2.36 lakh crores and 2.1 lakh crores overall, while the government might be estimating some bit of dip in terms of around 48,000 crores as a net dip on collections. But I foresee that with increase in taxable base, we should be able to meet even that dip.
Okay, all right. So tax buoyancy perhaps will bounce back, will come back as the consumption patterns really get a boost. Thank you very much, gentlemen. Good to have that perspective from you. Well, with that exhaustive session, we are winding down on this edition of Bazaar and leaving the market about 130 points up on the Nifty. Don't go anywhere. Continued coverage of the mega GST reforms continues right after this break.
You're watching us here on Chartbusters on CNBC TV 18, a day of big, bold reforms, GST 2.0, the market's showing that, and it's evident in a couple of sectors, in particular, consumption and auto. So let's speak about the consumption space itself. With me, Nigel, we are talking about Bikaji Foods. The management of the company joins in now as the GST rates have been curtailed for namkeen mixtures and bhujia snacks all the way from 12% to 5%. Manoj Verma, who's the CEO at Bikaji, joins in to discuss the impact. Manoj, congratulations, and I guess more snacking to you and all of your customers. The important question right now, what proportion of your overall portfolio now stands at 5%? And what do you expect as incremental growth, volume growth, because these rates have come down from 12% to 5%?
Good morning, and thank you for inviting on the channel. For us, if we look at this, about 78% of our business was under 12% GST regime, which now will come down to 5%. Other than this, sweets were already at 5% and papad were no GST. So now if you look at, say, about 94% of our business would be on
All right, we've snapped that connection, but as of now, what we understand is earlier 78% of your overall portfolio was 12%. The remainder was about 5%, which was sweets and papad, and now we have 94% of your overall portfolio, which now stands at 5%, and the remainder, which is papad, etc., would be around 0% itself. So a large proportion, nearly your entire portfolio, is from 12% comes down to about 5%. The other part of the portfolio having no taxes, and that the street is liking that because we have seen a big up move in the stock price itself. Bikaji up around 4-5% as we speak right now. The street believes that this could boost consumption. Currently, now the rate has settled to about 1.8%. But remember, a large part of the street were expecting this, which is why over the last month or so, the stock has seen a rally of about 7.5 to 8%. We do have Manoj Verma. We're trying to connect with him once again, but it's not just Bikaji, Nigel. I'm looking at all the other FMCG companies as well. Most notable ones are the likes of Colgate and Britannia. Why is that? Because nearly 85 to 90% of their overall portfolio as well now comes down to about 5%. And these are impulsive categories. You're walking down the road, you feel like having a biscuit, you feel like having a bhujia, you feel like having any of these products. You go ahead and buy it. It becomes a lot more cheaper. And more importantly, it will increase their volumes as well. Why do I say that? Because a large part of their sales come in from price points. So it's 5 rupees, 10 rupees, 15 rupees. And these price points, the companies hold very dear to their hearts. So they are not going to, reduce the price from 4 rupees to 4.5 rupees or 5 rupees to 4.5 rupees, etc. They'll just give you a little more at that price. So if you're getting a little more at that price, which means simply volume growth coming in for all these FMCG companies. So that's a positive. And for something like a Colgate, where the lower end of the consumption was being impacted by down trading and, problems in the mass consumption spaces, their reduction of 5%, a reduction to 5% would help. But we have Manoj back with us. Manoj, you were saying that 94% of your portfolio now stands at 5%. The question is, how much incremental volumes can you see because of this reduction from 12% to 5%?
So in our overall portfolio, if you look at about 40% is on 5 and 10 rupee price point. And that's where you cannot pass, in terms of, say, price reduction that you make it 9 rupee 50 paisa or 9 rupees. So that's where the volume is going to get increased, and which is what has been done during the times of inflation, that instead of increasing the price, the grammage had gone down. So what we feel is around 3 to 5% would be the volume increase on account of the GST benefit.
All right. And what about this? This comes in from September 22nd. What about, you managing your existing supply chains, your channels, etc., up until September 22nd? Because I'm sure a lot of your dealers, etc., would say that, why should we buy now when we can buy it at 5% GST? So how will you account for that change? And could there be any near-term disruption because of that?
So we operate on very minimum inventory holding at our company level. That's what it is. So we keep it about 2 days kind of a stuff. So business will not get disrupted in terms of offtake, but certainly in terms of stocking, which is what normally happens during the season time, would get impacted to the time there's more clarity on that what will happen on the stocks which are on a higher GST already built.
All right. And what about, the margins? This time around, obviously, everyone is saying that these prices will be passed on, etc. But at the same time, the anti-profiteering clause has also been taken out. Do you think some people would be tempted to perhaps keep a little bit of an extra margin cushion, or that is not happening?
I think we welcome, I mean, as an industry, as a category, we welcome this GST reduction and would definitely pass this benefit to the consumer and would help category grow. Also, in this competitive environment, this will not be so easy for any individual, any player in the competitive space to hold that, just keep all. Of course, if not 100%, but most of it will go to the consumer. That's what we feel.
Okay, all right. Hi, Manoj. Good to see you. And clearly, this has come, as a big boost for the industry and for your company as well. So, give and take everything for the second half of the year and for the year on the whole. What kind of a revenue growth can you look at? You are already indicating that you want to improve margins by, I think, 40, 50 basis points per year. Are you stick to that?
Yeah, we'll stick to that. And I think this will make things easy. And I mean, we may exceed that stuff if possible.
All right, you may exceed the margins. And overall volumes this year, you said low teens volume growth every year with 2 to 4% price growth. First quarter, you did about 14% revenue growth, underlying volume growth of about 7.5%. With this GST benefit coming in, incremental 3 to 5% volumes, what are you targeting for the overall year when it comes to volumes and overall prices?
So if you look at in terms of sweets business, which is huge in, say, quarter three, even during the festive time, that's not impacted with this GST change because in the erstwhile regime as well, it was 5% and it continues to be on 5%. However, on our snacktionary business, which would reap this benefit in the latter half or 6 months of the year. So now considering that 3 to 5, so we may think of say, something between 1.5 to 2% volume increase on this account.
So double-digit volume growth should happen this year. Thanks a lot, Manoj, for joining in. And how, by the way, is consumer sentiment? Are you seeing some sort of improvement?
I think, being this time a very holistic tax reduction stuff, it's not only one category has impacted. So be it service industry, be it personal care, overall. So discretionary and non-discretionary. So we being a discretionary category, we feel that we definitely will reap benefit and overall consumer sentiments are also pretty good, very strong sentiments.
So sentiment is good, but with or without GST, have you seen any improvement? Because earlier...
Yeah. So which is what we spoke the last time as well. That
exactly.
From the beginning of this year, so quarter one onwards, there's an uptick in the momentum. And I think that this will further boost it up.
And raw material inflation, not a problem anymore. We've seen some decline from the highs for palm oil prices as well.
So not so far. I mean, palm oil prices are stable at the same, but that's new normal. That's how we look at it.
All right, take that point, Manoj. Thank you so much for joining in and giving us your views. Double-digit volume growth not out of reach. Incremental volumes from this cut could be 3 to 5% on an annualized basis, but because we have just one half of the year, it'll be 1.5 to 2% on their namkeen portfolio. So 94% of their portfolio now stands at 5% GST. The remainder is GST nil, which is why the stock higher. What we'll do is take a short break. On the other side, we have an exclusive conversation lined up with Rajiv Bajaj, who's the managing director of Bajaj Auto, in conversation with Parikshit Luthra.
Welcome back. We are joined by Rajiv Bajaj, Managing Director of Bajaj Auto. Mr. Bajaj, thank you very much for joining us. A big GST relief, so to say, for the commuter segment. Do you believe this is going to give a festive boost to the auto sector now that there is clarity that all these changes will come into effect on the 22nd?
Yes, absolutely, Parikshit. In a word, definitely. This has been long in coming, I would say, and it's a fabulous change and it's great timing. So it's wonderful.
Right. Does this also help in creating demand for two-wheelers on a sustained basis?
I think so personally, and I think that's really the more important part because season is anyway peak time, and most of us are anyway up to capacity at this time. So what's really important is what happens after that from November onwards. November, December are usually the weakest months of the year, but that will not be the case this time. And I think, more importantly, the two-wheeler industry that never really recovered post-COVID, I think finally will now head to a new high.
So new high for the two-wheelers segment. Are you now going to be ramping up your production in anticipation of a strong festive season?
Well, production is already planned to be ramped up this month, Parikshit, obviously to stock up for the season because the season starts towards the end of the month. And in October, due to the vacations, we all have fewer working days. So this will be the biggest month of the year, I'm sure, for everyone of this financial year. And so also for Bajaj Auto.
Right. Does this also help three-wheelers and commercial vehicle sales? Are you looking at a strong uptick?
Yes, absolutely. It will equally help three-wheelers. And obviously, that's really important to us because we are now just in the domestic market, clocking in excess of 40,000 three-wheelers every month. ICE and EV included, with about 80% share. So that is very meaningful to us.
Right. Downside for the segment above 350cc?
Yes, I think this is what you and I discussed last week as well. And therefore, if I have to summarize what's happened for the two-wheeler industry, say it's a tactical hit. This GST reduction is a tactical hit. But it's a strategic miss. It's a tactical hit because, obviously a big fillip for, let's say, almost 98% of the domestic industry with this significant reduction in GST. But at the same time, the 350cc plus motorcycles, where Royal Enfield and Bajaj are the biggest players, this is on the one hand just 1% of industry, perhaps about 4% by value. For Bajaj, I can tell you this is about 3% by volume and about 7% by value. It would perhaps be a little more for Royal Enfield because they are the leader in this market. So, both Siddharth and I had appealed to those concerned, that this is just 2% of the industry and let's have a uniform rate. From a strategic point of view, because although it may sound like 2%, but in terms of volume, it is getting closer to 200,000 motorcycles per year. Now, that is not small when you consider that the global volume for such products is well under 1 million. So here you have two Indian OEMs with a very significant global footprint. In our case, almost half of what we make is exported. If this rate had been applied uniformly, it would have further helped us to scale up in this 350cc plus segment, which is, I think, very important for the future because it's great for your brand image, it's great for the bottom line. With the scale that we would have got here, or more specifically, our supply chain partners would have got here, we would have been, in a very cost competitive position to take our brand and our products overseas There, I can tell you in recent times, the Chinese are making very, very significant inroads at the expense of American and European brands, the same as what's happening in cars. So, in that sense, I would say this is a strategic miss because I anticipate that in a few months' time, we will realign most, if not all, of our portfolio to under 350cc, which means this segment will be practically dead. The 350cc plus segment, will be practically insignificant in India, and I don't think that is good for the long term because OEMs will find it very difficult to develop products solely for export markets. When the domestic market doesn't support it. So I think that's unfortunate. And frankly, nobody wins. Everybody loses here. The consumer loses, the manufacturer loses, and certainly the government loses when there is no volume to be multiplied by that 40% figure.
Right. So does this mean that, as you said, your portfolio will now get aligned to bikes equal to or less than 350cc? Are we going to see more future launches under 350cc now?
I think it's inevitable because I think let's look at it like this. The single cylinder motorcycles that are over 350cc are typically up to 450cc. I think most, if not all, will get realigned over the next few months to under 350cc by appropriate engine development. Twin cylinder motorcycles or multi-cylinder motorcycles that are bigger than that obviously will remain in the higher space, but those volumes are tiny, minuscule. And therefore, yes, I think even new developments will be largely restricted to under 350cc.
Right. Overall, Mr. Bajaj, how do you think this will lead to an uptick for two-wheeler sales overall? I'm speaking about Bajaj Auto, and then please tell us about the industry as well.
I think both for Bajaj and industry, this will have an enormously salutary effect. It is bound to. It's anybody's guess what that number would be. So quantitatively, I won't be able to put a number on it, but I would certainly say qualitatively that this will really lift sentiments. That's the single most important ingredient when it comes to purchasing decisions for such high value durables or goods. And definitely, I would expect the industry to go well past its pre-COVID highs. So all in all, as I said, a tactical hit, but unfortunately, I think also a strategic miss.
Right. My final question to you would be, overall, how do you see this GST rate ration exercise boosting sentiments in the economy?
I think it's excellent. All the feedback is outstanding from across peers, from across sectors, across industry. And in my discussions with some of the people in Delhi, I'm also encouraged to hear that, this is not the end. In a few years' time, we can expect further rationalization. And perhaps one day, India will head to that golden single number GST, which would be wonderful because, as I've been saying to you, that in the major global two-wheeler markets of the world, the equivalent of GST is still between 8 and 14%, a average of, let's say, 12%. So there is certainly, in my view, some distance to go before we put the Indian consumer on par with his global counterparts.
All right. Mr. Bajaj, thank you very much for joining us with your view on the GST rate rationed exercise and how it's going to give a boost. Your statement that we could see the two-wheeler industry going past the pre-COVID highs as well. So that's a very important message. Let's see how the festive season goes now. Thanks once again for being with us.
Thank you, Parikshit.
And with that, it's back to our anchors in the studios.
Welcome back. Well, markets are holding on to gains, 130 points thereabouts. The only problem is the breadth of the market isn't as encouraging because now you have it almost even Stevens. Both those two lines are almost coming very, very close to each other. I think we should get that up for our viewers on the screen. And Manglam was just pointing out that Gillette is another stock where there is some rationalization out there. We have to shave any which ways, but when it gets cheaper, it's obviously good news. So Gillette's a stock that's up close to around 5%. Well, we'll wrap up on this edition of Chartbusters. Stay with us. The team of Trading Hour is up next.
Hello and welcome to Trading Hour live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Hormis Fatakia and Reema Tendulkar. Hey guys, good morning. We've been discussing that big GST impact, the reform that has come by as well. Markets initially were very excited, but now there has been a fall from the highs of the day as well. In fact, the mid-caps, they've turned in the red. It's a 600-point fall for the mid-cap index for the highs as well. And the Nifty as well, up 116 points. But you know, the high of the day was around 24,980 today, very close to that 25,000 mark, but we are now at 24,820, so almost a 150-point downtick from the highs of the day. We have the Nifty Auto Index, which is doing really well, but do remember, in anticipation of these GST cuts, that index was in focus and that continued to do well. Today, it is up around 2%, but it has fallen from the opening highs as well. A lot of moving parts in the broader markets that we'll continue to discuss on the show today, but yes, that continues to be the big story, and we've been discussing the possible impact for a while now.
Indeed, this is not just tweaks, right, or GST rationalization. It's a complete overhaul.
Yeah.
And bulls were, as you rightly pointed out, very fired up as we began trade, almost inching towards the 25,000 mark. But some of that exuberance has now faded. M&M is still the top gainer, and that's pretty much holding on to its higher levels. But many other stocks have come off from the highs. But the two big themes are auto and FMCG. And on the way down, money is being rotated out of IT. So the Nifty IT index is down close to about 0.5%. In fact, staying with the big story, CNBC TV 18's Timsi Jaipuria is currently in conversation with CBIC Chairman Sanjay Kumar Agarwal.
All right, we are live with Chairman CBIC Sanjay Kumar Agarwal, the key man who heads the board on indirect taxes, setting the tone on GST reforms that we heard from the Finance Minister after giving the approval of the GST Council. A very warm welcome to our show, sir. So when we talk about the two key rates, they will now soon be a reality from 22nd of September. A key question that comes in from the industry is what happens to the existing stock? How will they exhaust the ITC and the backlog on these existing stocks?
Yeah, Timsi, these new rates will be effective from 22nd of September, except for few commodities like pan masala, tobaccos and cigarettes. As far as existing stocks are concerned, the rate applicable will be on the date of supply. So these are the provisions under the GST law. So if something is, say, supplied after 22nd or from 22nd September onwards, the new rates will apply.
So when we talk about the key rates, 5%, 18% and 40%, what was the rationale to come down to these three rates only, with two, the main rates, and 40% only for the limited items?
The basic idea was that this time we have to carry out a comprehensive exercise because GST is already 8 years old, and therefore there was need for redoing the rates and bringing down the number of rates, because number of rates, if we have multiple number of rates, then that leads to the classification disputes. And if the similar type of goods are classifiable maybe under two different headings, which may be attracting two different rates, that leads to the classification disputes. And there are unforeseen demands which have been raised, and especially we have analyzed the food sector and automobile sector. We found that in large number of cases on food items there were classification disputes, and that was leading to unnecessary demands on the sector, as well as on the automobile side also. Auto components used to attract 18% or 28%, and these disputes were ongoing, and therefore it was decided to bring uniformity in the rate. And on all food items now the rate is 5%, whereas on all auto components the rate is now 18%. This will lead to giving certainty and predictability to the industry, and there will not be any unforeseen demands. While determining that what should be the rates, so 18% rate is the main standard rate, and it was decided to do away with 12% rate and move the items under 12% to either to 5% or to 18%. So majority of the items were placed, which were placed in 12%, were already in the nature of merit goods. So most of the items have moved to 5% and few items have moved to 18%. Similarly, there were items under 28% bracket, which were there in that because at the time of fixing these rates in 2017, revenue neutrality was the concept in mind. So the goods, the excise duty and the VAT, which the goods were attracting, that was the determining factor for the levy or fixing the rate on the goods. But goods actually should be, according to the nature of goods, should be maybe under some other rate. So this time this exercise has been carried out, and items which were falling under 28 have been brought down to 18%, which is the standard rate, barring few items which are in the nature of sin goods or ultra luxury goods.
So when we talk about services, a key change that was discussed in the council, what we heard was for e-commerce operators on local deliveries, including food delivery. Over there, we saw in the past a lot of cases were coming up where e-commerce operator was demanded to pay 18% GST, whereas e-commerce operator was saying that the delivery is being carried out by the delivery operator, there's a delivery partner, and if he is under the threshold, then he may not pay GST. What is the clarity that the council discussed on this?
Now it has been decided that the delivery services which are provided through ECO operators would be notified under section 9(5). And once it is notified under 9(5), the liability gets shifted to the ECO operator, and but this will require an amendment in the law. So it will take some time, but now there is certainty that local delivery services will attract the rate of 18%, which is the standard rate.
And this is without ITC?
No, it will be with the ITC.
And when we talk about the levy being shifted from delivery partner to the e-commerce operators, it includes food delivery, any local grocery delivery, everything?
It includes all types of local deliveries which are provided through ECO operator.
So when we talk about medicines, a lot of key medicines have been shifted to 5%, and in some cases, rare diseases and life-saving drugs, cancer drugs, they've come down to exempt. But APIs, the key raw material, is still at 18%. That is causing a lot of inversion for the pharma sector. What could be the way out for this inversion?
Actually, it is not possible to correct the inversion in all types of cases, because there are items which are maybe the goods of chemical industry, and when they are consumed in pharma industry, then the inversion may happen. So, but just because inversion is happening, we should not keep the rates high. Medicines deserve to be placed in 5% rate. Accordingly, medicines have been placed at 5% rate. And because of inversion, if there is any accumulation of credit, ITC, so that can be refunded. And in that case also, in the process reform, the government, GST Council has recommended amendment in the law so that 90% amount, claimed amount, can be provisionally sanctioned within 7 days on the basis of identification and risk evaluation by the system. So that will lead to the faster refunds in case of inverted duty structure. Since it requires amendment in law, and which may take some time, the Honorable Finance Minister has instructed CBIC to issue the instructions to the field formations that pending amendment, the refunds in these cases also may be disposed of in the same line as in case of zero-rated supplies refunds.
So when we talk about textile, a similar matter, polypropylene is at 18%, but the yarn which is made, that is the polyester yarn, which is consumed by almost all sectors, be it apparel, be it the Meditex, etc., again they are having this issue. They will also get clarified under this process of inversion?
In case of textiles, actually the inversion was occurring at the level, at the stage of fabrics. Fabrics attract 5% rate of duty, whereas the fiber and filaments were attracting higher rate of duty. So because of that inversion, the refunds have to be inverted duty refunds were to be claimed by the weavers, and they are mostly in MSME sector. So, and we have analyzed the data that almost 44,000 claims were getting filed because of inverted duty structure. But now inversion stage has been moved back, and it is happening when the products of petrochemical industry are entering into the textile segment. So inversion is happening at that stage, and in that stage there are few number of industries. I think 400 industries are there. So, and they are in organized sector. It is easier for them to claim the inverted duty refund. And as I mentioned now, that in process reform, we are bringing a provision in the Act itself to provide 90% refund amount on provisional basis. In case of taxpayers, where we have done the due diligence, and it can be given on provisional basis.
So when we talk about these rates, it definitely brings a cheer to the common man, to the industry, with reduced rates. As you said, all food items at 5% and standard items at 18%. A key concern from the consumer point of view is how will these rates be trickled down? For example, a biscuit was attracting 18%, it is now at 5%. The gap of 13% in a 10 rupee pack might not mean more than just 50 paisa decline in the MRP. And that becomes a pricing issue for the manufacturer as well, because either he changes the price or he increases the grammage of the product that is being sold. In that case, it becomes a little sort of a difficulty for the industry to either change the pricing or to increase a very limited, say 1 or 2 grams more. Do you think how will the consumer get the actual benefit? Also, is there we don't have any anti-profiteering clause anymore that has had a sunset. How will you ensure that the customers, the consumers' rights are protected and also a clear window is given to the industry to pass on this benefit?
Our experience is that in most of the cases, industry pass on the benefit whenever there is a rate cut. And this rate cut exercise earlier has been carried out in 2017, 18 and 19 also. And at that time also, and in those periods, there were anti-profiteering provisions under GST law. But our experience shows that there were not too many number of cases which were filed under that particular law. And the amount involved was something like 3,000 or 4,000 crores. So that was not a significant amount. So this shows that in most of the cases, industry, they pass on the benefit to the end consumers. And in many industry segments, they have already mentioned that in case there is a rate cut, they will pass on the benefit to the end consumers.
Okay, all right. That's the word coming in from the CBIC chairman. A lot of clarification, especially when it comes to inverted duty structure where input tax credit may or may not be allowed in certain sectors. But let's get this conversation going and get in Nilesh Shah, founder Envision Capital, to talk about what's happening in the markets and the reaction that we are seeing to these massive GST cuts and regime change as well. Nilesh, good morning. Thank you so much for joining in. You know, markets have come off the highs, but of course, that's a one-day phenomenon that we are talking about. What's your take? What would this do? The GST cut that has come about, is this enough for a rally to continue going forward? What happens to macros overall? Your first take.
Well, this surely provides tailwinds both to the economy and to the markets. Obviously, yes, this has been expected from probably the last fortnight or so, since 15th August, ever since the Prime Minister has announced it, and the markets have held up relatively quite well since then. And I think this is clearly going to be a big booster dose for both the economy as well as the markets going forward.
Nilesh, hi, morning. So, you know, we've been talking about, there's so many beneficiaries, right? Whether it's in the auto space, in the consumption space, you've got a diagnostic company. I mean, there are lots of them. Give me your top 3 beneficiaries based on this, stocks which you are comfortable buying at this juncture.
I think it's still going to be the broad basket of staples, consumer staples, and both consumer and consumer discretionary, both are the biggest beneficiaries. I clearly believe that from all of this, it's going to be more of the consumer appliances space, which will be the biggest beneficiary, because there it does matter. I mean, a 50,000 air conditioner versus a 5 or 10 rupee biscuit pack. I think there's a very big difference in terms of the impact. So clearly, it's going to be the consumer appliances companies which are going to benefit. In addition to these cuts in the GST rates, which reduces the price points, but it also essentially, we have to keep in mind that the budget had increased the exemption limits in terms of the income tax for the middle class. So clearly a lot of that additional saving is going to get into consumer appliances. So it's going to be clearly consumer appliances which are going to be the biggest beneficiary of this GST cut.
Consumer appliances. Nilesh, thank you for waiting by. You know, what about the indirect beneficiaries of this? We've all spoken about consumption and automobiles and so on and so forth. But what about the indirect beneficiaries, the NBFCs, the Bajaj Finances and the Shriram Finances, the CV financiers of the likes? Does that give them an indirect benefit as well? Because for these essential items, or for items like televisions, or for tractors, or for automobiles, you would go to a Bajaj Finance or a Shriram Finance other than availing conventional banking service. Does that give them a boost as well? And or do you see this limited because of the fact that they are already priced to perfection, so there will be limited upside for such names?
I clearly believe that valuations essentially follow growth, and clearly these kind of measures, policy changes, policy reforms essentially drive growth. So clearly the non-bank lenders, especially the specialized finances, they benefit quite significantly. Their growth gets lifted up. There's been some challenge in terms of both credit quality as well as credit growth. Hopefully, the worst is behind us in terms of credit quality. And what was required essentially was credit growth. Clearly believe these measures will lift growth rates for the non-bank lenders. In addition to that, the retail chains become very big beneficiaries because it's essentially going to help them kind of clear out a lot of inventory. It's going to basically draw in a lot of footfalls. So some of the retail chains which are specializing in selling consumer appliances will also benefit. And lastly, in terms of the tax benefits which got announced in the budget, you're going to see the home finances also benefit. That sector has been under some pressure in the recent times, but they too will end up being disproportionate beneficiaries of a combination of all of these policy measures.
Okay. Nilesh, I wanted your take on the insurance space because there was this big call for, making it exempt from GST, health and life insurance, and that has happened. But still, there's not that much cheer. What is your take generally? Do you think that cut would be passed on, or the inverted duty structure would actually mean higher prices or higher premiums for consumers?
I'm not sure whether it will eventually lead to higher premiums. All the way I look at it is that the consumers were willing to shell out an X amount of rupees. That included both basically the premium amount and the GST amount. With the GST being removed, it's quite likely that the entire spending, that entire X rupees of spending, will entirely go towards payment of premium, and therefore I believe that consumers and families and households are going to buy more of the insurance. So there's clearly going to be more policy cover which consumers and households will take, and that bodes good for the sector. It will help the sector to kind of drive double-digit growth for the entire sector as a whole.
So this is despite no change in premiums, you're saying there'll be an improvement in volumes?
Absolutely. I mean, clearly, I think the consumers were willing to spend X rupees for which they were getting basically a Y cover. Now they're willing to spend the same X rupees, and they will basically probably go in for Y plus cover, given that health insurance itself is now becoming such a big imperative. And clearly, the policy covers are not sufficient to take care of healthcare costs. So healthcare costs are growing, and the best way to mitigate that is to have a higher cover. With basically removal of GST, consumers will be able to allocate that same premium amount for a larger cover, which essentially I think will drive growth for insurance companies.
Just getting back to the consumer appliances space, because that's clearly a big bet right now. You've got a Voltas, which has been struggling with market share. Havells, Whirlpool has been under pressure ever since those stake sale took place. There's Blue Star, Crompton. Your best bet, and why?
Well, we're betting more on a retail chain which sells consumer appliances in basically the eastern and the northern part of the country. So we prefer to essentially kind of bet on platforms versus betting on products. So clearly, I think a better way to kind of play the consumer appliances space and not getting bothered about which appliance or which companies or manufacturers appliance will get sold or which brand's product will get sold. We're essentially getting into more a product agnostic mode and going more for a player which essentially has got a few hundred stores in the northern and eastern parts of the country, where they're selling a whole bunch of appliances across brands. And we believe that a player like that is the best position to make the most out of the growth which is expected in the space.
Nilesh, pleasure having you as always. Thank you so much for sparing time and joining us today with your views on this big GST boost and which among those beneficiaries that you are betting on. Nilesh Shah of Envision Capital. By the way, the gains now for the markets are in less than triple digits. Now only a 90-point uptick on the index. Now at 24,800 is where we stand. So it's an almost 170-point drop from the opening highs for the index. Take a short break. Our coverage on this big GST boost continues on the other side, and we also bring you some stocks that are not doing well in today's session. Stay tuned. We'll be right back.
Welcome back. Auto is clearly the sector of the day since morning. Earlier today, we chatted with Anish Shah, Group Chief Executive Officer and Managing Director at M&M, and Rajesh Jejurikar, ED and CEO of the automotive and farm sector. Listen in to their comments.
The overall impact on the economy, and to me, that is the biggest factor in this change. It is a very dramatic one. It ushers in a new era of simplification and possibly a new era of ease of doing business as well. It will have a very significant impact on consumption. And this is something that should, in some ways, create that momentum that we were looking for in the economy. A lot of the fundamentals have been in place, but I think this is a very significant move that will create that momentum and propel India to an 8 to 10% growth rate overall. So that is the reason why we feel it is a very important milestone for our economy and sets it up in the right way. I'll let Rajesh cover the details from an auto perspective in specifics, but from an overall economic standpoint, this is a very, very positive move.
Fair enough. You're very positive in terms of the overall economic impact. Rajesh, if I can ask you then the specific bit, what percentage in the 18% slab and what percentage in the 40% slab? And of course, we will get to the tractor GST rate reduction as well, which I think is a big positive for Mahindra. Go on.
Yeah, so Prashant, like Anish said, we're delighted with the news overall. It's a huge enabler to demand and consumption. Markets have seen some kind of a slowdown over the last few quarters, and I think this will be a very good boost, timed very well with the start of the festive season. To the specific of your question, I actually want to, you got to see the auto and farm business, which is key part of the M&M Limited company, as a sum of three key segments. The tractor segment, which is tractors and farm machines, the commercial vehicle segment, and then the SUV segment. So tractors gets a big boost, 12 to 5%, which will lead to prices coming down 40 to 60%. And that on an average basis, we do about 35 to 40,000 volume a month. Then we have the pickup portfolio, which is LCVs less than 3.5 tons, which will move from 28 to 18, which is about 25,000. So I'm just giving you these broad numbers so that you get a context of the volume. Our SUV portfolio is in the region of 45,000. Roughly 40% of that will be in the 18% and 55-60% will be in the 40%. But we have to keep in mind that we also have EVs, which will be in the 5%. So overall, if you kind of, were to leave out the 40%, we have a very large chunk of volume pickup plus SUVs in the 18%. And then we have tractors and EVs in the 5%.
Rajesh, around 40% in the 18% overall. Would that be okay in the ballpark?
No, it will be higher when you add the pickups, the commercial vehicles. So it will be almost 65% when we add the commercial vehicles as well.
In the 18%
So when we report
slab.
our auto numbers, it includes commercial vehicles as well.
Okay.
Yeah.
Mr. Jejurikar, hi, good morning, sir. And Mr. Shah, thanks so much for joining in, both of you. Mr. Jejurikar, if I could ask you, I know it's very early, but maybe your team has already done the back of the envelope calculations. If we talk about the full revenue of the automotive segment, let's leave aside farm equipment. So if you talk about full year revenue, then is there a way of gauging that, what part of the portfolio, with the volume breakup that you just gave us, what part of the portfolio or what percentage of that revenue gets a positive leg up because of the reduction to 18%? And what part perhaps, which will be few, which go into that 40% category? So that percentage of the revenue, perhaps you have to see how the volumes play out.
No, every part of the portfolio will get a volume up, Surabhi, because 40 is also benefit of 8%. So what was in 40 was 48%, including the cess. So even there's an 8% benefit. So every part of our portfolio gets a leg up. EVs are unchanged, but everything else gets a leg up between 8 to 13%.
Going back to the overall point, to what extent, I mean, how should we, interpret or imagine the sort of boost and, whether it's going to be a lasting boost to consumption and specifically to the auto sector that these cuts will yield? I mean, say, given your monthly run rate, of course, there'll be an immediate bump up, I guess, all the pent-up demand, maybe in the next 2-3 months, especially in the festive season. So by how much more than the average anticipation would you expect your volumes to go up? And then is it a one-time bump up? I mean, or how should we look at the longer-term impact of this?
So the basic impact will be is the fact that with prices coming down, demand should go up. In terms of specific numbers for us or for any particular company, it is going to be difficult to say, but it will be a longer term impact. What I could say is from a macro basis, I'd expect this to take our growth rate as an economy to greater than 8%. And for us to be somewhere between 8 and 10% over the next few years.
Okay, so so we're going to take that and pull that flash out that Mr. Shah thinks that the GST cuts can take India to 8% growth rate in terms of an economy. And again, Rajesh, if I could ask you the question, so if you were expecting X as your festive sales number, will it be X plus 20% now, X plus maybe 25, 30%, just so that we can wrap our heads around the size of the impact?
Yeah, you clearly don't give up, Surabhi. So,
just trying.
I think, Surabhi, the reality, as Anish said, is there is limited time to capitalize the upside in the festival period. We are literally 20 days away from the festival period. We can't increase capacities or production outputs. Festival period is a 30-40 day period. So I honestly don't think we're going to get a wholesale billing upside in the short run. This is more a long-term game.
Mahindra and Mahindra, the top gainer on the Nifty, at a record high in today's session as well. Take a short break. Mahesh Patil from Aditya Birla Sun Life AMC joins us on the other side to discuss this new GST regime and its impact on the market. Stay tuned.
Well, Welcome back. You're still tuned into Trading Hour on CNBC TV 18. Let's talk about market fundamentals. Mahesh Patil, Chief Investment Officer at Aditya Birla Sun Life AMC, is joining us now. Mahesh, good morning. Thank you so much for joining in. Well, of course, we have to talk about the GST cuts. Which sectors, according to you, would be the biggest beneficiaries, the top three? And you think the impact on GDP would be limited because it would spur consumption to that level?
Yeah, hi. So I think this GST rationalization and rate cut is a big event, right? It is quite significant, not only in terms of simplifying the structure, but also giving a stimulus or a boost to consumption. And it's been not only GST cut, but the other measures which have been taken in the last 6 months, right? Like the tax cuts, what we saw in the budget, which was there. The impact of that is slowly starting to flow through. The rate cuts, what we saw in the monetary policy, that should also help discretionary consumption. And then overall, the good monsoons and low inflation, and along with the GST, all these factors, I think, really create a good kind of a platform for consumption, okay, to get stimulated, especially after once the festive season starts. And if you look at purely from a GST rate cut perspective, the sectors, okay, which we see could benefit are, one is obviously the auto sector, which has been kind of reeling under the pressure. We've seen the auto sales have been sluggish. There is some amount of deferment also, okay, which will happen because people are awaiting this GST rate cut. So clearly that sector should see a meaningful pickup in volumes in the subsequent months. Apart from the auto sector, the FMCG sector, where we've seen the rates have been cut from, say, around 12% to 5%, which should benefit. Then consumer durables, again, a big cut there from 28% to 18%. That has also been a sector which has been kind of weakish because of the monsoons. So the last 1 or 2 quarters, the lower sales, I think that should really see some kind of a pickup in the second half. There are other sectors like footwear, where the difference between the unorganized sector and the organized sector, because of the tariffs being brought down to around 5%, should also help to stimulate demand. So I think overall, I think we should see a meaningful increase in volume, but also as volumes increase, we should see a margin improvement also. So some of these sectors, okay, which I mentioned, I think you could see earnings upgrade to the extent of around 4 to 10%, okay, which is quite possible for the next fiscal year.
Mahesh, hi, morning. This is Rima here. Despite so many policy positives, as you spoke about in auto, in consumption, we could see earnings upgrades to the tune of 4 to 7, 8%. But the market reaction is not euphoric, despite getting the landmark reform that they wanted. Why is that? And it's not that we've gone into the event at a high. Markets, if anything, are down year to date. I mean, not year to date. In the last 1 year, we're down 1%. So, what explains, what is keeping a lid on the markets despite getting the reforms that it wants and the positive policy push?
Yeah, so if you look at from a market perspective, there are a couple of factors. One is the trade deal, okay, which was supposed to happen, okay, that has not happened, and we've seen the tariffs, okay, which have been imposed. Though the real impact of that on earnings is not really that much, but sentimentally, I think that is a negative. And until we really come out with a trade deal, I think from an external world perspective, I think that is a bit negative, and that's why we've seen the FIs, foreign selling, has been pretty relentless in the last 1 month or so. FIs been sellers, and that has impacted the market. And also the fact that while the GDP growth number reported last quarter was strong, okay, the real GDP growth, but the fact is that the overall growth is still weak. If you look at the nominal growth, right, is just about 8.5%. So that is impacting in terms of the earnings growth. We've seen last few quarters, earnings growth has been sluggish in the mid-single digit. So I think market is really waiting to see that whether how this translates into actual numbers in the subsequent quarters, and that's where I think it will start to gain traction, is what I would believe. And so I think these are the factors, I think, why the markets have been Relatively, if you look at India, also has underperformed the other markets. Our valuations relatively were slightly on the higher side, and growth was weak, as I said, anemic in the last few quarters. So I think once we see that growth picking up into the double digits or somewhere around, say, 10% and above, I think that's where money will start to move in, especially from the foreign investors, and that could lift the market higher.
That was my next question, right, Mahesh? What will it take for these FIIs to come back after these exodus that we have seen over the last few months, especially because it is only domestic money that has been keeping the markets afloat even at these levels. But aside of that, aside of this FII selling and aside of this GST consumption, which are the other pockets that you are currently betting on, or is it now that consumption will now take a full-fledged overweight in your portfolios as well, but you would want to see more happening on the ground before it becomes a higher conviction opportunity?
Yeah, so I think while domestic-facing sectors were our preferred choice, okay, in this period where we've seen uncertainty on the external front and on the tariff-related issues, which have been still not, which have been impacting some of the exporters. But if you look at what has happened is that the rupee has also depreciated in this period, right? In the last couple of months, if you look at while against the dollar, the depreciation is only around, say, 3 to 4%, but compared to all other currencies, it has seen a larger depreciation. And that automatically has a kind of a corrective impact. After a lag, actually, rupee depreciation helps earnings growth because it supports your exports. And so I think besides the domestic sector, talk about, like, for example, auto, we have been positive on the consumer discretionary side because we think that that's a sector which has been kind of lagging in terms of growth. And we've seen all these stimulus, okay, which could improve the whole consumer discretionary, consumer durable space going forward. So that's a sector which we are been positive on. Also, the banking sector, especially the NBFCs, I think with this push, at least on the retail side, I think we could see the growth pick up with, again, stimulated by the rate cuts also, which we expect more to come in the latter part of this calendar year. And then as a contrarian sectors, IT is a sector which, while it has underperformed in the last couple of quarters, US overall growth has been a bit sluggish, but we think that there are drivers there where when the US rate cuts happen, you could see the discretionary spends over there improving. The sentiment is negative. There is under ownership over there in the IT sector. People are underweight in that sector. Valuations, as I said, are reasonable. Dividend yields are good. So if at all we see some improvement in terms of the outlook or the growth over there, I think this is a sector which can, say, bounce back with, say, another 1 year view. So from a contrarian perspective, I think the IT sector, which is not necessarily domestic speaking, but external focus, is a sector which we are now turning positive, at least on our matrices, which we look matrices on valuation, on ownership.
Right.
That's
Okay.
slightly attractive.
Got it. All right, Mahesh, was a pleasure speaking with you. Thank you so much for joining us with your thoughts on what's happening in the markets and this big GST bonanza that has come by. With that, we'll do one thing. We'll slip into a short break. On the other side, our special coverage on the big GST bonanza continues.
Welcome back. It's 24,800 still on the Nifty. We're off about 180 points from the day's high. We're managing to hold on to the green line still for the Nifty and the Sensex with a gain of close to about 0.3, 0.4%. But let's try and assess the impact of the GST rationalization on apparel and the fertilizer and the chemical segment. Will it be a catalyst for growth? Vinny joins in for more on textiles and apparel, and Ria on fertilizer and chemicals. Vinny, you go first.
Hi, afternoon. So textiles and apparels, obviously this is a positive that comes in on that front. Given that, they're already facing some bit of that 50% tariff, then they're getting hurt by that situation. Now this GST reduction is expected to actually improve the procurement prices for most of these textile companies. Why? Because now we are seeing a reduction that is coming in the input products. Textile value chain is where we are seeing the reduction coming in. So when you look at it, most of them have come down to the 5% rate. Now that's the uniform rate. Man-made fiber, when you look at it, earlier was 18% GST. That's moved to 5%. Man-made yarn, that is from 12% moved to 5% as well. So most of these input products are now at the 5% GST slab rate. Other than that, obviously there's a reduction in rate for even apparels as well as final products. So whether you look at final products like carpets, rugs, bath linens are some of the places where there has been a reduction. And reduction for apparel especially comes in where the product prices are not exceeding 2,500 rupees. Now they'll be in the 5% GST slab rate. So a significant reduction that comes in there, because this amount first was 1,000 rupees. So a lot of companies would start benefiting on this front. That is why we're keeping an eye out on all these textile names, right? Whether you look at Wellspun Living, Indocount Industries, KP Mills, Gokuldas Exports, even the spinners, Nitin Spinners, Vardhaman Textile are some of the beneficiaries.
Some of the beneficiaries there on your screen. Vinny, thank you for that. Ria, over to you now for the GST impact on fertilizers and the chemical space.
Well, yes, there are two major changes when it comes to the GST rate cut for fertilizers and agri-chem companies. The first one is the correction of the inverted duty structure in the fertilizer sector. The GST rate has now been cut from 18% to 5% on sulfuric acid, nitric acid, as well as ammonia. Now, in terms of the impact, this will lead to a reduction in input costs and working capital and lead to better margins for these companies. And the reason that this correction in inverted duty structures is important is that these three are the key raw materials for these fertilizer companies, and companies were earlier paying higher taxes for their raw materials and selling their finished fertilizers at a rate of 5%. So now that this has been normalized, the rate has come down from 18% to 5%. This will lead to a big positive for the company, and earlier this had led to a lot of accumulated unutilized tax credit for these companies. So now this is a big positive for them. The beneficiaries on this front would include companies like Deepak Fertilizers, GNFC, Chambal Fertilizers, Coromandel, as well as RCF and National Fertilizers. Moving on to the second important change for micronutrients and agri inputs, the GST has been cut from 12% to 5%, and this is going to lead to improved affordability as well as a demand uptick for companies like UPL, PI Industries, Rallis India, Bayer Crop Science, Dhanuka Agritech, and even Best AgriLife. In terms of the stock impact, we are seeing a mixed reaction on the stocks today. Some profit booking seen in some of these names, but overall positive for the industry.
Positive for the industry indeed. Ria, thank you for that update. Take a short break. Still 100 points higher on the Nifty. What you do, I factor in also is that today is the first BSE weekly expiry after the Tuesday-Thursday swaps. Take that into account as well. On the other side, as India enters a new GST regime, we get you more on the impact on the insurance space. Stay tuned. We'll be right back.
Welcome back. You're still tuned into Trading Hour. Let's continue our coverage on the GST rejig. Now, remember, GST on insurance, both health and life, has been exempted from 18%. Now, the consumers will not have to pay any GST on this. However, that means on exempt services, there'll be no input tax credit available for insurers, which could mean higher costs for them. So, we spoke to Yashish Dhaya, who's the chairman and group CEO at PB Fintech, and Ankur Kharbanda, who's the executive director at Niva Bupa Health Insurance, to understand what it would mean for premiums and the final pricing as well. Listen in.
So it is not like one is making too much money or anything of that sort of profit. Terms like profiteering, etc. do not. Which insurance company is making crazy profits? And which distributor is making crazy profits? Right? As a percentage of premium. If the benefit is 18% and the cost is 5% or 10%, a benefit is going to the consumer, is it not? Right? Whatever the industry can afford, it will take.
Do we get the input credit, because now it's into exempt mode? As of now, there is no big clarity, but assuming we will get some more clarity after this. But we have three costs. One is reinsurance cost, then is our operating cost, commission cost. Reinsurance is also exempted, so hence some of our costs will get there, which is waived. The rest two costs, which is the commissions cost or the other expenses, etc. cost, that is something which will not get the benefit out, and that's what we need to figure out. How do we manage this? Because we want to give the benefit to the customer. We want to give the most of the benefit to the customer. We're not looking at anything which is giving on to the customer. We want to give this to benefit to the customer. We don't want to increase premium as of now. We still want to assess this, understand this in terms of what impact it has.
And with that, we call time on this edition of a Trading Hour, this special GST coverage from Sonal, Rima and me. Thank you for watching. We leave you with the Nifty still 100 points higher. Halftime report on the other side takes the action forward.
Tractors gets a big boost, 12 to 5%, which will lead to prices coming down 40 to 60%. There is limited time to capitalize the upside in the festival period. We are literally 20 days away from the festival period. We can't increase capacities or production outputs. Festival period is a 30-40 day period. So I honestly don't think we're going to get a wholesale billing upside in the short run. This is more a long-term game.
After a few sessions of outperformance, auto and FMCG are the big gainers, even as energy and utilities track. And in terms of the GST Council unanimously approving a move to a two-slab GST regime with 5% and 18% rates, along with a special sin and luxury goods rate of 40%. Industry economists and analysts expect this will boost consumption and growth. Bajaj Auto's Rajiv Bajaj, while hailing the GST reform, terms the higher levy on about the 350cc bikes a strategic miss that will kill the segment. Insurance providers too, while welcoming the shift, see costs rising without input tax credit. Mahindra & Mahindra Group CEO Anish Shah says that the GST rate rationalization will drive private investment, which has been missing so far. He believes that it will usher a new era of simplification and ease of doing business.
Good afternoon. You're watching us here on Halftime Report. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me, Vinny Motiwala. The market's holding well, though off highs right now for the frontline index. We have the Nifty holding above the 24,800 mark. Sensex holding with a gain of almost 0.5%. The mid-cap index, after having seen outperformance in the earlier part of the week, is now giving up some of those gains. So the advanced decline lines come up for you. The mid-cap index marginally in the red. We have almost an equivalent number of stocks which are in the red for the number of stocks which are in the green. Those lines absolutely in intersection and single line. The big story overnight and of today is the GST rate cut bonanza that is coming from the government, particularly for mass consumption, be it entry-level vehicles, entry-level, two-wheelers, or a lot of the FMCG staples. A large proportion has now come down to 5%. As against the 12 and 18% that there were earlier. So the street is parsing through all of these things. The FMCG and the auto indices are doing well, though marginally off highs on account of expected profit booking. Hi, Vinny.
Hi, Mangalam. Good afternoon. So some bit of that profit booking is what you're talking about as well. But let's look at some of these individual names, that are buzzing because of this GST, rate that has come in terms of a change, two slab rates, 5 and 18%. Now, DOMS industry, keep an eye out on that one. With Bata, that's buzzing away in trade. M&M also, because of the focus coming in on the GST side. Let's pull up NetWeb Technologies. That continues to gain, and this is after that order that's coming yesterday. So this is not because of GST, but because of the order that we're seeing that came in yesterday. NetWeb Technologies is buzzing in trade. But let's move on and go across to Vivek, who's here to tell us which are the other stocks buzzing around in today's trading session.
Well, that's right. Good afternoon, Vinny. What a session we've had. We opened up sharply higher, but we've seen a bit of profit booking emerge ever since then. But despite that, let's have a look at which are the stocks, especially that have seen quite a bit of an up move. Clearly, the key beneficiary as far as the GST cuts are concerned is the entire auto pack. M&M, across all of the segments, it's present in a clear beneficiary. That's doing quite well. Eicher Motors, remember, again, a key beneficiary. And Escorts, tractor GST reduced sharply. That stock higher by 4%. Now, the consumption boost, clearly that is being seen, has also gone ahead and boosted some of the consumer financiers. So look at a name like Bajaj Finance today. That particular stock doing very well in the session, almost 5% higher. FMCG continues to remain the key beneficiaries, while few of the FMCG names are taking a bit of a knock. Names like Colgate, Britannia, clear beneficiaries. Remember, GST on biscuits is something that's dropped down drastically. The education sector, there the GST has become nil, and on the back of that, all of the stocks present in this particular space have seen a significant up move. DOM, Cellerworld, Fled Writing, all of these stocks doing very well. And footwear, remember, below 2,500, there's been a sharp dip as far as the GST rate is concerned. So the entire pack there is doing quite well. So names like Bata, Campus, Activewear, Metro Brands, all of these names doing very well, up anywhere in the range of 3 to 7%. Well, select stocks under a bit of pressure as well. In fact, the PSU set of stocks are seeing quite a bit of profit booking emerge, selling pressure there. Also remember, exploration services are seeing a hike as far as GST data concerns. So names like ONGC, Oil India seeing a bit of selling pressure. BL, NTPC, Power Grid topping off some of the laggards in the session today. Select FMCG stocks are seeing some profit booking. Names like Tata Consumer, GCPL, even Varun Beverages for that matter earlier today did see a bit of profit booking emerge. So there too you saw some weakness. The entire shipbuilding pack, within the defense space, seeing quite a bit of profit booking. Garden Reach, Cochin Shipyard, BDL, all of these names under a bit of pressure today. And lastly, Maruti, had a significant run-up going into the entire GST outcome today, seeing a bit of profit booking, slight negative sentiment coming in terms of hybrid not being slashed as far as the GST rates are concerned.
Take that point, Vivek, but just keep an eye out on ITC. The stock is at the low point of today's trading session so far, sitting with a gain of just about 1%. At one point, it was higher, so it's higher by almost 3%. It's off by about 3% from the highs, and that's because of important clarifications coming in. Tim C has been getting us this exclusive interview with the CBIC chairman, saying that, the cess will continue well beyond October 31st, up until all the repayments are made. So what happens is that September 22nd, the GST rate increases from 28% to 40%. The cess which would be subsumed will not be subsumed, could not be subsumed well beyond October 31st itself. So that means that there could be a hit of around 5 to 6% over and above what the company has been expecting, and that explains why the stock is off the highs right now. So the cess continues well beyond October 31st, even as the GST rates on tobacco increases from 28% to 40% come September 22, explains why the stock is off the highs. But let's cut across to Parikshit, who's also joining us now in conversation with Santosh Iyer, who's the CEO of Mercedes-Benz, on the sweeping changes in GST rates. Not so much for Mercedes, in fact, gets a little more expensive, I suppose, Parikshit.
Overall, the cess has gone. Earlier, Mangalam, the GST was 28%, and there used to be a cess in the range of 15 to 25%. So overall, the tax hit on your car would be almost 50 to 55% in some cases. Now, with the cess going, there is a base tax rate, so to say, for all large SUVs and luxury cars at 40%. Even large hybrid cars will be in the 40% bracket. Let me go across to Santosh Iyer, the MD and CEO of Mercedes-Benz. Santosh, how is this move for the luxury car industry overall? Does the tax incidence for the customer come down?
Yeah, thanks, Parikshit, for having me. I think it's a no-brainer. This is a great move because reducing taxes was long awaited always. India was one of the highest tax countries when it comes to luxury cars and products. So I think this should for sure drive consumption. But on the other side, I think the biggest outcome is also simplification. Today, earlier we had for EVs, combustion engine, and even for hybrids a different cess. Now all of that is at 40%. So we used to have combustion engine at 48 to 50, including the cess, and hybrid, strong hybrids at 43. Now with the standardization, everything comes to 40. I think it's also a very clear direction that it's either EVs or ICE, and hybrids are part of the combustion engine portfolio. So in that sense, it also gives a vision of government's decarbonization agenda to say we don't confuse now too much with taxation, and it's up to now consumers and OEMs to see how to price their cars. But in general, reduction of prices is expected. We are still calculating how much exactly for the customer, and we will pass on whatever is in terms of taxes to the market as well.
Right. I would also like to ask you, to what extent do you expect the prices now to come down for luxury EVs, including Mercedes-Benz?
So for EVs, there won't be a change because the GST was at 5% and the EVs are continuing to be at 5%. So the EVs will continue to be the same. The biggest change is in combustion engines, where our sedans were close to 48%. The SUVs were having a tax of 50%. So technically the tax incidence has come down by 5 to 10%. and the pricing impact will be 6 to 8%. That's what we are seeing for all the car lines. But I think we are trying that by late night, we should be able to come out with a new pricing for all our car lines so that it's also easy for customers to then make their purchase decisions.
Right. Could you also give us a sense of how this impacts already built inventory? Dealers right now are worried about a cess loss of 2,500 crores as well.
Yeah, exactly. That's, I think, the biggest thing. But yesterday in the FAQ itself, in the evening, it was clarified that the finance ministry will come back on the mechanism, because I think the positive is the government is aware of it, that now with the reduced prices and with the accumulated GST and cess, both, how do you set it off? And that's not going to happen in the near future. So, and this will block working capital also for our dealers and retailers. So this is something now, hopefully before 22nd, before this new changeover comes in, the government is clarifying so that that removes anxiety among the entire dealer community as well.
Right. I would also like to ask you that when it comes to hybrids, all hybrid cars will now come under the 40% bracket. Do you feel that government also has made its intent clear that they want to promote electric mobility, and the rest of the technologies will be there in either the 18% or the 40% bracket?
Exactly. It's much more simpler. So it's not based on the powertrain option is only between an EV and ICE, and there is no third element of hybrid now. So that makes the policy making quite clear from, at least from the central standpoint, and now we have to look at states, because some of the states were thinking of registration charges separately for hybrids compared to EVs or ICE, etc. So that's still to be sorted, but at least from the center's viewpoint, it's ideally full decarbonization with an EV at 5%, and then cars based on size and engine capacity at 18 and 40. So things are simpler, also shows the clear direction what the government wants to steer the industry for.
Right. What kind of uptick do you expect in the festive season?
If with this momentum, because we had a lot of customers who also postponed purchases in end of August. So, we had this entire anticipation of the GST rates coming down. I am damn confident this would be the best ever festive season for the automotive industry ever witnessed. One, also because of a bit of pent-up demand coming from August, but more so also with the reduced prices. I think overall, there is also more money in consumers' pocket, because it's just not automotive, across the categories where the disposable income should ideally increase, because the shopping basket prices should come down. The ability to pay more EMIs goes up, and 80% of cars are bought with installments, and that should definitely help I can't call it animal instincts, but yes, a very strong purchasing sentiment during the festive period.
Right. And finally, before we let you go, Santosh, does this now create demand on a sustained basis? And once again, as a ballpark figure, how do you expect, by what percentage will luxury car prices come down, and possibly of large SUVs as well?
So from a percentile perspective, the prices should come down by 6 to 8%. 5 to 8% will be the right corridor of price coming down, and it should be much more clear by evening. But that's the max that's possible when it comes to price reduction. But on the other hand, I have been always saying, for some of the luxury manufacturers like us, we still, the exchange rate is a major issue because of a lot of components which comes from Germany and from other parts of the world. The euro to the rupee has not been as strong, and that's at 102. So the pricing is still not done at the current exchange rate level. So on one side, yes, the current prices will come down, but the fear is that if the exchange rate continues at some period of time, these prices again will have the tendency to go up. So best time to buy for sure. But this doesn't solve all the problem, because on one side, demand will be created with a macroeconomic churn and a trickle-down effect, as we all expect. But on the other side, hopefully, the rupee becomes a bit more stronger, and there need not be another price increases in 3 to 4 months' time because of the exchange rate issue.
All right, Santosh Iyer, thank you very much for joining us. So 5 to 6% or 5 to 8%.
8%, yeah.
5 to 8% is the price cut that one could expect, and they need dealers need clarity on the cess very soon. So back to you in the studios. So overall ticket price is going to come down, Mangalam, and with that, it's back to you.
Right, take that point. So 5 to 8% cheaper on your Mercedes, Parikshit, the next one?
No, not at all. Not at all. Maybe you, Mangalam.
No. For me, you know what I'll do is I will go ahead and purchase what I can afford, and that is the management that is joining us after this short break. We have the management of Amul on the sweeping GST changes, so we'll obviously enjoy with a lot of paneer, milk, and perhaps a glass of lassi as well. Jain Mehta, the MD of Amul, joins in after this short break. Welcome back. You're watching us here on Halftime Report. The big news overnight has been the rationalization that we've seen in GST for a lot of the daily consumption items. And one of the biggest beneficiaries of that, it seems like, it is the dairy sector. Why do I say that? Because, you know, the GST on UHT milk, chena, paneer, all of them have been brought down to nil from 5%. GST on butter, ghee, cheese, dairy spreads, all of them down from 12% to 5%. Even on condensed milk, ice cream and milk cans, it is down from 12% to 5%. All in all, for all the dairy needs, the maximum GST that you have to pay is 5%. For a lot of the dairy needs, you probably have to pay nothing. The biggest beneficiary of that would obviously be the biggest dairy company in the country, which is Amul, and that's what we have. On a CNBC TV 18 exclusive, the MD of Amul, Jain Mehta, joins in. Thanks a lot, Mr. Mehta, for joining in. It's a sweeping reform that has come in right now. So, fair to assume that your entire portfolio is now either at 5% GST or nil? If yes, then what could the incremental benefit in terms of volumes be because of this rationalization? Because over the last couple of months or so, milk prices have increased at the consumer level.
No, it's indeed fantastic news because this will bring in a lot of benefits both to the producers as well as consumers. And you are right in saying that because now half the products that we do or half of our turnover comes with 0% GST and the balance half with just 5% GST. So we as an organization, cooperative, believe in passing on the largest share of the consumer's rupee to the producer, which is already about 80-82%. And now with reduction in GST, we will definitely increase our share of the consumer's revenue to the producer in a much larger way. So benefits both producers and consumers, and we are really thankful to the Prime Minister and the Finance Minister for this great initiative.
Sure, Mr. Mehta. Good afternoon. Could you also highlight in terms of volume growth that one could actually expect to see or a rise in volume, especially now we do have that festive season that has started as well, right? So do you think this could lead to a bumper festive season given this boost is also coming?
Yes, actually, yes, because we've been growing at double digit all through over the last year and first 5 months of this year. We will obviously look at higher double digit growth now because this will mean a lower price for the consumers and a sustained demand for the producers. So yes, not just the festive season, even beyond that, we will see a greater demand for organized sector in the dairy category, the branded consumer products, and more importantly, as we know, milk is the largest agricultural crop of our country, and milk is the single largest item which we consume in our monthly expenses. So in that case, it is a win-win situation, and therefore we are looking at a very, very long term on this and very bullish on that.
So incrementally, how much? You said earlier you were targeting double-digit volume growth. Now it's high double-digit volume growth. What's the difference between double and high? Incrementally, what could the volume jump be because of this lower GST? And also on a revenue, from a revenue standpoint, because, you know, GST on value-added dairy like butter, ghee, cheese, all the spreads, all of them have come down from 12% to 5% as well, even paneer. So as a proportion of sales, even value-added would increase. Could you give us some numbers?
So as I mentioned, 50% of business comes from fresh product, which was already having zero GST.
Yes.
Okay, so milk and so in that UST milk and paneer has been added, so it's a very big boost. The balance comes from the products like butter, ghee, milk powders, ice cream, cheese, and so on. There also, now the rate is fixed at 5%. All the youth products now are at 5%. Largely the household products are at 0 or 5%. Demand will grow in all these categories. And when I say high double digit, we're looking easily at 20-25% growth in many of these products like ice creams and beverages and cheese and butter, primarily because the per capita consumption of most of these items is very low in our country. Okay, ice cream, we only consume 5 cups or 500 ml ice cream per person per year, as compared to developed countries which consume 15 to 20 liters per person per year. So you can see there is a huge opportunity of growth in these categories. Only 1 in 10 Indian consumers eat butter. Only 1 in 20 eat cheese. So you can imagine that with lower prices and a sustained lower prices over a long term, we will see this category expanding multiple times. And ghee is the single largest product category after milk in our country. We were affected by a high 12% GST rate for a simple reason that it was giving benefit to the unscrupulous traders to do the tax evasion. But with 5% duty, adulteration will come down, tax evasion will come down, the organized sector will grow, and you will see multiple growth happening in that. And that's why cooperatives like us and all the branded players will benefit a lot.
Sure.
Looking at very, very strong tailwinds, and I'm sure it will be very, very good for our country.
Absolutely, a lot of boosts that could come in on the consumption side. But Mr. Mehta, what is the current procurement price? If you could tell us that, and how do you see that moving now? Also, just an outlook in terms of the margin front as well. Where would we see that going now?
The cooperatives of Gujarat are paying very, very good price. And we are pegging our price on per kg of fat for what the milk the producers bring in. So an average a liter of buffalo milk with 6% fat, the farm gate price is about 60-64 rupees, which is almost 90% of what we as consumers pay in the market. And same for cow milk is also at very high rate of 40-45 rupees per liter, which again is almost 80-85% of what the consumers pay. So that is one indicator which we grew about 8-10% last year. We will continue to pass on the higher realization from the market back to the farmers. And that's why I said all the milk producers will benefit in the short as well as long term from this GST reduction. Similarly, the demand also, when the prices are low, the demand for dairy products goes up more, because that's where the income elasticity of milk is. The GDP is growing very well. The country is progressing very well. And you see, look at the chronology also. The Prime Minister and the Finance Minister reduced the income tax a few months back, which benefits started coming to all of us as consumers with the 12 lakh rupee slab starting from April onwards. And now you have higher purchasing power and a lower price for most of these dairy products, which means the demand will grow up and the production is also growing up. So you're able to match and grow at both the ends of the spectrum.
All right, we take that point. And this is a question which stems from a lot of personal interest, Mr. Mehta. The protein range of Amul has gained a lot of mind share right now. I'm not sure of the market share because none of those high protein products are easily available on your website. What is the GST situation on that right now? Has it come down to 5% as well? And what are you doing to increase your capacity and distribution of those protein products that you keep advertising but unfortunately never available in the markets?
Well, good demand is always good for the brands, and when you see stock out, it means it is sold out in most of the times. We are seriously looking at that, obviously, and expanding our capacities. Nobody wants a stock out situation for disappointed customers, for sure. Having said that, we tripled our capacities last month. We are again doubling up on that in the next 2 months, and by end of March, what was our capacity in the beginning of the year, it will be almost 7 to 8 times. So multiple expansion happening. The raw material is abundantly available with us, which is the way from the cheese. When we are the largest manufacturers of cheese and cottage cheese in the country. So that's not a constraint. All we needed was to get the product and the recipe right. And that's where we are seeing a demand coming across all the products that we are launching, and more products also in the pipeline, which we'll be launching very soon. GST on buttermilk lassi, the high protein ones, was always 5 and will continue to stay 5. But because now there is a reduction in GST on the cocoa and the chocolate based products and so on, many of our products will now see a lower GST, which means we were always value for money in our not just protein but the entire range. We'll further try to work on it to see that we pass on that benefit to our consumers and build the market at multiple times.
And what's the GST on whey protein?
Our this month's August sales was almost 3x of last year's sales. So yes, huge demand. We're selling and reaching out to large number of customers with more than 20 lakh monthly active users on our shop.amul app. But yes, this is just the beginning, and I can assure you that you will see more and more of Amul products, protein products, not just available, but also being consumed by most of us.
And what's the GST on whey protein products?
Yes, that also. Yeah.
How much? What is the GST? It's 5%?
Yes.
All right, so that should be good news for all of us. Thank you so much for joining in. I'm definitely, looking forward to the higher availability of these products. But from a larger consumption standpoint, you said earlier you were targeting double-digit growth, and now it's high double-digit growth because of the reduction in GST, and as a result of which the prices to the hands of consumers, there is a fair amount of elasticity out here. So increased volumes is what we can expect. Thank you so much for joining in on this momentous day. We will take a short break on that note. And as we do that, a reminder for our viewers.
Absolutely. Unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV 18 Access. Our premium members only experience on CNBCTV18.com. The membership includes access to CNBC TV 18's flagship events, interactions with our journalists along with curated studio tours, e-learning sessions and masterclasses and curated lifestyle benefits.
Welcome back, and joining us on the show now is Mr. R.K. Vij. He's President Emeritus at the Textile Association. He joins us on the show now. Mr. Vij, hi, thank you so much for joining in. And first of all, it clearly is a cheer across segments. Would you say the same for cotton as well?
Good afternoon, Ram Ram. We were waiting from the last 7 years that the government will take some decision for the growth of the textile. And the textile now, government has done, Honorable Prime Minister and Piyush ji and Sitaraman ji has done this, a milestone work has been done. And so we are dividing the textile whole industry into three parts. One is the garment, weaving garment. The second is the intermediate spinning, fiber filament manufacture, and first and third is the raw material. So government, earlier we were having 18%, 12% and 5%. 18% on PTA MEG and 12% on fiber filament and yarn, and then 5% on the weaving and garment, and more than 1,000 rupees garment was attracting 12%. So with this removing 12% and taking all fiber filament, yarn, fabric and garment up to 2,500 rupees per piece, all are 5%. So it has become ease of doing business for the whole textile industry. Now the working capital will reduce and only the value addition we will have to deposit. We will not have to wait for the refund every time, and the expansion in the downstream industry will increase, and it is a very big move. And at present, we have a very big domestic market of textile, and the garment for the common man fabric will be available at a much easier price. Earlier, there was a difference between man-made and cotton. It has been removed by the government.
Absolutely.
So, but there is, I think, there is one point I think government has missed, because these all are coming in textile, and the manufacturing of this PTA, MEG, fiber, filament, yarn, they are coming in the petrochemical ministry. So PTA, MEG are still at 18%, which is the basic raw material to manufacture textile product like fiber. Earlier the fiber was 18%, no inversion was there, but POY, FDY, TTY was at 12%, and now government wants to bring to 5%. Now the inversion between PTA, MEG raw material to filament fiber will become 13%. And I just wanted to clear that government should look after, because the growth will be there in the man-made fiber. So
absolutely,
if it would have been one GST rate on right from PTA, MEG to that, it would have been a very good bonanza for the industry. Because I think government may be thinking that PTA and MEG is being used for the other product, chemical product, but 70% of the PTA MEG is being consumed in the PSF, POY, filament yarn, which goes to the textile, and moreover, then another 20% which goes into the PET, also at the later stage
comes into textile.
Recycled fiber. And
I get your point there, Mr. Vij. But quickly also, as you said, man-made and cotton now are almost at par. And India is quite contrary to what the rest of the world does. In the rest of the world, we have 60 to 70% of man-made and perhaps 30% cotton. Do you see India's numbers changing as well?
Yes. Thus, as on today, the growth was only, the whole textile growth was only 5 to 6%. And now with this, we are expecting the growth of 10 to 12, and maybe the 13% growth will be there. And the export will be also there, and will be competitive in making the export and domestic market also, and import will also reduce. This will be so the growth on textile industry will be there. Only we request to the government before 22nd of September, if they can again think whether the PTA and MEG, basic raw material or ML, should come down to 5%.
Okay. We see that you keep pushing on to that one, but that seems slightly difficult at this point in time. But overall, a cheer clearly.
Correct.
Absolutely, overall cheer coming in for the consumption side, textile story, and most of these other sectors where we're seeing a reduction in terms of GST as well. But On that note, we're going to sip in a very short break. Don't go anywhere. We have more conversations lined up, so stay tuned in.
Welcome back. Joining us now is Sanjeev Bajaj, Chairman and Managing Director at Bajaj Finserv. Mr. Bajaj, great to have you with us here. Prashant this side. I mean, it's a big one, what the government has announced. It sure is, one hopes it gives a big fillip to consumption. But I wanted your first thoughts, sir, top down, before we get into some of the individual impacts you see for the variety of businesses you're in. Go on, sir.
Top down, Prashant, I think this is one of the biggest reforms we have seen from the government since the 2017 introduction of GST. And we must commend the government for doing that. It is a big bang positive movement for the economy on multiple fronts. So if you think about it, big boost to households and rural income. I think it's between 1 lakh and 2 lakh crore, the benefit that should come out of this. Big stimulus for manufacturing and infrastructure. As we know, the cut in cement will be a big cut in construction costs, infrastructure costs, further accelerate investment and job creation. Particularly also, if you see the kind of items, tremendous support through MSMEs and employment intensive sectors. So overall, very positive, I would say, this kind of dramatic action that has been taken on GST rationalization, plus some of the rationalization moves beyond the rate cut, should just also help in formalizing, getting more MSMEs to come in, sign up under GST, so formalizing the economy as well. Even the operationalization of the GST appellate tribunal and simplification of structures should strengthen compliance and trust in the system and broaden the overall system.
Mr. Bajaj, on the lending side, we've spoken to a few analysts and they all agree that if there's one business most positively correlated to the consumption boost which these GST cuts may provide is your business. And I think the markets are giving a thumbs up. Could you give us I know, of course, I'm not looking for specific numbers or anything, but there will be a multiplier effect. And I mean, you're exposed to a variety of lines, lending lines there. Where will we see this coming up the most, in your opinion?
Prashant, as you correctly said, that any such dramatic change in the economy first impacts financial services disproportionately, because it ends up supporting or enabling so much of the real economy. And that can work both ways. In this case, naturally, it is the positive step. So there is a hopeful positive move. I would directly look at both. On the consumer side, consumer spends should go up dramatically in the coming quarters. In addition, we have a large lending portfolio to MSMEs. That should benefit as well. And, over the last few years, we've been looking at what it takes to get private sector to bring in new investment. And while a number of factors have provided tailwinds, the larger external uncertainty and impact of wars, it has been external situations that has held private sector back. I think this kind of a boost should encourage a number of sectors now where they've reached significant capacity utilization to start looking at the next investment cycle very seriously.
As someone said, and I think that was an apt point to make, if on cars, for example, rates are cut, it's not necessary that the demand for, people will immediately start buying more cars. But the point is there is more savings in the hands of the consumers. So that category it's very difficult to put numbers to it, whether, a cut of 10% will lead to this much volume jump. But broadly, because it's happened on so many items across the board, more money in the hands of consumers. And that is a broader kind of call. But if I were to press you a little bit more, Mr. Bajaj, which lending segment, according to you, will you think do very well? You mentioned SMEs, MSMEs. Where else?
Very much consumer lending. Consumer lending is for Bajaj Finance one of our largest areas. So we should clearly see over there. And as you said correctly, Prashant, the money that gets saved now in the hands of both the rural and the urban consumer partly will get spent. And keep in mind that there was a negative emotion due to the external uncertainties, the trade issues. I think a large part of that can get resolved with this positive step. So if people were sitting on the fence and not spending in the last couple of quarters, hopefully many of them will get convinced to spend. For the rest, they will still be saving an additional amount of money. And as we have seen in the last few years, that additional money now is not just going into buying a second house or investing in fixed assets. It is going now into financial assets. Look at the monthly inflows into mutual funds. And this will help the economy as well. Because as we are trying to build the real economy over the next decade and more, we need a very solid financial services economy to fund the real economy. So I think this provides the start of very strong tailwinds for that as well.
Late July, when we spoke with the Bajaj Finance management, this is after, of course, the results, the commentary was, you would acknowledge, cautious, right? A little modest. And markets did take note of it, and because, it's such a behemoth and leader in pretty much all the segments. Do you think these cuts help change some of that sentiment, that cautiousness? Have you spoken internally? Have you had a huddle internally with the finance team in terms of how they are thinking about it? Anything you can tell us?
I would say broadly, of course, it will have a significant positive momentum. What that is expected to be, that is something that the team will work on and the team will talk at the right time.
Okay. Will you allow me to push you a little bit more? I think you had said that AUM growth guidance, 23 to 24%, but you said, your lending business said, we will revisit this post the second quarter. Would you want to preempt that? Broadly, without being specific, and we want to, of course, hold you to numbers. But any thoughts on what kind of lift this could provide?
I can only say it will be positive, and I think that's common sense. Beyond that, the team has to run its numbers. They have to do their job. I'm not going to do their job for them.
No, absolutely. Fair enough. On some of the stress formation, etc. as well, maybe in some segments, does this help, Mr. Bajaj? to alleviate some of it?
It's too early to say, but see, there is more money coming into the individual's pocket or the MSME's pocket. So by definition, that should help. So I think your questions are all fair. Given that this is a 24-hour announcement, it will need a little bit of time to get into detailed numbers. But all this should be positive. But I'd also like to stress, given my role at CII, that we're very grateful that a large number of the CII suggestions have found their way in these GST rationalization moves. And once again, goes to show the very significant collaboration that the industry association like CII has with the government towards this.
Mr. Bajaj, let me ask you about on the insurance side, right? There it's not very clear. We've spoken with a couple of insurers since the morning that getting the rate down to zero on policies, health, life, etc., will result in lower premiums. I mean, that math doesn't quite add up because of input taxes and the ITC benefits not being available. Can you tell us what the thinking there is?
So our teams are just calculating the numbers. Of course, there will be some ITC credit that will not come, but I think net, first cut, and again, don't hold me to it, I don't have the numbers, but first cut, it should benefit positively. How much? This is something that we will know soon as we start calculating it.
You're saying it should result, I mean, at a headline level, there should be some reduction in premiums.
Yes, I would think so. Now, what it is, when it is, what products, prospectively, new products, these are details that the team has to work on. So I can't answer that at this point of time.
As head of the industry body as well, Mr. Bajaj, when the representations were made and you just said that the government has sort of agreed to most of it. On the insurance side, at least what we were picking up is that the industry did not want zero, because with zero under the current rules, you can't have input tax credits. It doesn't allow for it. So a bit of disappointment there or no? Not really.
So you see the benefit of that ability to set off input tax credit would have gone completely to the consumer. So from that point of view, if he had been able to do that with maybe putting this into the 5% slot, that would have benefited the end policyholder that much more. But we still think that it's a big step from where we were till 2 days ago. And maybe this is something to keep in our pockets for the next time this gets rationalized.
In terms of in the order on the insurance business, Mr. Bajaj, life, general, health, I mean, how does it, who benefits most and who benefits least? I mean, if you were to request you to order those lines of businesses, because it's different for different, right? On the health side, for example, the rate of reinsurance where ITC is available is lower. Whereas for other lines, it is higher. So, I mean, just in terms of ordering of benefit, where would you place which one?
So the quick read that I've done, firstly, the cuts on life and health. Health can either be a standalone company or it's part of the general insurance company. Benefit will come on both. But as you correctly said, depending on what's the build-up on the ITC side, the benefit could be slightly different. I don't have those exact numbers right now. That's something that we are working on.
Mr. Bajaj, thank you very much. First cut reaction coming through, but I think it's very, very useful. But I think the message is very clear across your lines of businesses. On the lending side, there is a boost coming. You're not putting numbers to it, understandable. On the insurance side, there will be a cut in premium. How much, when, etc. That's being worked out as we speak. Thank you once again, Mr. Bajaj, for joining us. Okay, well, that's Sanjeev Bajaj, head of Bajaj FinServ. With a perspective. I guess let's just take a quick commercial break here and we'll have more for you on the other side.
ushers in a new era of simplification and possibly a new era of ease of doing business as well. It will have a very significant impact on consumption. And this is something that should, in some ways, create that momentum that we were looking for in the economy. A lot of the fundamentals have been in place, but I think this is a very significant move that will create that momentum and propel India to an 8 to 10% growth rate overall. So that is the reason why we feel it is a very important milestone for our economy and sets it up in the right way.
Tractors gets a big boost, 12 to 5%, which will lead to prices coming down 40 to 60%. There is limited time to capitalize the upside in the festival period. We are literally 20 days away from the festival period. We can't increase capacities or production outputs. Festival period is a 30-40 day period. So I honestly don't think we're going to get a wholesale billing upside in the short run. This is more a long-term game. Tractors gets a big boost, 12 to 5%, which will lead to prices coming down 40 to 60%. There is limited time to capitalize the upside in the festival period. We are literally 20 days away from the festival period. We can't increase capacities or production outputs. Festival period is a 30-40 day period. So I honestly don't think we're going to get a wholesale billing upside in the short run. This is more a long-term game. Tractors gets a big boost, 12 to 5%, which will lead to prices coming down 40.
Going to be benefiting from the GST rate cut that is going to be the stationery as well as the education space as well. Why? The GST rate has been cut from 12 to 0% for education services, materials including books and learning aids as well. Now to talk to us about the sector, the outlook for the company going forward, we have Ganesha Gala, who is the MD at Navneet Education, joining in with us. Mr. Gala, good afternoon. Thank you so much for giving us your time. And surely you are going to be cheering this, right? From 12% to nil in terms of GST. I want to understand this is across all your segments, right? That you're going to be seeing the benefit of nil, and will you be looking to pass it on to the consumers?
Yeah, first I'll answer the last question that, of course, whatever benefit that the company gets, we will pass it on to the end consumers. But it does not impact or benefits the businesses that Navneet is in. As per the press note released yesterday, we still need clarification, and that I'm talking about particularly the content business that we are in. Now, there is no clarity on books that are being published by the company are also exempt. Of course, those were exempt, but particularly the raw material that we buy from the paper mills, whether even that is exempt or not, as it is mentioned for the exercise or notebooks. So we are still awaiting that clarity, and basis which we will come to know. But if it is not covered, then the input cost for the publishing business will increase from 12 to 18%.
All right, that is very interesting. But you do get about what, 350 to 400 crores sort of revenue coming in from stationery products. The GST on notebooks, pens, pencils, erasers, sharpeners, all of them have been brought down to nil. If you could give us a sense on what proportion of your existing revenue comes in from practice notebooks, notebooks which don't have any published content on them and some of these stationery products that have now zero rates?
So as you rightly said, it is 400 crore revenue that we generated last year. And of course, the future looks too bright for the business. Now, in there, almost 95% was exercise and notebooks category, which now will get exempted, where the input cost earlier was 12% and output was 5%. Now, therefore, whatever 12% reduction that we will get on our input cost, that will be the price reduction for the end consumers as well. So I'm sure the consumers at large will be benefited with this rate cut.
All right. And what proportion of incremental sales will happen because of lower prices? Or is it price inelastic because, everyone needs to buy these products?
I fully agree. Overall, the consumption levels, as spoken by the other speakers as well, needs to go up, which we witnessed in last couple of quarters that impacted our business too. So just by the reduction or between 5 to 12% in pricing, I do not think immediately there would be any improvement in offtake of the products. But overall, going forward, we are very, very clear that because of this little bit of reduction for the end consumers, the overall, it should be a good buying going forward.
Okay, you're expecting overall a good buying. Not maybe in the near term, we may not see such a big change coming in, is what you're highlighting. But going forward, we could see some bit of a positive move, right?
You should also understand this is a seasonal business. So the first quarter, when the schools reopen, has the maximum volume that happens for the company. And next 2 quarters, in any case, would be a very low quarter every year. So next 2 quarters, in any case, is not going to see any benefits.
Okay. So, but then overall, maybe by Q4, do you see an improvement furthermore? Because right now in Q1, your stationery business had seen a degrowth, right? So then would that lead to a better improvement or a better growth, at least Q4 and Q1 of FY27 then?
Of course, in Q4, we will see much better numbers going forward. But in stationery, again, the stationery has 2 components. One is the exports and the other is the domestic. In exports, of course, we saw a little bit of degrowth because of the US tariffs, and which is still unclear as of now how will it shape up. But in domestic stationery that we do around 400 crore, there, of course, we did not grow though, but going forward, we are looking at a much better numbers.
What proportion of your overall sales comes in from the US right now?
So it is around, of the total stationery business, it is almost 60% that comes from the US. And of the total business of the company, it is around 40%.
Wow, 40% and 60%, all of that stands to get impacted by the 50% tariffs. So is there any clarity on that? Or do you believe that, this could be taking a bit of a hit?
So we did started speaking to our customers, and all the customers thankfully have said that they are going to continue buying them. But what we saw that because of the inflation has gone up in the US, the overall consumption in the local US itself has gone down. And because of that, volumes have come down a bit in last 2 quarters. But overall, present customers, they have assured us that they will continue to buy from us.
Did they speak about sharing this 50% tariff? How much of that would be borne by them? How much of that would be borne by you?
They have not yet asked for that. But on our own, to retain them, we may decide something to pass it on as well.
Okay, interesting there, actually, in terms of the tariff update that's coming in there, an important one that everyone will be keeping an eye out on.
40% of their revenue stands to, get impacted by this. And obviously the company says that even as their customers will continue to buy products for them, we still need to know the impact that it could have on their margins. Thanks a lot, Mr. Gala, for joining in. Wish you good luck for the remainder of this year, the academic year. We've obviously grown up using a lot of the Navneet products. We hope the next generations also do that, be it digital, stationery, or maybe some of the people in the US itself. May there be some more clarity.
Yeah, thank you.
Okay. Thank you so much for that. And with that, we'll wind down this edition of Halftime Report. Thank you so much for tuning in. Up next, your Business Lunch.
ushers in a new era of simplification and possibly a new era of ease of doing business as well. It will have a very significant impact on consumption. And this is something that should, in some ways, create that momentum that we were looking for in the economy. A lot of the fundamentals have been in place, but I think this is a very significant move that will create that momentum and propel India to an 8 to 10% growth rate overall. So that is the reason why we feel it is a very important milestone for our economy and sets it up in the right way.
Frontline stocks perk up even though they are off the highs of the day after the big GST revamp, even as mid-caps see some profit taking after a few sessions of outperformance. Auto and FMCG are the big gainers, even as energy and utility stocks drag.
The GST Council unanimously approves a move to a two-slab GST regime with 5% and 18% rates, along with a special sin and luxury goods rate of 40%. Industry, economists and analysts expect this will boost consumption and growth.
Bajaj Auto's Rajiv Bajaj, while hailing the GST reform, terms the higher levy on more than 350cc bikes a strategic miss that will kill the segment. Insurance providers too, while welcoming the shift, see costs rising without the input tax credit.
Mahindra and Mahindra Group CEO Anish Shah says the GST rationalization will drive private investment, which has been missing so far. He also believes it will usher in a new era of simplification and ease of doing business.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormis Fatakia. With me as always is Vamakshi Dhuria. Vamakshi, good afternoon. There's the first weekly Thursday BSE expiry after the new rules kicking in. And well, after the almost borderline euphoric start of close to 25,000, is slightly off the highs of the day, but it's the broader markets that are feeling a bit of a pinch here.
Well, absolutely. Good afternoon to you, Hormas. And largely the subdued sort of move, if we can call it that, at least for now, that we're seeing is mainly because a lot of this, I believe, was baked in after the Prime Minister's speech on August 15. So therefore, we're trading in the green. So that's good news so far. And for the week itself, we're also trading in the green. So, the bulls will be looking at that information. But, the broader end of the market is definitely taking a knock. Of course, the advanced decline ratio has now moved in favor of the declines. Earlier this week, it was the advances that were far outnumbering the declines, but the lines have crisscrossed just a short while ago. The mid-cap end of the market is down almost 0.2%, and so is the small-cap end of the market. Now, as far as sectoral movers are concerned, earlier in the day we had a lot more sectors in the green. Now the PSU Bank Index has cooled off. It's down almost 0.6%. No PSU banks advancing in trade. IOB is down almost 2%. Canara Bank is almost 1.7%. But it's largely all of these, FMCG names, auto names that are actually moving around in trade today, Hormaz.
Indeed, and that's of course because of the big story and that India's new GST regime is here after the council approved a two-slab structure of 5 and 18% and a special 40% rate for sin and super luxury items, which will come into effect from the 22nd of this month. CNBC TV 18 news breaks on all the rates were also confirmed. Small cars will now face an 18% GST compared to 28% earlier, while motorcycles under the 350cc and three-wheelers get cheaper and have been bought under the 18% bracket.
Hormas, now in a big boost for the consumption story, new GST rates imply big savings on daily essentials, which have been moved to the 5% bracket from the 12 to 18% bracket earlier. Electronics such as ACs, TVs also see a cut from 28% to 18%. Now, the finance minister also addressed the media after the yesterday's GST Council meeting. Let's listen in to what she had to say.
This reform is not just on rationalizing rates. It's also on structural reforms. It's also on ease of living. so that businesses can do their business of working together with the GST with a great ease. Rate rationalization, of course. We've reduced the slabs. There shall be only 2 slabs, and we are addressing also the issues of compensation cess. Ease of living, simplifying registration, return filing and refunds. Levied on common man's daily use items have gone through a rigorous looking into, and in most cases the rates have come down drastically. Labor-intensive industries have been given a good support. Farmers and agriculture as a whole will also benefit by the decisions we have taken today. Health-related also will benefit. So the key drivers of economy have been given a prominence. Man items such as hair oil, toilet soap, bars, shampoos, toothbrushes, toothpaste, bicycles, tableware, kitchenware and other household articles have all come to 5, whether they were in 18 or whether they were in 12. Similarly, reduction of GST from 5% to nil. 5 से 0 में जाने वाले items indicate कर रहा हूँ. Ultra high temperature milk, the UHT milk, chena or paneer, all the Indian breads will see nil rate. Reduction of GST from 12% or from 18% to 5. इसमें फूड आइटम्स बहुत सारे हैं. नमकीन से भुजिया है, सॉसेस है, पास्ता है, इंस्टेंट नूडल्स है, चॉकलेट्स, कॉफी, प्रिजर्व्ड मीट, कॉर्नफ्लेक्स, बटर, घी, ये सब 5% में आ रही है. From 28 to 18% on small cars and motorcycles which are equal to or below 350 cc. Reduction of GST from 28 to 18 on buses, trucks and ambulances. Uniform rate of 18% on all auto parts, irrespective of their HS code. 3-wheelers from 28 to 18 again.
Well, a key beneficiary of this GST rate reform has been the FMCG sector, and Mangalam is here to break everything down for us with regards to its impact. Mangalam.
We just heard the finance minister, and all essential items of daily use, be it soaps, shampoos, toothpaste, toothbrushes, even biscuits and a lot of the dairy products, all of them have been curtailed. The rates on them have been curtailed from 12% down to about 5%. And that is a big boost because these sectors are price elastic and they are sensitive to the way prices move in the country itself. And a large part of these products actually are sold at 5, 10, 15 rupee price points. So what it basically means is that these companies will not pass on immediate price benefits, but give better volumes at the same price. So which means that volume growth for a lot of these consumer companies could return and be added a fillip to because of the GST rate cuts that have come by. We had the managements of a lot of these consumer companies join us. Amul, for instance, has increased their revenue growth target or volume growth target from double digits to high double digits because of the GST rate rationalization. Bikaji, because of the rate rationalization on bhujia, namkeens, etc., believes that their additional volumes for this category could be anywhere between 3 to 5% because of the rate cuts that have been affected. And we can see this on the share prices of the likes of Colgate as well as Britannia as well, because these are impulse purchases, especially for the biscuit business, and Colgate as well had seen a lot of competition and stress in the lower end of consumption. So because of rates now coming down from about 12 and 18% to 5%, this could provide a bit of a fillip to their volumes. And also seeing some positive uptick on names like Gillette, because shaving creams and products of daily men's use are also now in the 5% bracket, which increases the scope for formalized sector coming in these businesses, and as a result of which we are seeing an uptick on all these share prices. So net consumption has been given 2 thumbs up and the stock market is reacting accordingly.
Well, thank you so much for that, Mangalam. Indeed, a big boost coming in for all of these consumption names. But in fact, we also caught up with ITC Chairman Sanjeev Puri, and he said that GST cuts can provide good momentum to the economy. He also believes that the tax cuts can boost consumption, which has been lagging due to elevated costs. Let's listen in.
This is a very bold step that the government has taken. It's the Honorable Prime Minister announced it on the Independence Day. And I think it's going to have multi-dimensional impact. because it's not just about rate reduction, it is also about simplification, it is also about ease of doing business. So the changes are multidimensional and impacts are going to be even more profound. I think it's certainly going to make things cheaper for the common man. So it will fuel consumption. It will lead to a lot more formalization of the economy.
Now, here's what the CBIC chairman had to say on the issue of the cigarette cess.
Many of the items which were attracting compensation cess will now not be attracting compensation cess from 22nd September onwards. So this collection which we are anticipating till 31st October, that will not happen, and it will take slightly longer time to collect enough for making the loan and interest payment. So on the commodities which are left out from this exercise, that is pan masala and tobacco products, so there the compensation cess will remain there till the time collections are completed. NCCD and BCD, this excise duty is not part of the GST exercise. So these were not the issues before GST Council. So they have not made any recommendation in this regard.
Let's actually focus in on some insurance stocks as well, because there was an important clarification that did come through, and resultantly most of these, while earlier in the day were trading in the green, they've slipped in the red, and this is after the CBIC chairman Sanjay Agarwal clarified on inversion benefits for the insurance industry. Let's listen in, and this is a very important clarification.
In case of insurance where the rate has been brought down to nil, there because under exemption there is no provision of any refunds under inverted duty structure. Inverted duty structure refunds are applicable only if it is because of the goods or capital goods, but not because of input services. So as you mentioned that on commission it is at 18% and on policies at nil. So in such cases refunds are not admissible.
Now, the GST Council has exempted the individual and life and health insurance in and reinsurance costs from the GST regime. Now, there will also be no input tax credit for insurers while exempting GST from insurance. Now, Yash is here to tell us more on this. Yash.
Well, let's just understand what are the four key headlines as far as GST on insurance is concerned. The first one, GST has been exempted on life insurance as well as health insurance. Under life insurance, GST exemption will be applicable on endowment policies, term life insurance policies, ULIP policies, as well as annuity policies. On the health insurance side, it would be on individual health insurance as well as family floater policies. What does this mean as far as policyholders are concerned? Now, in a situation where the industry passes on the entire benefit of making insurance exempt from GST, in that case for policyholders, health insurance premiums could come down by as much as 18%. Life insurance policies, the ULIP premiums and the term premiums could come down by about 18%. Endowment policies, since the current GST is 4.5%, annuity where it's 1.8%, those premiums could come down by similar proportion. What does it mean for insurance companies? Well, for insurance companies, it could mean higher cost because first thing, there is no provision of input tax credit, which means that companies won't be able to offset the cost which they incur when it comes to acquisition of an insurance policy. Just to give two numbers, on acquisition of 100 rupees of premium, for example, a company incurs a cost of as much as 70 rupees. They were able to offset this cost so far through input tax credit, but now that won't be possible, and hence that would be some pressure as far as insurance companies are concerned. The second one is no provision of or no benefits of inverted duty structure. Only reinsurance as a category will be exempted from GST, but that is just 35% or one-third of the total cost. There is commission cost, there is claims cost, and here they won't be exempted as far as that inverted duty structure benefit is concerned. So that benefit won't come in, and with these two put together, analysts suggest and the industry leaders suggest that there could be an increase of about 5 to 7% of cost for health insurance companies and about 9 to 11% of cost for life insurance companies. Now, three scenarios emerge as far as this additional cost for insurers is concerned. First one, health insurance companies take this 5 to 7% cost hit on their books. Life insurance companies take this 9 to 11% hit on their books. Or they tend to share it with the distributor of the likes of Policy Bazaar and other distributors when it comes to sharing this additional cost itself.
Well, thank you so much for bringing us, clarification on that, Yash. But moving on then, on the flip side, automakers are expected to see a big boost with rates on small cars, motorcycles under 350cc cut to 18% from 28% earlier. Now, Rajiv Bajaj, who's the managing director of Bajaj Auto, told CNBC TV 18 that he expects the two-wheeler industry volumes to reach fresh highs with the new GST reforms. Take a listen.
The two-wheeler industry that never really recovered post-COVID, I think finally will now head to a new high. To summarize what's happened for the two-wheeler industry, I would say it's a tactical hit. This GST reduction is a tactical hit, but it's a strategic miss. It's a tactical hit because, obviously a big fillip for, let's say, almost 98% of the domestic industry with this significant reduction in GST. But at the same time, the 350cc plus motorcycles, where Royal Enfield and Bajaj are the biggest players, this is on the one hand just 1% of industry, perhaps about 4% by value. For Bajaj, I can tell you this is about 3% by volume and about 7% by value. I think it's inevitable because I think let's look at it like this. The single cylinder motorcycles that are over 350cc are typically up to 450cc. I think most, if not all, will get realigned over the next few months to under 350cc by appropriate engine development. Twin cylinder motorcycles or multi-cylinder motorcycles that are bigger than that obviously will remain in the higher space, but those volumes are tiny, minuscule. And therefore, yes, I think even new developments will be largely restricted to under 350cc.
And we also spoke to the management of the Mahindra Group, who believe that the GST rate cuts will create the kind of growth momentum that they were looking for. Here's what they had to say.
Ushers in a new era of simplification and possibly a new era of ease of doing business as well. It will have a very significant impact on consumption. And this is something that should in some ways create that momentum that we were looking for in the economy. A lot of the fundamentals have been in place, but I think this is a very significant move that will create that momentum and propel India to an 8 to 10% growth rate overall. So that is the reason why we feel it is a very important milestone for our economy and sets it up in the right way.
Tractors gets a big boost, 12 to 5%, which will lead to prices coming down 40 to 60%. There is limited time to capitalize the upside in the festival period. We are literally 20 days away from the festival period. We can't increase capacities or production outputs. Festival period is a 30-40 day period. So I honestly don't think we're going to get a wholesale billing upside in the short run. This is more a long-term game.
Well, take a short break then. More news and updates follow on the other side, so don't go anywhere.
Tractors gets a big boost, 12 to 5%, which will lead to prices coming down 40 to 60%. There is limited time to capitalize the upside in the festival period. We are literally 20 days away from the festival period. We can't increase capacities or production outputs. Festival period is a 30-40 day period. So I honestly don't think we're going to get a wholesale billing upside in the short run. This is more a long-term game. Tractors gets a big boost, 12 to 5%, which will lead to prices coming down 40 to 60%. There is limited time to capitalize the upside in the festival period. We are literally 20 days away from the festival period. We can't increase capacities or production outputs. Festival period is a 30-40 day period. So I honestly don't think we're going to get a wholesale billing upside in the short run. This is more a long-term game.
Ushers in a new era of simplification and possibly a new era of ease of doing business as well. It will have a very significant impact on consumption. And this is something that should, in some ways, create that momentum that we were looking for in the economy. A lot of the fundamentals have been in place, but I think this is a very significant move that will create that momentum and propel India to an 8 to 10% growth rate overall. So that is the reason why we feel it is a very important milestone for our economy and sets it up in the right way.
GDP growth to move beyond 8% going ahead. Let's listen.
I would like to congratulate Honorable Prime Minister Shri Narendra Modi ji and the Finance Minister Srimati Nirmala Sitharaman ji for historic decision to bring down the GST slabs to only 2 slabs, which is going to create a huge upswing in the overall economic activities in India because of the fact that the rates of tax will come down, and that would also put money in the hands of the people who will continue to buy more, and that's going to create a virtuous cycle. And I've always believed that reasonable taxes would ensure that tax compliance increases and the tax avoidance or tax evasion reduces drastically. So overall, reduction of rates, reducing the complexity, which has been now decided. In fact, the GST introduction in 2017 itself was a historic move, and this particular decision now is going to go a long way in ensuring that India is able to now go about 8% plus GDP growth rate going forward.
Take a short break. More news and updates continue on the other side. Stay tuned. Welcome back. Now, US President Donald Trump has announced his plans to seek a ruling from the Supreme Court on the ongoing tariff tussle between his administration and the US courts. He said that his administration will ask the justices to reverse an appeal court ruling that found many of his tariffs to be illegal. He also said that the US may have to unwind trade deals with the European Union, Japan and South Korea if the Supreme Court rules against it on its tariffs.
Well, Hormaz, it's not done till it's done. The tariff drama continues and we'll keep getting you more updates on that as well. But with that, that's all the action we have on this edition of Business Lunch. Don't go anywhere. The Mid-Cap Radar comes up next.
Good afternoon. Welcome to Mid-Cap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. Hey Vivek, good afternoon. Well, we started with a bang. We've come up from those highs. We were closer to that 25,000 mark. Now we are at that 24,820 mark. Mid-caps, they're sulking in trade today. And we do have a lot of stocks or sectors which have come up from the highs.
That's right. Good afternoon. clearly cooling off. In fact, even as we speak, the mid-cap index in the red, the advanced decline ratio now, especially in the broad end of the market, skewed towards the negative side. But we have a lot lined up on the show, so let's start off with the top headlines. Frontline stocks perk up after the big GST revamp, even as mid-cap see some profit-taking after a few sessions of outperformance. Auto and FMCG are the big gainers, even as energy and utilities drag.
Stocks like Dome, Cello World and Flair Writing surge after Centre Slash's GST rate cut from 12% to nil on educational services and materials, including books and learning aids. Management of Navneet Education tells CNBC TV18 they will pass on the entire benefit to consumers.
Insurance stocks slip from highs as CBIC chairman tells CNBC TV18 that there is no input tax credit while exempting GST on insurance.
Footwear stocks like Bata, Campus, Activewear and Metro Brands surge as Centre cuts GST on footwear below 2,500 rupees to 5% from current 12%. Footwear priced above 2,500 rupees will be taxed at 18% versus the current 12% mark.
Solar industries under pressure after an explosion occurs at its factory situated in Nagpur. 1 killed, 8 injured in this accident.
Okay, all right, those are the top headlines. Let's revisit markets yet again. 102 points higher on the Nifty right now. But there is pressure on the mid-caps, 140 points gone on that one. If we talk about the movers in the sectoral space, the CPSE index that was lower from the start of the trading session, and that has continued to be the case right now as well. What has come off from the highs has been the auto names, the consumption space. IT too is seeing some pressure from the top. So these are some names which are in the green, yes, but there is some pressure from the top, from the highs of the day as well. And mid-caps, we've been talking about that. The advanced decline ratio is in favor of declines as we speak, and a lot of moving parts in the broader markets as well. But some stocks which are doing really well. Electronics Mart, 14% higher on that one. Atul Auto, that one is up 12%. We have NetWeb that continues to see higher highs, 6.5% higher there. We do have Vishal Mega Mart, which is sitting with gains of around 3.5%. So a whole host of stocks which are on our radar, and let's take that forward. Mid-cap movers, that's the segment that we'll be talking about. Vivek has gone to the big wall. Tell us more about the mid-caps moving in trade, Vivek.
Well, that's right. A bit of a dampener given the fact that we actually expected quite a lot of fireworks, especially in the broader end of the markets, given the fact that so many rate reductions seen across most of the consumption names. But despite that, quite a few stocks making all the strong moves. The footwear GST is something that has come down significantly, and that clearly is seen aiding demand. Look at Bata, up after almost 6.5%. Campus as well as Metro Brands doing very well for themselves. The entire education sector, GST there is quite nil. So look at DOMS, Cello World, Flair Writing, all of these stocks doing very well in the session today. Muthoot Finance is doing quite well. That particular stock has perked up to the day's high in the last half hour or so. Gillette, this particular stock from the broader end of the markets up almost 5%. Colgate as well as Imami from the broader end of the markets, especially when you're looking at toothpaste GST getting cut, both of these names as well as the FMCG pack doing quite well. On the other hand, quite a few laggards as well. Have a look at Paytm, one of the top laggards, especially as far as the broader end of the NSE 500 is concerned. Solar Industries, we told you about the negative news flow. That stock down almost 2%. Ola Electric, after the one-way rally the stock is seen in the last month or so, today seeing quite a bit of profit booking, down almost 6%. And Kalyan Jewellers, especially in this particular name, quite a bit of short build-up seen. That stock down 2% in the session today.
All right, some interesting names there. Thank you so much for that, Vivek. Let's do one thing. We'll slip in a short break. When we come back, we'll get you more on the markets and stock-specific action. Stay tuned for that. Welcome back. You're still tuned into Mid-Cap Radar. Well, Nifty steady where it was when we started the show as well, but some stocks like MIC Electronics, that's higher. That's up almost 18.5% right now. Atul Auto is the other one. Aditya Vision is a stock which is surging. It's up around 10%. And a lot of movers on the back of the GST rate cut announcements that have come by as well. So let's do one thing. We've spoken about how these GST rate cuts would impact specific companies, specific stocks. But what is the impact on GDP overall? How does it impact macros? Let's get in a conversation going. Sakshi Gupta, Vice President and Senior Economist, HDFC Bank. And we're also joined by Kanika Pasricha, who's the Chief Economic Advisor, Union Bank of India. Ladies, good afternoon. Thank you so much for joining in. Sakshi, let me start with you. It is largely in line what was expected. What are your GDP targets for FY26, FY27? Do you think the government has given an estimate of how much GDP will be impacted? What kind of changes are you seeing to your GDP targets? Which are the specific sectors which will see a lot of impact because of this?
No, thank you for having me on the show. Look, of course, the GST announcement that has come in is clearly going to be positive for consumer demand. Particularly, I think, for the lower and middle segments of the income pyramid. So if you look at, the benefit of the GST rate cuts, especially the move from 12% rate to 5% rate, which is coming in a lot of the food, beverages and essential items. I think this is something that benefits, the middle and the lower middle, income segments. And to that extent, we do see that this will have a positive impact of about, 15 to 20 basis points positive on our GDP growth estimate for the year. Our baseline currently was 6.3%. So because of this GST announcement, we do see a positive impact there. I think this is something that will play out, not just in the near term, but I think over the next 12 months. We could, in the second quarter, we could, see some postponement in demand and demand starting to pick up, end of September when these GST rates come into effect. But Q3, I do, of course, expect that there's going to be a pent-up demand effect and, that playing out on the consumption side. I think this comes at a time when for households over the last couple of quarters we have seen that because of high inflation and of course slow wage growth, we had started seeing consumption kind of slow down. So in that context, definitely this is a positive booster for demand.
Right. Kanika, let me also bring you into this particular conversation. Clearly we are seeing a shift in stance from the government as well as RBI. Earlier, it was all about capex and the kind of boost that we were seeing towards the industrial sector. This time around, we've seen three key moves, right? We've seen personal tax rates getting cut, we've seen RBI cutting rates, and now we're seeing the GST kicker. FY26, FY27, what kind of growth rates are you penciling in? And has, both Centre as well as RBI exhausted all the arsenal as far as their own armory is concerned?
So I would say let's be optimistic. Let's not think that they've actually exhausted all their arsenal. There's still a lot more to go. In fact, there's been consistent discussion by the government and RBI to think of more policy proposals to support the economy. So first, compliments to the government. They have given us a GST rate cut and completely agree with Sakshi. It's a demand booster. Given the kind of items that have been lowered from 12 to 5% and 28 to 18%, though the high-end premium or luxury segments have been raised, the base rate has come up from 28 to 40% for a luxury car, though the net rate comes down still from 45% effective tax rate to 40.
Right.
Or your premium travel also goes up from 12 to 18. Now, quickly on your question, policy space. See, we think that, yes, after income tax rate cut and the RBI rate cuts, plus the GST reform, just purely basing on GST, agree with Sakshi's number of 10 to 20 basis points. In fact, the number can only be higher if the ease of doing business segment and the tax compliance improvement segment actually gives us much more dividend the way it has been giving in case of income tax in the last few years. But last but not the least, purely the growth number for the year, which be up to 6.5% to align with MPC after the 7.8% booster shot for Q1, which was primarily front-loaded growth. Another factor which we can't ignore in growth is the US-India trade deal stalemate, which actually affects 1% of GDP, around $45 billion across sectors like shrimps, textiles, gems and jewelry, auto components, chemicals. That itself has to be taken into account as well, which is why after this number, we'll not be upping our forecast. It's a close wait and watch, 10 to 20 basis points. So this year, 6.5%. I would say with a downward bias, if the disruption remains for longer, salutary effect provided by the government definitely, and RBI also may probably add with another 25, 50 basis points token rate cut. Next year, purely on base effects, some upping can happen, but broadly trend forecast, GDP's mapping in terms of its decadal trend of 6.5%, and may stay there. Thanks.
Got it. Thanks for that perspective, Kanika. Sakshi, let me come to you. We've spoken about the growth perspective, but now that we're putting in more money in the hands of consumers, what is the impact on inflation? What are your targets in terms of how it would impact that number?
Right. So look, on the inflation front, there are a couple of things, right? If you look at the new revised rates on GST, then de facto, that brings, a downside, impact on our overall inflation forecast for the year, which could be, anywhere between 60 to 80 basis points. However, I don't think that that's going to be, fully passed through. So assuming, that 50% of the benefit is actually passed on in a very graded manner to, consumers, I would at this stage see a downside to my annual inflation forecast of 2.8%. And the downside could be anywhere between 10 to 15 basis points. My forecast was already lower than what the RBI is expecting for FY26. The second thing, I think you were hinting more at the fact that, look, if there is going to be a pickup in consumption, does that end up being inflationary in nature down the line, right? So from that perspective, I think that, for now, at least the problem has been that consumption has been very low. Capacity utilization rates in the economy have also been, across sectors between 70 to 75%. So I don't think that we are anywhere near a situation where there is heating up in the economy that can happen, that can lead to a, upside inflationary impact. So at least for this year, I think this GST announcement is actually going to pull down the overall inflation number.
Sakshi, a quick follow-up question. Now, between the center and the states, almost 3 to 8% of budgeted GST revenues would be impacted, right? So in that context, how do you see that getting offset? What do they have in their arsenal to go ahead and equip themselves to offset these laws?
Right. I think, if you heard the press conference yesterday, the Revenue Secretary, did mention that the revenue impact of this GST announcement is close to, 48,000 crores. I think that is not an extremely high number at this stage. And I think they are relying on the fact that there will be some buoyancy on the tax front. My sense on the fiscal side at this point is that, look, the overall GST revenue number is high. We have some cushion from, things like a higher RBI dividend that we got this year. Also, the government seems to be making a little bit headway on the disinvestment front. So I would at this stage expect perhaps some amount of expenditure rationalization if required to balance the fiscal math, at least at the center level, and for them to kind of achieve their fiscal deficit target.
Got it. All right. Sakshi and Kanika, it was a pleasure speaking with the two of you and understanding what the impact on macros could be and the overall picture as well. But for now, we'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back. You're still tuned into Mid-Cap Radar. Well, we've been getting a lot of opinion and reaction for that big GST rejig. In fact, Asif Malbari, who's the CFO of Godrej Consumer Products, says, and I quote, "We welcome the government's initiative of lowering taxes to boost consumption. This is a positive trigger for demand and strong driver of volume growth as well. This move will ultimately contribute to overall economic momentum. GCPL has leading soap brands such as Synthol and Godrej No. 1 and hence welcomes this move. We are fully committed to ensuring that the GST rate reduction benefits are passed on to consumers."
Well, moving on, we'll now go ahead and see what are the impact as far as individual sectors are concerned, as well as individual stocks are concerned. We have both Winnie as well as Ria joining in from the research team. Winnie joins us first. Winnie, what is the impact as far as the textile as well as the apparel space is concerned? What kind of rate rationalization have we seen here?
Hi Vivek, good afternoon. So, at least after that 50% tariff, which had impacted most of these textile and apparel players, at least this is some bit of a relief, right, that we're watching out for. Given the reduction in this GST rates that we'll see coming in, could lead to a reduction in procurement prices for key input raw materials for most of these companies. Now, obviously, let's talk about where we are seeing the reduction coming in. Man-made fiber earlier was 18%. That's come down to 5%. Man-made yarn, that was earlier 12%. That's come down to 5%. Most of the raw material, which was in the 12 to 18% range, has now come down to 5%. So that uniform rate of 5% across key raw materials. Not only that, ready-made garments or finished products, that has also seen a reduction in terms of the rate as well. Now, for ready-made products or finished products like carpets, rugs, bath linen, as well as other products in towels, etc., also seeing a reduction to 5% from previous 12%. For apparels, there's a change in rate, right? They had said that first 1,000 rupees, they were being taxed at around 5%. Now that amount has been changed to 2,500 rupees. So up to 2,500 rupees value product, they will be taxed at 5%, and above that is going to go to 18%. So that is also a benefit that comes in for apparel players. And that is why we're seeing a boost coming in for most of these names, whether you talk about Arvind, Wellspun Living, Indocount, KPR Mills, Nitin Spinners, across the value chain benefit for textile players.
Okay, makes sense. And while the stocks are not buzzing on higher volumes or higher rates, but still it's a big change that we have seen in this particular space overall. Ria, there's some rationalization with Scamba and fertilizers and chemicals as well. Detail that for us.
Well, yes, there are two major changes when it comes to the GST rate cuts for fertilizers and agri-chem companies. The first one is the correction of the inverted duty structure in the fertilizer sector. The GST rate has been cut from 18% to 5% for sulfuric acid, nitric acid, as well as ammonia. Now, in terms of the impact of this will lead to a reduction in input costs and working capital, and also lead to better margins for fertilizer companies, and specifically for the correction in the inverted duty structure. The reason that this is important is that all three products of these products are key raw materials for these fertilizer companies, and now that this has come down from 18% to 5%, this will be a big positive for the company, because earlier these companies were paying a higher tax rate for their raw material inputs, and they were selling these finished fertilizers at a GST rate of 5%, which had also led to some accumulated unutilized input tax credit for these companies. So when these new rates come into effect, this will be a big significant positive for these companies. In terms of the key beneficiaries, we have Deepak Fertilizers, GNFC, Chambal Fertilizers, Coromandel, Rashtriya Chem, National Fertilizers, among other fertilizer companies. The second important move that has come in is for micronutrients and agri inputs. The GST rate out here has been cut from 12% to 5%, and in terms of the impact, this is going to lead to improved affordability as well as a demand uptick in this segment, and this will be positive for players like UPL, PI Industries, Rallis India, Bayer Crop Science, Dhanuka Agritech, as well as Best Agri Life. In terms of the stock prices today, we're seeing a bit of a mixed picture. Some of these names are seeing some fair bit of profit booking, but overall this is a big positive for the industry.
Okay, all right. Thank you so much for that, Ria. By the way, let's take a look at the markets. When we started the show, it was up around 100 points. Now it's up just 75. So there is some selling that we are seeing from the top. We have stocks like Dr. Reddy's, Bajaj Finance, Eicher Motors, Bajaj Finserv, HDFC Life, some of these insurance stocks, of course, which are going lower. HCL Tech is the other one. which is putting some pressure on the markets from the highs as we speak. But the GST Council has exempted individual life and health insurance from GST. In addition, GST on reinsurance costs is also exempted, which is confirming a CNBC TV 18 news break. We spoke to Yashish Dahiya, the chairman and group CEO at PB Fintech, and the management of Neva Bupa to get their views on how this rejig could affect the business. Listen in.
So it is not like one is making too much money or anything of that sort of profit. Terms like profiteering, etc. do not. Which insurance company is making crazy profits? And which distributor is making crazy profits? Right? As a percentage of premium. If the benefit is 18% and the cost is 5% or 10%, a benefit is going to the consumer, is it not? Right? Whatever the industry can afford, it will take.
Well, that was the management of Policy Bazaar, and that was something that you actually saw quite a bit of negative news flow coming in, and you did see most of the stocks going ahead and reacting negatively. But remember, the GST Council has also exempted individual life and health insurance from GST. In addition, GST on reinsurance costs also is exempted, confirming a CNBC TV 18 news break. Earlier today, we spoke to the management of Neva Bupa, and this is what they have to say.
Do we get the input credit, because now it's into exempt mode? As of now, there is no big clarity, but assuming we will get some more clarity after this. But we have three costs. One is reinsurance cost, then is our operating cost, commission cost. Reinsurance is also exempted, so hence some of our costs will get there, which is waived. The rest two costs, which is the commissions cost or the other expenses, etc. cost, that is something which will not get the benefit out, and that's what we need to figure out. How do we manage this? Because we want to give the benefit to the customer. We want to give the most of the benefit to the customer.
All right, a further fall is what we are witnessing in the markets. Nifty is up just 60 points right now. Important to track that. The mid-caps are down 0.4%. So we'll keep doing that for you, the moves in the market and individual names as well. For now, we'll take your leave on this edition of Mid-Cap Radar. Special coverage on GST continues when we return.
Joining us right now is the chairman of Maruti Suzuki, Mr. R.C. Bhargav. Mr. Bhargav, big move for the automobile industry and for the consumer in general. Big relief ahead of the festive season. How do you think this is going to boost sentiments at the entry-level car segment?
Well, I think this major reform by the government is going to make not only a big difference to the automobile industry, but is going to make a big difference to the economy as a whole. Certainly, the small car segment is the big beneficiary. It will, I assume, from the 22nd of September onwards, our expectation is that we will start getting into about 10% growth a year instead of the current stagnation and decline. I believe the automobile industry, as a result, will also move away from its 1%, 2% growth and get into a 6-7% growth as a whole.
Right. So you're saying you're expecting 10% growth in FY26?
For the remaining part of 26.
Right.
The first 6 months are gone anyway.
So overall, how do you expect FY26 to finish, sir?
Well, if I take first 6 half to have zero, actually we are at a decline, then overall for the year we should get, for the small car segment, a growth of maybe between 4 and 5%.
Right. That indeed is an important point. Now, when it comes to the policy clarity, do you think the government has also now clarified the policy intent that EVs will be at one rate, 5%? Beyond that, if you have a small car, either in CNG or petrol or hybrid or any other alternate fuel, that will be taxed at 18%. Large cars, large SUVs, hybrid, alternate fuels would go in 40% bracket. Do you think the policy intent is now clear?
Very clear.
On hybrids, sir, do you feel that the cost advantage that hybrids may have had marginally earlier, for example, a large hybrid car over 1500 cc had a 28% GST and a 15% cess, and maybe a large SUV or a luxury car would have had a 50% tax rate if we look at a 22% cess. Do you think that benefit has now gone?
Certainly gone, because both are going to be at the same rate.
Does this impact the sale of hybrid cars?
Not very much, because at that end of the market, Parikshit, the market is very small. You're talking of a price range of around 40-50 lakhs. It's a very small market there. So the impact, theoretically there's an impact, but overall in terms of volume, it's not going to make much of an impact.
Right. I would also like to ask you about the reduction in prices. We were just speaking to Mercedes-Benz and they said they expect prices to come down for luxury cars in the range of 5 to 8%. As a veteran of the industry, sir, what is the estimate or what is the good news you could give to consumers?
Well, we expect that at the entry level, let's say the Alto level, I can't give you an exact figure, but I think the reduction in retail price for the customer will be between 8.5% and 9%.
That's an important aspect. So you believe that for entry-level cars, 8.5% to 9% to even 10% could be the price reduction?
I don't think it can become as much as 10% because the tax benefit is 10%. And there are costs like transport costs and dealers' margins and some extra costs which don't get into the GST calculation. So it'll always be a little bit less than 10%.
Right. What about the rest of your segments, be it sedans, be it small SUVs?
The price will all reduce in all the vehicles because the minimum in the bigger segment was 43%. That comes down to 40%. So 3% reduction in tax will translate into roughly a 1.5% change in the retail price. Some cars went up to 45%, including cess. So 5% reduction would mean roughly 2.5% reduction in retail price.
Right. So 2.5% price reduction across the portfolio.
For those which are in the 45% bracket.
Right. That indeed is an important point, sir. Is Maruti Suzuki going to ramp up production now?
We hope that the demand will increase substantially and that we will be able to increase production, yes.
Right. Now, in terms of the future portfolio for Maruti Suzuki, now that this rate rationalization exercise is over, what do you think will be the product mix that Maruti will focus on?
You know, our strength has always been the small car market. I believe that the demand for small cars is going to pick up again because there has been a suppressed demand for years. Customers have been waiting for relief. This year, the government has done a number of good things which have combined to give the customer a great feeling of optimism in the future. Whether it was the income tax relief, whether it's the repo rates reduction and therefore borrowing rate reduction, now the reduction in GST on a whole lot of household commodities, all of these are going to combine to increase his own disposable income and purchasing power. And I think the customer is going to be a very happy man because he's going to find that he can finally start buying things which he has been postponing for years.
Right. And my final question, Mr. Bhargav, you had always been lamenting, especially since COVID-19, that the bread and butter segment of the industry of Maruti Suzuki is shrinking. Does this GST reduction now come as a savior?
I think this will make a big difference in the composition, as I said, of the whole product. The market will no longer remain just SUV driven. It will also be driven by small cars.
All right. That's an important point. Mr. Bhargav, thank you so much. Finally, any clarity that you would now seek from the government on an immediate basis? Any request for the long term?
At the moment, let's absorb what has been done. Let's make use of all the benefits which the government has given us. And I'm sure over time we'll come up with new things after that.
All right. Thank you very much, Mr. Bhargav, for joining us.
Thank you.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Hello and welcome to Closing Bell. Last hour to go. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I am Reema. With me are Surbhi and Prashant. And all their morning exuberance has faded now. Markets have given up close to 200 points from the top. The high today was nearly 25,000, 24,980. And as we speak, we're below 24,800. The bears are wresting control of the mid-cap index too. That's down close to about 0.5%. Very, very disappointing, right?
Oh.
Like, I mean, there's so much good news and this market just doesn't go up.
It's one of two things, Reema. Either the market is sensing something which we've still not discovered, or we have still not wrapped our heads around to it. And if you're someone who believes in the wisdom of the market, then is there a signal out there? Or the flip side of that could be, is the market just getting over pessimistic? Is the market not able to move ahead of this issue about FPI selling or tariffs, etc., because if you look at it, I mean, whichever way you look at it, the numbers are big, the cuts are big, corporate commentary is strong, consumption is expected to revive, but yes, it's not showing up in the market. For some sectors like auto, for instance, you can still argue. The auto index was anyway up 9% over the last 1 odd month or so, roughly speaking 1 month. So there was a big build-up. It's still piled on more gains. But if you're looking at FMCG, for instance, I mean, you should have, or you would have expected a bigger reaction to come through, but that's not the case. And even in auto, pull up stocks like, that's FMCG. Let's pull up individual stocks to see the reaction. Pull up a Maruti. It's showing a little bit of red already. There are some consumer stocks out there like, Nestle, Trent. They're showing gains between 1% and 2%. But yes, we don't have big exuberance, across the board exuberance. Prashant is also with us. Prashant, so which one is it, you think? Is the market sensing something which we are not?
Which are the two options, Surabhi?
Either the market is sensing something that no one has figured out, and that's market wisdom, or the market is just over pessimistic. It's just, it'll know better in due course.
I think it is number 3.
Oh, which one is that? I was waiting for it.
So this is, we discussed this in the morning actually, across sectors, right? This is basically pre-positioning.
Pre-positioning, yeah.
So I looked at, we don't know the graphics, but I'll say it, and we put this out in the morning. Nifty, from the 14th of August till yesterday's close, the Nifty Auto Index is up 6.8%, 7%.
True. Yeah.
Right, 14th August is right before the Prime Minister's speech. So since then, I mean, this has been building. So the auto index is up 1.25% off the highs, but it's up 7% till yesterday's close from the 14th. The consumer index, Nifty consumer index is up 7%, 14th to yesterday's close. Metals are up 5%. Again, same date. FMCG is up 4%. So I think it's basically...
It's in the price.
It's in the price, or, I mean, it's not... Of course, I mean, nothing is ever priced in completely in one day, but the point is, there is a fair bit of pre-positioning, and I think that excitement does wear out, right? I mean, that, 11 o'clock at night excitement and then early rush, I mean, we're all... but eventually the market finds its own rhythm. But I think what we're seeing in terms of the cooling off, at least for now, seems to be a bit in terms of just sort of correcting some of the earlier pre-positioning that we really had. But there's enough single stocks which are moving around, and I think we'll focus on all of that as we talk about markets from here on. Let me just quickly get in Mitesh now to run us through what he's making of things. Mitesh, good to have you here. Good afternoon. So, so in the morning we put out this level. The recent correction was from the 21st of August high to the low on the 1st of September. The 61.8 retracement is 24,878 of this most recent fall. We took that out very convincingly, and now we are under it once again as we speak. Just levels you're watching, what averages you're watching, and what's the thing to do?
Yeah, so Prashant, good afternoon. One, I think broadly my view that markets will be range remains. Two, I think, while we got past this 24,870 level, we, had a pivot at 25,000, which was an intraday pivot historically, which is where, if you look at the markets, we made a high on the 31st of July and some other intraday highs were also there. So broadly, this is a market which is still contracting on the near-term or daily on the daily and the weekly charts, which means that you will see these kind of situations when rallies get sold into and declines get bought into. I would still believe that we are in for sideways activity, and in case we break yesterday's high, so we fill the gap, with which we opened today morning, which is around 24,730. Then we might head towards 24,400 again and test the lower end of the range. So as of now, it's a contracting market, trade with stock-specific bias. That is what I said in the morning, and that is the view which remains.
Mitesh, hi. Afternoon. Any stocks that you would trade?
Yeah. So Federal Bank is, something which is just breaking down. That's a negative setup over here. Would recommend taking a short call with a stop at about 192 for targets of around 183. And EV is something which has gone through a big correction. Could be a buy call here. Keep a stop below levels of 51.30. Look for targets of 52.50.
Okay. And Mitesh, let me throw two more stocks specifically at you, the two biggest Nifty winners, M&M and Bajaj Finance. They've already had a good run, but do you see more upsides?
See, M&M, the good thing over here is that the stock has broken into all-time highs, and that should keep the stock in good stead. Again, extremely overbought, so you might get a pullback, but I would not be surprised that eventually much higher highs are being made over here. M&M for me, buying opportunity would come around the levels of 3,400 in case we get it over there, which is roughly about 70-80 points lower. In case you get an entry over there, that will be a good entry point. Keep a stop below 33.50, and I think we might actually see today's high of 35.50 being tested and crossed.
Okay. All right. Thanks very much, Mitesh. We'll come back to you in just a bit. Gurmeet Chadha is with us to take us through this leg of the show. Gurmeet, what a day, and historic announcements coming through, right? Now, let's straight away distill this down to individual stocks. And let's start with auto. We're seeing the reaction, which is fairly diverse across Maruti. You can, again, that's the argument we were just having. Now it's a run-up already, 20% in the last 1 month or so. So is there more upside? Should you stick to a Mahindra? No, it's not like Mahindra & Mahindra has not run up. Look at M&M. It's been running up for the last 2 years. But how should one play it? Which part of auto? Two-wheelers, four-wheelers? Where do you see some durable upside?
So, my sense is auto will have a great quarter. So I spoke to at least 4 or 5 dealers since morning. In fact, what has happened is even for high-end cars, something like, let's say I spoke to a Toyota dealer, something like a Fortuner, the 28% GST and cess and compensation share effectively was around 50%. Now it's 40. So if you pick up let's say a Fortuner 4x2, which is 36 odd lakhs in, let's say, Chhattisgarh, let's say Korba or in some place in MP, that's now down like by almost 3.5 lakhs. In fact, one of the dealer told me they've got like 40 bookings of Fortuner since morning in Korba, for example. So I think what will happen is once you have more price lists coming, because it will take a little time for system to put different codes. Auto pods have this HS code, HMS code, which needs to be put. You'll get some prices, and I think that's where the bigger impact will come. So I think you'll see a lot of back-ended demand there. So I'm very constructive on M&M and Maruti and including the OEMs, because also you have to see what has happened in last 2-3 years. Because the auto numbers have been pretty static. Similarly for two-wheelers. Now look at a Bajaj Auto, for example. It's been around 9,000 now for quite some period of time. So once the entire thing gets up, because 97% portfolio is below 350cc, right? So you will see some kind of impact coming in today. Today it's quite flattish. Valuations are reasonable. So I'm actually very constructive. I think I'll play both four-wheeler, two-wheeler, OEMs. M&M, again, you have almost 60% of the portfolio benefiting there, including tractors from 12 to 5. Even the above 1500cc cars will, I think, because the compensation cess goes away, so there is marginal improvement. And then you have Navratra starting from 22nd. So I'm very constructive. I think I'll probably add more to what I already have in the portfolio.
There's one more interesting pocket which is doing well, and that's these platform retailers like Electronics Mart and Aditya Vision. Both these stocks are up close to about 12 to 13%. We were chatting with Nilesh earlier, and we asked him that amongst which would be the top GST beneficiary, and he said the consumer appliances space, because on a price of 50,000,
the cut in GST is quite sizable as compared to the savings on a biscuit packet. So then we asked him, then what would you play then? Would it be a Blue Star? Would it be Voltas, Havells? And he said that his preferred pick would be one of these retailers of multi-brand products. So he didn't get into names, but there is Electronics Mart down south. That's up close to about 15%. The other one is Aditya Vision, which has about 150 stores up north and east. And these are stocks which are actually seeing a lot of interest. Gurmeet, do you have any of these stocks in your portfolio, or have you been looking at it?
So partially, I agree. You have platform players and retailers benefiting, but I also think there is a lot of subdued performance, even in some of the AC makers like Voltas or Blue Star. We had a very tepid season, which was the peak season, disrupted by rains and heat waves not being enough. Then you have something like Havells, which is across the appliances, electrical range, not only just restricted to, just the fan and the Voltas again has Beko and then the RAC market share being there. So I would prefer both, as I said. We have Havells and Voltas in our investment universe. We have Polycab, which is not necessarily exactly appliance play, but more a cable and wire play, and the FMEG, which is fast moving electrical goods, is 20%. I think one should also look at some of the appliance makers like Stovecrafts of the world, because that's also where you will see big rural demand coming in. And I think one thing which has surprised and will continue to surprise, is the resurgence in agri and rural demand. Obviously, some disruption in North floods. So I think that's another pocket one should not lose sight of.
You said Havells, and which is the other one?
We have Havells, we have Voltas, we have Polycab in our investment universe.
Got that. And Stovecraft, do you like, or
Yes,
do you own it?
We invested in Stovecraft.
Okay. What about another company like Bata? That's been an underperformer. And Bata is actually holding on to gains, 7%. Is it time to relook at it?
No, as I said, some of the plays can be tactical. So let's say something like a Bata, because footwear, there's been a price hike in terms of where the GST goes down. Similarly, apparel makers, similarly some FMCG names. So for example, Colgate, almost 100% portfolio gets the GST benefit. Something like a Nestle, probably maybe 50, 60, 65%. We'll see how it pans out. And then you have, let's say for example, a BKG, which is probably 70, 80% processed foods. I think Britannia also, including biscuits, bread, everything, almost 80, 90% portfolio gets benefit. So I think some of the FMCG names, because there has been underperformance for a pretty long time, whether it is HUL, Nestle, Britannias of the world, I think that is where you can look tactical. But I don't think so their valuations are that cheap that you want to hold them for a longer period of time.
Okay. By the way, love your example of the Fortuner, Gurmeet. It's happening, already happening. By the way, the market now is almost in the red. It's just about, it was up 200 points higher at the day's high, and it's completely flattened out, just about 6 or 7 point change now. So 24,721 is where we are trading at this point in time. So, we were talking about this yesterday as well, but with the understanding that these announcements were only going to come after Friday. How it's going to be tricky next 2 days if you're trading, especially because of exactly this pre-positioning and specific stocks. There would be all kinds of expectations built in, right? And it's a big market out there, and different understanding on things, etc. So all of that, of course, now coming to, culminating with the announcements last night. Some are getting unwound, some getting built. So I think you should look at what you're seeing right now in terms of the change. And I don't think the market price action is a reflection of what the government has done yesterday. It's still long-term, very positive, it's great news, should have happened before. Maybe that's the only criticism you can do. But this is just, I think, some of the pre-positioning getting unbound in that sense. Gurmeet, when you join us, you always give us a few things you are working on, ideating on, meeting, and on your watch list. So tell us, Gurmeet.
So, one thing which stuck to me was this, DOMS I've been eyeing for a while, which is the children's stationery. And I think that space is really getting premiumized. People are now paying a premium to a pencil or sharpeners or eraser. And I think that's one very large segment where you're willing to pay a price, which wasn't the case when we were kids, probably. So that's something which we are tracking. I'm also looking at some of the beaten down names, which could be the second order impact. So you look at, for example, banks and financials. I don't think so, other than Bajaj. I think eventually if everything does well, on consumption and even the private capex picks up, it will be on the bank balance sheet. So I think somewhere banks, especially the tier one banks, look oversold. And look at what SBI did on a fundraise, Prashant, few weeks back. They almost raised money at 4.5%. On long dated bonds in dollar terms, which is in line with what some of the countries are raising, right, from after the triple B one. So I think really augurs well from a long term cost of funds and the way credit optics is going to shape up. So that's something we like. And we are looking at something, as I said, even on the export side, because that's where you get bargains, Prashant. So some textile lanes which have been rogered, something on IT, especially tier 2 IT, which they are trying to pivot, and it's a more IP driven business than purely tech services. So I think we are trying to position some part of the portfolio there, because my view is that some point of time tariffs will also go. It may take few weeks or a couple of months. Nobody knows. Nobody has a handle. But the risk reward from a price point of view looks pretty favorable.
Okay, by the way, look at the Nifty now, barely 4 points up. So, yeah, the market for today, it looks like it could be giving up gains. We still have an hour to go before the day closes out. So, let's wait and watch. But the mid-cap index is down about 0.5%, and the Nifty is now virtually, it's lost all its gains from the morning. The gains were about 220 points when at the highest level in the morning. Since then, we have slipped quite a bit. The other disappointment, apart from IT for the market, also has been banking and big stocks like L&T and Reliance. A lot of the heavyweights, they have not let that exuberance continue too much on the auto side or on the consumer side. Gurmeet, finally, before we let you go on financials, and we were discussing this with Shriram Finance earlier, and we also heard it from Mr. Sanjeev Bajaj of Bajaj Finance. Bajaj Finserv. It should be good for lenders, but apart from Bajaj Finance, and we're seeing what that stock is doing, anything else that you will buy, hoping for better lending ahead?
Yeah, so we've added gold-based NBFCs. We've added Muthoot to the portfolio. We are looking at Chola also. Some of them better on Jio Finance. Again, it's a disruptor. The kind of yields they are offering on products like LAP, LAS, are actually as competitive as banks, because you get advantage of being a Reliance entity, and I think the lowest cost of funds amongst NBFCs. So I think, and plus obviously they're incubating a lot of businesses which will play out over the next couple of years. So that's something we are adding. And I also think at some point of time, if you have more money in the hand, not everything is spent. Some of it will get invested also. So I think capital market plays have also, I also call it as a consumption theme, because the way Gen Z is hooked on to new age investing. So I think even the capital market plays will be at some point of time will look good. There's been a lot of correction from where they were 20-30%, whether it is CDSL or CAMS or some of the other names.
Okay, Gurmeet, great conversation as always. Good to see you weigh in on markets and, of course, stuff that you like. We'll talk again. Thank you indeed.
Thank you.
All right, we'll take a quick commercial break here. We're going to come back. Our special coverage on the big GST bonanza continues on the other side. Stay tuned.
Welcome back. Holding on to the green line, but just by a smidge. Some stocks holding up are many of the pharma names. Sun Pharma, Apollo Hospitals, Cipla. These are stocks where you are seeing some gains come through. But on the flip side, SBI Life, Bajaj Auto has now dipped into the red, and ICICI Bank is losing ground. Bajaj Finserv too was up close to about 3.5% at its peak. Now it's up only about 2%. Hormus is now here to talk about other stocks in the spotlight right now. Hormus.
Some interesting movers that have been doing the rounds in the broader markets today. And of course, there are names which are mostly linked to these GST rate cuts and rationalizations. Electronic Smart is the first one, 15% higher in today's session now. They've taken the gains to almost 20% now in the last two trading sessions. These are the highest volumes since the stock has seen since June of this year. And we have already had 6 crore shares change hands in today's session compared to a 20-day average of just under 8 lakh shares, and it is also convincingly broken above its 200-day moving average of 133. Although the stock is down around 30% from its peak, it's still up almost 2.5 times from its IPO price. The other one, of course, is Aditya Vision. Was in the news yesterday because of a block deal that took place. There was a promoter that sold stake. Motilal Oswal and Axis were some of the buyers there. And look at the volumes today. 80 lakh shares have already changed hands. Of course, yesterday's volumes were higher because of the block deal, but even today, 80 lakh shares have changed hands compared to a 20-day average of just 1.1 lakh shares. And with this move, the stock is also set to reverse the negative returns that it has had so far this year, which could have potentially become the first negative year for the stock since 2019. The other one is Atul Auto, and that is another one seeing double-digit gains today. 15% higher, the biggest single day gain since April that the stock has seen. But the volumes today are the highest since July of last year. We've already had 70 lakh shares change hands in Atul Auto. The 20-day average is only 54,000. So extremely high volumes seen on Atul Auto in today's session. It's broken above its 100-day moving average, and now that it's crossed the 500 mark, it is also above its 200-day moving average, which is at 492, but still down around 10 to 15% in 2025. And the last one on the list is Bata, of course, footwear names, but it was building up to this move over the last 5 days as well. So this makes it the 6th day of gains for Bata, up almost 17% in these 6 sessions. This is the longest winning stretch that the stock has had since April of 23, the highest volume since December of 24, and 27 lakh shares already traded today compared to a 20-day average of just around about 2 lakh shares. So in very firm grip is Bata.
Okay, all right, Hormas, got it. Thank you very much for all the buzzers of the day. Well, with that, let's move on and keep decoding the implications of these big GST reforms. Sunita Reddy, Managing Director at Apollo Hospitals, is now joining in. Ms. Reddy, thanks so much for being with us. It really is a big, big day, right? And I mean, for your sector as well, healthcare and pharmaceuticals, when there's been a range of reductions, a lot of life-saving medicines. I think 33, I read the notification, 33 have seen a pretty significant price cut to 5%. Some of the life-saving drugs for cancer care, chronic care, I think some of them have come down to nil. And then a whole range of reductions on consumables, like I think, bandages, etc. So much, and medical devices as well. What would your first thoughts be? I mean, what does it mean for the business? How much of this can be passed on to customers? And how much perhaps will help improve margins even further?
I think the first part of it is, it's very important to understand that more than anything else, this is really stimulating demand, putting more cash in the hands of the consumer. This coupled with what was announced in the budget, which was reduction in taxation and therefore more disposable income in the hands of the consumer, has really spurred demand. If we were to look at it from a healthcare point of view, I think this will enable more people to have access to quality healthcare, and the significant incentive that has been given to insurance is clearly a huge differentiator. Moving to nil GST on life and health will enable more people to buy insurance products and for the insurance company to have a larger risk pool. So this should result in a huge access to healthcare, to hospitals, and the industry, I'm sure, welcomes it. The second most important thing is what you've said, that if you look at margins and you look at cost of consumption, etc.,
and something that is good for the patient, which is ultimately what we want. Life-saving drugs moving to zero from 12% is really something that is much needed in the healthcare sector. Balance all medication at 5%, definitely good for both margins and for the consumer. And moving on to think of the detailing in a way that they have done that includes reagents, diagnostics, consumables, bandages. All of this moving to 5% is a saving both in the hands of the consumer and for the hospitals. It should result in an improvement in margins. So the third most important aspect of it is what they've done for the construction. And I think that in healthcare, there are people who are consolidating hospitals, but what we really need is investment in healthcare infrastructure. So this will significantly reduce the cost of construction in terms of reducing the reduced cost on cement, fly ash, granite. These are important components of construction.
Absolutely, yes, they're big.
Yes. So that will result in a saving. In about 2 to 3 days, I think I'll be able to quantify the savings and see the impact on the margin. But I must say that these are significant moves for the healthcare sector.
Absolutely. Ma'am, for things like consumables, gloves, etc., and even the drugs on which GST has been reduced, now that reduction, will it be passed on entirely to customers, or how does it work? I mean, overall, will there be a reduction in hospital bills, or it's too early to say? Some indication of how this might play out.
There'll be both. In the sense that we're at negative GST, so we were never passing on, even we were absorbing all GST. So I think, this, as we attempt to work with insurance and rationalize and create packages, this is a very important component of what could enable us to be more accessible to a larger pool of individuals.
Ma'am, on the insurance bit, it's true that 0% GST on premiums will make insurance on the whole more affordable, penetration will go up, but there is that other issue about income tax credit, ITC, where, you can't claim the income tax credit. Will that result, from a hospital point of view, can you explain what happens? And is that an issue for you as you work with insurers? Is there going to be some sort of an income tax leakage?
No, this is not going to significantly impact us, the income tax leakage. I think it's more in the hands of the consumer.
So overall, Ms. Reddy, which part of the healthcare industry will see the highest benefits? Is it going to be diagnostic chains? Would it be, the drug manufacturers? Or to what extent do hospitals benefit?
Well, I think all across the value chain, you will see benefit. But I just want to end with something. We do not have input tax credit. So all of this in terms of, it's really not, from this, you will not see a huge impact on consumers currently. But as we rationalize input costs because of these savings, I think net we should be more affordable.
Ma'am, for critical treatments like cancer, etc., where medicines are now GST free, what could be the drop in patient bills?
It's at this time a little difficult to tell. Yeah. There's one which is radiation, there's part which is medical oncology and some surgical. But for medical oncology, of course, this is a huge benefit.
In terms of the input tax credit not being available, that's something that obviously the insurance industry is also grappling with to see how they will, deal with this whole situation of being exempt and not having ITC. Is there any ask from the hospital sector on the indirect taxation front now with these big changes having happened?
No, there will be an ask, and I think there's precedent, which is more important. If you look at what is done for education, I think that's a good starting point for us to Normally.
Could you elaborate on that more
So,
specifically?
if you look at education, the services are exempt from GST. For example, all of the contract services, the outsourcing is all exempt from GST, and this is a huge saving. So, if we just follow that precedent, if we will continue to have a dialogue with the ministry to see if we can follow that in healthcare as well.
Okay, all right. Ms. Reddy, we'll leave it on that note. Thank you very much for joining in and giving us a quick perspective on what these GST changes and big cuts mean for the healthcare sector. Thanks for joining in. Well,
I have a fourth reason.
Of why the market's not excited. All right, go for it.
This is not mine. This is somebody sent it to me. I think this is it says now stock prices are quoting without GST. In the morning they were quoting with
GST. So the cut is leading to lower prices, but at least you've got some green back on the Nifty. But going back to the insurance space, I think that's the big hotbed where there's still a debate and discussion on what happens. Is it net positive for companies or not? Well, let's get Yash back in. I think we've got Yash with us. Yeah. Yash has been talking to, of course, a lot of the players since morning, looking at some clarifications that came in from New Delhi as well. Yash, what's the verdict as of now? No ITC at all. So what happens? Positive, negative?
Well, as far as the verdict on the premise itself is concerned, 4 important headlines. GST on individual life and health insurance exempted, GST exempted on the reinsurance cost, and to the point that you made in terms of clarifications which also came in. But what we had reported earlier before the clarifications even came in is that inverted duty structure, the benefits of it won't come to life insurance companies or health insurance companies. Also, the second part, input tax credit benefits won't come as far as life and general insurance companies is concerned, because the category of exempt does not have the provision of input tax credit itself. Now, let's look at the policyholder point of view. How much can the insurance policies get cheaper for the policyholder? Well, health insurance, if the entire benefit is passed on by the insurance companies, could get cheaper by 18% because the GST goes from 18% to the exempt category. For life insurance, the ULIP policy and the term policy, again, the premiums can come down by 18% if entire benefits are passed. Endowment policies could become cheaper by 4.5% because that's the GST rate there. And single premium annuity policy could become cheaper by about 1.8% because that is the GST rate which applies there. What happens to insurance companies? Well, the inference or the conclusion is that the cost for insurance companies on every policy is expected to go up. Why? First of all, input tax credit. To acquire 100 rupees premium, insurance companies spend about 70 rupees as expense. Earlier, which is the current regime, they could take 18% GST input tax credit on that 70 rupees of expense, which won't happen now, and the ability of the insurer to offset that cost goes away. The second reason why the cost would go up for the insurer is no benefits of the inverted duty structure. Only reinsurance get exempted, which is just 1/3 of the total cost. 2/3 is still commission cost as well as claims cost, which still remain. And hence, that cost could come onto the books of the insurance company, both health insurance and life insurance. And the numbers that we worked out and we've spoken to experts suggest that health insurance policies, the cost could increase for the insurer by about 5 to 7%. Life insurance policy, the cost could increase to the insurer by about 9 to 11%. There are 3 scenarios which pan out after that. Either that entire hit on health insurance of 5 to 7% and 9 to 11% for life insurance could come on the books of the insurer. Second thing, the cost could be shared between the distributor, someone like a Policy Bazaar, and the insurance company. And the third and the final scenario is that benefits could be curtailed. Some part of the benefits could be curtailed for the policyholder and some part of the benefit could be passed.
Well, that's exhaustive. Yash, thank you very much for that. And for a more detailed explanation, Yash, you're explaining it in detail on digital, right? On the digital platforms.
That's correct. I'm just ready to do that. So very soon you'll be able to find a detailed explanation on this entire math on the digital platforms of CNBC TV 18.
Okay. Well, be sure to check it out. Thanks very much, Yash, for that. Listening to some opinion we got, right? So we spoke to Sanjeev Bajaj. They run some of the largest life and general insurance businesses. Niva Bupa, a standalone health insurer, and of course, platform PB Fintech. Listen.
Some of the rationalization moves beyond the rate cut should just also help in formalizing, getting more MSMEs to come in, sign up under GST. So formalizing the economy as well. Even the operationalization of the GST appellate tribunal and simplification of structures should strengthen compliance and trust in the system and broaden the overall system. Any such dramatic change in the economy first impacts financial services disproportionately because it ends up supporting or enabling so much of the real economy. And that can work both ways. In this case, naturally, it is the positive step. So there is a hopeful positive move. I would directly look at both. On the consumer side, consumer spends should go up dramatically in the coming quarters. In addition, we have a large lending portfolio to MSMEs. That should benefit as well. You see, the benefit of that ability to set off input tax credit would have gone completely to the consumer. So from that point of view, if we had been able to do that with maybe putting this into the 5% slot, that would have benefited the end policyholder that much more. But we still think that it's a big step from where we were till 2 days ago. And maybe this is something to keep in our pockets for the next time this gets rationalized.
So it is not like one is making too much money or anything of that sort of profit. Terms like profiteering, etc. do not. Which insurance company is making crazy profits? And which distributor is making crazy profits? Right? As a percentage of premium. If the benefit is 18% and the cost is 5% or 10%, a benefit is going to the consumer, is it not? Right? Whatever the industry can afford, it will take.
We're not looking at anything which is, giving on to the customer. We want to give this to benefit to the customer. We don't want to increase premium as of now. We still want to assess this, understand this in terms of what impact it has.
Okay, that's insurers, right? And a whole range of views. And we'll play out sound bites of some of the top auto companies that we've spoken with. You heard from Mr. Bhargav, but so many others a little later. Pankaj Tibriwal is now joining us. He's founder and CIO at Ikigai Asset Manager. Pankaj, good afternoon. Great to have you with us here on the program. Thanks very much. It was going to happen. Now it's happened. Forget about what the market is doing now. It's come off a little bit, but into this event, maybe some sectors had rallied, etc. But to your mind, Pankaj, for the viewer, where does this show up in the biggest, where is the maximum bang for the buck, if I can put it that way? Which stocks, which sectors?
Prashant, good afternoon. I think consumption is something which we have been talking about. And I think directionally, if you look at all the last three events, first was the interest rate reduction. Second was followed by tax rate cuts. And now by the GST rationalization. All is moving towards reviving consumption at the ground level. And we looked at a lot of areas in this consumption because it's a large basket. That where is the maximum elasticity being played in the last 15, 20 years in India? Because we had various cycles across. And we saw that durables is something where is the maximum elasticity and also autos. And if I take you back to 2008, if you remember, after the subprime crisis, government reduced 4% on excise duty. And it was for a limited period. And we saw about 20% CAGR growth across automobile sector in terms of elasticity, which and the volumes went up. So clearly, I believe that in consumption. Clearly, if you look at from a GST perspective, rationalization, staples, yes, you will see some margin expansion playing out, but volume growth is not, we are sure that somebody will start using the toothpaste twice or thrice or 4 times a day because the price has been reduced. But elasticity in some of the other sectors like durables, autos, I think is clearly should be seen over a medium term. I think that's one. Second, our overall thought remains that commodities are in a very sweet spot. And I think this is a completely ignored and under-owned sector right now. And the developments which we are seeing globally has a bearing on this space. Don't forget, for the last 3-4 months, the anti-deflation policy which China has adopted is showing way that the excess capacities in many areas are being shut down or rationalized. And that means that a lot of commodity prices have started to move up. Look at coking coal, look at polysilicon, look at iron ore, and look at the Chinese steel prices. I don't know when I remember that Chinese steel prices landed in India is at a premium to the Indian domestic steel prices. At $520, China is selling FOB. So I believe that commodities is a sweet spot along with cement. And the third sector, which is chemicals, we have been talking about. We saw a worse downturn in the last 3 years, globally in the last 20 years. I think that cycle also starting to take a upturn. And we believe many bulk commodities where China has been a major player for the last decade or so, I think rationalization of that capacities will bode well for many of the Indian chemical manufacturers. So broadly, just out of, slightly out of box, though financials, tactical play on IT remains, consumer on discretionary. But these 3-4 sectors could be a decent one to look at as you move ahead from a medium-term perspective.
So within consumer, which space just to get some of the details out, Pankaj?
Yeah. So on consumer, our preference lies more towards discretionary, whether it be footwear, whether it be retailing, whether it be consumer durable, as we spoke about, and autos, if you include that, and also in consumption. And these are the 4-5 spaces, and you can choose the derivatives wherever you want comfort to be in. But these are the spaces where we believe that elasticity will be the maximum. And you just think about it. If you have saved a portion of your money from staples or any other category, you are likely to consume in low-ticket discretionary items. It could be maybe a pressure cooker. It may be something which you wanted from a low discretionary item purchase. And I think that's the space where we could see, which has been, out of flavor for the last 5-6 years. But I think there the demand boost can be significant as we move ahead.
Okay. Hi, Pankaj. Good to have you on the show today. So, I mean, in summary, let's say, if you are to look at the best, the sectors that will be, best impacted and where, there is still durable upside on stock prices. Now, autos have already run quite a bit. Then there is financials, broader financials. But then unless you are with a lender like, say, Bajaj Finance, no bank is exclusively lending only to consumer per se. So then what's the best play over the next few months?
That's what, Surbi, I said that maybe autos may have run up. But we haven't seen volume growth in two-wheelers and four-wheelers for a long period of time. The two-wheeler volumes are still below the pre-COVID levels. And I believe that once that monthly numbers start to show some growth, I think markets could get a bit excited on those names. And obviously, then there is an entire auto ancillary play below that, which has not moved to that extent as we speak. And I think that's something which which could be an interesting play as you move ahead.
But you're saying so more optimistic on two-wheelers than four?
Two-wheelers, both. I think both of them are good.
Okay.
And auto ancillaries along with that, which kind of favors that. And also consumer discretionary, I mentioned, Prashant, a lot of sectors where after saving, you will like to spend on those consumer low-ticket purchases. I think that's another area where we are positive on. And the third, and the three sectors where I mentioned, which is metals, cement, and chemicals. I think there the macro thought is that globally inflation will be back in action very significantly. As countries build out their infrastructure, their factories, you need metals. And overnight, you can't open a mine. For example, US, if you look at, in the last 15 years, copper production has halved. And now for everything on electrification and other things, you need copper. Where will you get copper from? So there will be a demand-supply imbalance in many commodities as you move ahead in the next 3-5 years. And China is shutting down excess capacities in the last 4-5 months, whatever action the government is taking. And I think that bodes well for the overall commodities, cement and chemicals.
Okay, so I think we've done a fair amount of discussion on individual sectors. Before we let you go, Very quickly, overall, the market, Pankaj, of course, individual stocks are moving and it has been a stock-specific market. But at an index level, the struggle continues. Do you see that changing maybe as we get into the festive season?
Maybe in the near term, market may remain sideways, Surbhi, but I am not so negative on the markets. I was at the conference at last 2 weeks at various conferences, meeting a lot of my counterparts globally, locally. I think the mood is of pessimism today. But when I look at the rate of incremental change across, I think it is only going to be positive rather than negative. Whether it be earnings starting December quarter, you will see a rate of change being higher than what we have seen in the previous quarters. Whether it be on the tariff issue, I think the move could be positive rather than negative. And from reform perspective, and don't forget, India works when there is crisis and government is doing all the right steps, starting with GST rationalization. And we expect that more reforms should follow over the next couple of months. So the rate of change, which I think is very important in the marketplace, is going to be positive. And hence my belief is for the near term, markets may consolidate sideways. But once earnings from December quarter onwards starts to come in, I think markets can start to move northwards from there. So I'm not so negative on overall market per se. And you know that we were cautious till Feb, March, then our view changed. And from here on also, I think stock-specific movements will be there. Easy money is behind us. Let's be clear. The fest which we saw for the last 4-5 years is not going to be there. It will be a stock pickers market, but from December onwards, I think index should also start seeing to move higher.
Absolutely. Pankaj, thanks very much. Good speaking with you. It's always a pleasure to get that sort of framework and how you're thinking about markets from here. We take a quick commercial break here. What are the buy and sell ideas in the short term? Our technical experts will be joining in for exactly that. And of course, we're going to come back and tell you the market buzz on D Street Chatter. Stay tuned.
Welcome back. It's a bit of a damn squib in terms of a close now. We've got about 30 minutes left and the Nifty is at 24,750. But let's find out what the F&O cues are. Manglam's at the F&O desk. Manglam.
Well, the markets are off the highs, and that's something that we can see. The Nifty Bank in more pronounced decline is that what we've seen in the mid-cap end of things. Over the last few trading sessions, the mid-caps were actually doing a lot better. But today, after I think 3 or 4 trading sessions, we have more decliners than advances in our market. So in the broader markets, if you look at it, 0.2% lower for the mid-cap index and way more number of stocks which are declining versus the number of stocks which are advancing. That's the crisscross lines which are suggesting right now. But what's interesting is the bunch of levels that we have to watch out for. Today's high on the Nifty, 24,981, absolutely in line with the 50-day moving average, which was at 24,979. So that's where we found resistance. Thereafter, we went all the way lower to closer to 24,700, and we found some sort of support at the 20-day moving average, which was 24,695. And where we're at right now is the 100-day moving average, 24,750. So staying above 20 and 100-day moving average would be extremely crucial for us to go ahead and conquer higher levels, which were closer to 25,000. Top gainers in the cash market include some of these electronic sellers. So we have Electronic Marts India and Aditya Vision, both of them doing extremely well. But psychologically, the 25,000 mark on the Nifty seems to be a bit of a resistance. That's what call writers who are, betting on expiry for the next Tuesday are placing their bets on. 25,000 call has seen a fair amount of writing, premium of 180 rupees. 24,900 call as well is equally active, equating with today's high. So between today's high and 25,000, there could be some supply coming in. But at lower levels, there is support, which is why the 24,800 put writers are equally active as well. Between 24,750 to 24,700 is where support is seen for the market. So a lot of long positions added on names like M&M, Britannia, Colgate. Basically, the ones that stand to benefit from the GST rate cuts are the ones which are fairly well bid in today's trading session.
All right, Mangalam, thank you very much for that. That's the F&O stat as things stand right now. Mitesh is back with us. Mitesh, welcome back. How are you looking at things? I mean, still there, right? It's kind of fizzled out a little bit, and just 20 points. What are the trades?
Prashant, I think on the stock side, I have what one buy and one sell. Info Edge is turning negative. All the intraday charts are, seeing negative crossovers. So STVT here. Keep the stop at 1345. Look for targets of 1310. And on the positive side is Jubilant Foods. That started the day where it's come off the day's high, but I think the overall setup is still on the positive side. So would suggest a BTST with a stop below 649.5 for targets of 665.
Okay, Jubilant Food, right, is the call. By the way, market breadth is completely turned around, right? If you want to just, Mitesh, I want to just ask you 2 or 3 of these names. Ola Electric, if you can put out, it's down 6%. Of course, it's up 50% in the last 1 month or so. But Ola, on the way up, used to have the biggest volumes. On the way down, it's got the biggest volumes. Paytm is down about 4%. But it's also had a bit of a one-way move recently. I mean, Force Motors, I guess, don't even ask. It's even after today's pullback, it's up 180% this year, 2025. But it's down 8.5%, meaningful cut today. Garden Reach is down 4%. JSW Cement is down 4%. That's, of course, the recent listing. TBO Tech saw a massive move. They announced an acquisition. Stocks at the same price where it listed a couple of months back. TBO Tech is down 4%. Delta Corp, I mean, some of these are just pure reversals. Delta was up. It ended for some reason 12-13% higher. It is down 8% right now. 87-88 rupees on Delta Corp. Bajaj Consumer is down about 4%. Oswal Pumps is down 4%. Again, a recent listing. Zuari, there is Renuka Sugar. Idea Forge is down 4%. And so on and so forth at this point in time. 1,800 stocks are lower. And you got about 1,230 stocks which are higher at this point in time. So it's basically flipped along with the rest of the market that we've been reporting. Let me now actually toss it across to my colleague Shireen, who's with a special guest. Shireen, over to you.
Well, thanks very much, guys. As we continue our conversations on the new GST regime, joining us now is Rajiv Memani, the president of the CII. also the chairman of EY India. Mr. Memani, always a pleasure. Many, many thanks for joining us here on CNBC TV 18. I know you're traveling, so appreciate you taking time out to be with us. You know, the day that you took over, this is the conversation that you and I had. Are we ready to usher in a new GST? And it certainly seems to be now a reality. Your first reactions on what the implications and the impact will be for the economy in the near term, but more so in the medium to long term?
Yeah, I think, Shireen, thank you for inviting. Always a pleasure talking. No, I think, listen, this is probably something the industry has been talking about for a long time. We had the corporate tax reduction, which was quite significant. Then we had some personal tax relief in the recent budget. And, the industry felt that the full consumer uplift is not coming, especially in sectors relating to FMCG, food, and urban demand in particular was slowing down. So there was a lot of requests to see if there could be GST rationalization that happens and some GST rates are reduced. The second was obviously because of the 4-rate structure, there were always classification issues and things like that. So that was also creating confusion. Then we had lots of inverted duty structures. So GST has been one of the best reforms that India has done, but it needed another refresh. And honestly, the speed at which the government has done it and the intensity with which they have done it, and even the rate structures that they have devised, not only just reducing rates for a lot of these items, but also corrected inverted duty structures, also ensured registration had become easier, also ensuring that provisional credit for inverted duty structures was available. So at least refund process can be speeded up to a large extent. For e-commerce companies in particular, registrations for the sellers, resellers, registrations, just at one place and not multiple registrations. So I think this is not only from a rate standpoint, does it give great impetus to the economy, but also structurally, I think it's something that they've tried to address quite a few things challenges that people have been experiencing. I think this will have a very positive impact on the economy for two reasons. One, I think the Prime Minister on 15th August, when he announced this and he also talked about this is the time for India to reform and all kinds of reforms. So I think hopefully this is the first one in a sequence of reforms that one sees, which definitely augurs very well for economy, for GDP growth, and for the overall strength and resilience of India. So I think in that way, it's very positive. And secondly, obviously, the economic impact. I don't know, we've not done the exact number, but my guess is roughly 1 lakh crore odd would come in the hands of consumers to spend incremental amount of money. And that's a big relief that the government has given. And, this is a virtuous cycle. You have greater sales, you have better capacity utilization, you have got greater capex spend. So the multiplier impact of this will be quite significant. So I'm very positive that the changes will come through. By when will it come through, Shireen? I think it will obviously 22nd September is when they're saying by the time things actually start. And this is at the perfect time because this is the prime time as far as consumer buying is concerned. And as things progress and there are some issues as the inventory clean out happens, inverted credit gets clearer. The pricing, it's very important for industry to ensure that the pricing advantage passes to the consumer. And as soon as that happens, the benefits should start trickling in. So I think any time in the last quarter of this calendar year to early next year, we should see benefit coming through.
Yes, several points that you mentioned there. But, Rajiv, if I were to pick up on what you mentioned, and we've sort of started to see this theme play itself out, starting the budget with the income tax cuts coming in, now with the GST cuts announced by the GST Council. Consumption seems to be something that the government is focused on. To take forward that sequence of reforms theory that you were building on, if consumption is in fact now being prioritized, what could then be the next set of reforms? What has been the discussion and the dialogue between industry and government on what could perhaps spur consumption further?
Yeah, I would say the government has definitely, obviously it also addresses a large part of India which feels that they don't have enough money in their hands to spend. And as you have seen, Shireen, the revenue neutral rate that has come will be below 10%. So you have low corporate tax rate, you have low revenue neutral rate, you have some relief on the personal tax side. So I think that piece of the equation is honestly, yes, you can continue to ask for some procedural ease and some other things here or there, but I would say that part of the equation has been very well taken care of. In terms of next set of reforms, which will create, if you look at government's agenda is to create greater economic activity in India, ensure that India is more self-reliant than it ever was before, that if you look at those two themes, which means to encourage greater business activity in India. On doing business, I'll break this into three parts. On ease of doing business, as you know, Shireen, there has been a lot of work that is happening. It is being led by the highest levels in the government. They're engaging both with the central governments and with the state governments. They're seeking active feedback from the industry. They have also got a team of people who are benchmarking each states on various approvals, consents that are required, whether it's for land, for labor, for environment, for NOCs and others. And hopefully we see, and we are seeing some early signs, and hopefully we see signs of implementation of that. Some of them have to happen at a central level, and a lot of them have to happen at the state level. So hopefully the willing states and who really care for greater economic activity in their state should be the first ones to adopt some of these changes, because it will make them significantly more attractive and competitive. The second, after ease of doing business, is factor reforms, which will really lead to reducing the cost of doing business. And there I would say land, labor, power, logistics, these are some of the important ones which the government is focused on. If I have to pick up one or two, I would say power is one area where there is a lot that can be done. And especially if we are looking at bold reforms, then the industry has definitely made the point of, we have to reduce the power cost for industry. You cannot have a 50-60% cross-subsidization load as it is in some very progressive states. And the only way out of this is either to encourage privatization in states, or to look at issuing second licenses. And over a period of time, reducing the cross subsidization, at least for manufacturing, and I think that will have a big impact on the power competitiveness. Also, how we facilitate captives and ensuring that captives also don't have to incur that load, because it's, once the tariff barriers come down, as they will come down.
Okay, that's a view from EY. We also spoke with Shailesh Chandra, president of SIAM, the Automotive Association. Here's what he had to say about the GST reforms.
For auto sector specifically, we are seeing across the categories, there has been a significant reduction in GST. The 28 to 31% bracket rates have come down to 18%, and then 43% to 50% brackets have been brought down to 40%. So I think not only the reduction, but also the timing is perfect, just ahead of the festive period. And therefore, I believe that this will have a significant impact on the demand, which will be extremely favorable. So overall, I think, it's a significant move, and this will have a significant demand creation and generation for the auto industry in all the categories. I'm sure that, it will be much better than that. But what will be the real size of this increase is something which, among all the members in SIAM, we'll try to size this increase in the coming weeks. And then I'll be in a better position to really say to what extent the demand will increase. But definitely from the earlier projection, things should be much better.
Okay, that's the opinion coming in on GST landmark reforms, but the market doesn't seem very excited. The mid-cap index is extending its loss now down nearly 450 points. Let's find out actually what the mood is across dealing rooms and why we're seeing such a subdued reaction to these policy positives. Nimesh is now joining in with an insight. Nimesh.
Hi, Rimana. So first, to talk about your point of why the market is a bit disappointed,
I spoke to a lot of investors today, and the feedback seems to be that 90% of what was announced last evening was something which is anticipated by the market. So market was more looking for where the disappointment seems to be, or which was not a big surprise for them. So there were really few pockets where either there was a big surprise on the upside or a bit of disappointment. So I guess that's the reason why you're seeing a bit of profit booking in the FMCG names, and in general there has been a profit booking is what I sense in the FMCG basket. And even in the FMCG basket, Rima, the feedback seems to be that it's not going to be easy to gauge as to which segment will do well in the very near term because of this GST rate cut. So it's a huge market. It's a complex market, right? So it's not very easy for anybody to get a sense on which FMCG companies or which segment should do well. So that's the overall feedback from what I understood talking to a lot of investors about the GST rate cut and the potential impact. Overall, from a market's point of view, a bit of profit booking, I would say, and in general, we've seen a bit of selling pressure from the larger FIs. So that's been the trend in today's market as well. But it's the insurance leg or the domestic leg which is still putting in money, and that money seems to be flowing into some select pockets. But I guess today's GST story and the FMCG story seems to be a bit of profit booking, and because there was a bit of anticipation which was there in the market that these are the things which are likely to come. So I would say more of profit booking than anything else, especially for the FMCG basket.
Yeah, no, absolutely. Seems to be the case. Nimesh, in terms of individual names, what's on the radar? What are you picking up?
So, okay. So in terms of individual stocks, Prashant, the first stock is Prime Focus. That's been, been buzzing in the last few weeks. In fact, there was a large block 2-3 weeks back, and since then you've seen a bit of re-rating. Now I understand there could be another large block deal in Prime Focus very soon. So that's a big buzz as far as Prime Focus is concerned. The second stock is Indus Tower. This is interesting. While the stock is corrected sharply on that reports of or on the board prima facie approval of going to the Africa market, some smart investors, including mutual funds, one or two large family offices, they have actually bought in the last 2 days of dip into Indus Tower. And again, the biggest concern for the investors has been the deferment of dividends. So in case there is some clarity on that, maybe you see a bit of reaction. But there has been genuine buying on the downside by some mutual funds and market investors in Indus Tower. The third name is Tega Industries. It was part of my charter list a month back or so, and stock has seen a bit of reaction as well in the last few days and weeks. I understand there is a very large corporate development which is down the corner, and the feedback is that maybe you'll get to see that announcement coming very soon in Tega Industries. So that's the news there. And the last one is Axis Kids. Again, a mid-cap name, but been consolidating a very narrow range post Q1 numbers. But now even in Axis Kids, there is an indication that maybe you'll hear a corporate development. A potential joint venture with the Middle East company is the buzz as far as Axis Kids is concerned.
Nimesh, on Prime Focus, I think there was Standard Chartered which held a large chunk for a long time. I'm not sure, it is that block which is now getting transferred. Is it that chunk?
There was one. No, so there was one large block where Standard Chartered was a supplier, was a large seller there. But I understand even beyond that, there is one large FI investor who could be a potential seller. So that block can come, is the sense as far as the market feedback on Prime Focus is concerned.
Okay. All right. I have more questions, but no time. So maybe later. Thanks very much, Nimesh, for that. That's an interesting list. We'll take a quick commercial break here. More market conversation on the other side. Ambarish joins us. 9 minutes to close.
Welcome back. Just counting down to close. Ambrish Baliga is joining us on the last leg of this show and the hour. Ambrish, did you make any purchases today? What would be your best big GST bet?
One big bet is Mrs. Bector's food specialty because they are one of the biggest beneficiaries of this GST reduction. Basically into biscuits and bakery products, flagship brands like Cremica and English Oven, decently large range of products. In North America, North India, they are number 2 in mid-premium and premium biscuit segment. And in West and South, they are increasing footprint. In East, Kolkata, they are setting up a new facilities so Eastern market should also pick up for them. Health-focused offerings are also gaining traction. And when we talk of QSRs like McDonald's, they are the exclusive suppliers of buns to them. And they also supply to Subway, Burger King, as well as KFC. For Cadbury's, they manufacture Oreo biscuits and Choco Bakes. And from an export perspective, one of the leading exporters in biscuits, 12% of the total biscuit exports from India is from Mrs. Bector's. Dubai, again, they have a subsidiary which is building the base for the GCC region, which again is a very large market. So overall, I think we should see consistent growth if we talk about the next 2 to 3 years. So expected EPS for FY27 is 32, and my target price is 1760. But the stock has moved up quite sharply today, so I think one can buy at these levels partially and then wait for a correction to buy more.
One stock which is spiking right now is Eternal. We know QSRs would, there is broadly a lower rate on dining and takeaway, but I think the way to play it is Eternal, the platform play. Look at Eternal spiking up towards the close of trade. But on the flip side, Dr. Reddy's, HUL, Nestle are just seeing some more profit booking as we wind down today's trading session. So Mrs. Bector's is one. Anything else in the textiles, in the footwear space that you like?
Footwear again, Bata has moved up today decently well, but then if you look at the products, I don't know how much real benefit they'll get because they don't have too many products at the lower end. So again, Bata, if it moves up because of this, could be a good profit booking opportunity. And as far as FMC is concerned, still bullish on stocks like HUL, Dabur, even something like a ITC, because if you see cigarettes is status quo for a while longer, and then finally when the 40% GST kicks in for cigarettes, it will be lower than what they're actually paying as of now, which is close to about 54-55%.
Okay, all right, Amrish. Well, thank you very much for all the inputs today. We are down to the last 2 minutes of today's trading action, so let's quickly wrap this up. It's been a historic day in terms of the reforms for the market, though it could have been any other session, because final count, Nifty is going to go home with just a 20-point gain. So what was a 220-point gap up in the morning ends with just about a 20-point up move. The mid-cap index is negative. It's down about 0.6%, and the advanced decline ratio is also negative. As you can see there, there are over 2,000, on the BSE that is, over 2,400 stocks declining on the NSE. Over 1,700 stocks on the declining side. Anyway, let's talk about what was green on the large cap screen. Mahindra & Mahindra retaining a bulk of that morning pop, 6% up. Bajaj Finance, 4.2% higher. Apollo Hospitals, 2% up. Bajaj Finserv, 2%. And then a bunch of FMCG names, Nestle, ITC, on the consumer side, even Trent, Eternal, some names over here. But after that, the move fizzles out. Actually, the Nifty's gains were retained thanks to two big banks, HDFC Bank and ICICI Bank, both on the green side. Otherwise, maybe we would have lost that little bit of green. On the flip side, HDFC Life finally is ending with a cut of about 3%. Remember, they don't have input tax credit. It's become very, very clear. Maruti, perhaps stock had already run up. So today was a day of profit taking, 2% lower. And then you had the biggies, Infosys, Reliance, stocks like L&T. They didn't really contribute, leading to what was not a lackluster close as we're getting to the bell.
Well, the mid-cap index ends with a cut of more than 350 points. On the way down, you had Delta, Ola Electric came in for profit booking. JSW Cement ends with a cut of nearly about 4%. One MobiKwik again, a big mover. Earlier this week, the stock is up nearly about 30% over the last 3 trading sessions. Today, a bit subdued in trade. And even stocks which were beneficiaries of the GST cut, like a Campus Activewear, came under pressure and ends with a cut. Other insurance names like ICICI Pru weak in trade. On the way up, Bata, Aditya Birla Fashion, Avenue Supermart, Electronic Smart, NetWeb, Atul Auto. These are some stocks which stand out in terms of the gains.
Okay, I think we are done for the day, right? The well went off. 24,740 is where we finally closed, which is about 25 odd points higher. So, yeah, I mean, off the highs by quite a bit. Almost, 200 points off the highs on the Nifty from where we started in the morning. All right, I think we're going to wrap up on this edition of Closing Bell from all of us here. It's goodbye. Thank you very much for staying with us. Markets Forward will do a recap of course, what happened during the day. And, of course, the big GST-related sector-wise implications with our research team. Stay with us.
This reform is not just on rationalizing rates. It's also on structural reforms. It's also on ease of living. Rate rationalization, of course. We've reduced the slabs. There shall be only 2 slabs. And we are addressing also the issues of compensation cess. Ease of living, simplifying registration, return filing and refund.
From a macro standpoint, especially ahead of the festive season, 2 sectors that did well today, consumption and autos, both of them telling you that this is a mega boost for consumption in the country.
Absolutely, and that has been the story ever since the Prime Minister's address, right, on the 15th of August on Independence Day. And since then, these are the 2 sectors that have been dominating the proceedings when it comes to the markets as well, even though the benchmark index has done precious little. But if you look at the Nifty FMCG index or the Nifty Auto index, both of them have seen very healthy gains. And come the 22nd of September, tax rates will be lowered for many daily essentials, small cars, scooters, cement and several other items. And the Lal Street reacted positively to the new GST regime before profit booking in late trading session. Of course, it was the auto stocks that have been the dominant factor ever since the last 3 weeks, and they hit the highest level in nearly a year. Mahindra & Mahindra hit a record high as well today. The GST cuts on small cars and bikes has lifted sentiment for a lot of these stocks. Sudarshan is here to tell us which companies are set to benefit from this change in the automotive segment.
One sector that has come out as one of the major beneficiaries from GST Council outcome is the auto sector. So what are some of the major takeaways? First, GST rate has been reduced across the segment. Second, compensation cess or say GST cess goes away. Third, effective rate for even 40% slab would be lower than the earlier tax rate. Fourth, small cars, most selling bikes and auto parts will now fall in 18% slab versus earlier tax rate of 28%. Fifth, tractor and its parts will now fall in 5% slab. And sixth, EVs will remain in 5% slab. So which all companies would benefit the most? So first talk about small cars. So companies that would benefit the most are Maruti, followed by Hyundai and Tata Motors. Second, for bikes up to 350cc, the biggest beneficiary would be Eicher Motors, followed by Hero MotoCorp. Why would Eicher benefit the most? Because almost 90% of its total domestic volumes have bike with capacity of up to 350cc, exactly 349cc. Only 10% of its domestic volumes fall in the capacity that have more than 350cc, for which tax rate is increased to 40%. So it's a minor negative, but overall it's positive for Eicher Motors. Next is tractor. Biggest beneficiary would be M&M and Escorts Kubota. Apart from tractor, M&M would also benefit from SUV. Despite its best-selling SUV, that is XUV700, is being moved to 40% slab because effective tax rate will now be 40% versus earlier effective tax rate of in the range of 43 to 50%. Next is three-wheelers. So biggest beneficiary would be Bajaj Auto and TVS Motor. Next is tires. So Apollo Tires, MRF, Seat and Balkrishna Industries. Balkrishna Industries will also benefit because it's the supplier in the tractor segment, and tractor tires will fall in 5% slab. And last is auto parts, and biggest beneficiary would be Endurance Technology, Bellrise Industries, Sona BLW, Motherson and Carraro. So now after the GST Council outcome, the hope would be that if industry sees an increased demand and if we see an increased estimates for FY26 from current estimate of single-digit growth.
So Darshan, thanks a lot for that. From autos, let's talk about the consumption space. It's been very clear from the finance minister's statement that they want to boost consumption. On the one hand, you had the income tax cuts that came by in the budget, thereafter the RBI cutting interest rates as well, and now the GST rationalization specifically on daily use items like soaps, shampoos, hair oil, toothpaste, toothbrushes, biscuits, etc. All of them down to about 5%. And for a lot of the dairy products, the 5% slab has been moved lower to about 0%. And a lot of the paneer products, etc., moving down from 12% to 5% as well is a big positive, which is why we saw that big gain come by in the likes of HUL, Colgate, Britannia and the likes. The only stock which ended lower was Varun Beverages, and that too because it was expected that something like an aerated beverages, etc., would go all the way up to 40% from 28%. Does that mean your cola gets expensive? No. It only means that earlier it was 28% plus cess, but now that cess has been subsumed, all you have to pay is 40%, which is pretty much in line with what these companies were paying already. Bikaji, for instance, had namkeen, bhujiyas, etc. Nearly 90% of their overall portfolio now stands at 5% taxes, and they said they would see increased volumes to the tune of 3 to 5% on account of this rate rationalization. Does this also mean that you have to scamper for change every time a 5 rupee product has become 4 rupees 50 paise? No, that's not the case. India is a price point market. What these companies will go ahead and do is keep the price points at 5, 10, 15, 25 itself, but give you a little more bang for your buck. So you will get more grammage for the products that you buy at the price points that you buy, which also means it is volume positive for a lot of these FMCG companies. So all things said and done, this is a massive boost to all things consumption, and that's something that we've seen in the stock prices as well. Yes, there was some bit of profit baking today, but that's ahead of all the up move that we've seen after the Prime Minister's speech on the 15th of August. So it is 2 thumbs up to consumption, and the stock market reacted accordingly.
2 thumbs up indeed, and 2 thumbs up also in hopes that the wafer packet will now have more wafers in anticipation of what we pay for at the end of the day. Mangalam, thank you for that update from the FMCG space. The other one that was in focus, of course, was the textile and the apparel industry that will also benefit, as key inputs and finished products will now fall under the 5% tax slab. And Vinny is now here to take us through the impact of this move on a lot of these textile companies.
Thanks so much for that. So yes, surely a GST boost that is coming in for the textile and apparel players, because previously these players had multiple rates, right? There was 5%, 12%, 18%, 28%. Now it's coming to 2 unified rates of 5% as well as the other rate of 12% is what we'll keep an eye out on. What does this mean? Rate reductions will lead to lower procurement prices for textile players, especially in terms of key inputs. Now, inputs, whether you look at in terms of the value chain of yarn, whether you look at in terms of the threads that are made as well, all these will see a reduction. Man-made yarn, 12% to 5%. There was man-made fiber, that is from 18%, it's coming down to 5%. A unified rate now of 5% for most of these input products, which is positive for them as well. Now, other than that, finished products also are seeing a cut, right? 12% to now 5% is what's coming at. Bath linens are the products, carpets, rugs, all these finished products from textile players actually come into the 5% range now. Let's talk about apparels. Apparels, now we're saying that GST of 5% will be on apparel products not exceeding 2,500 rupees per unit. Previously, this 2,500 rupees was 1,000 rupees. So an increase in terms of that rate, that is what is coming in, right? So 1,000, now it's moved to 2,500 rupees, and a lot of companies will benefit from this as well. Some of the beneficiaries from these changes will be Wellspun Living, Indocount Industries, KPR Mills. Other than that, we also have Gokul Das Exports, Vardhaman Textiles, as well as Nitin Spinners among some of these gainers. And obviously, these unified rates is something that will give a boost in terms of the demand for the companies as well.
Right, and that's not all, Vinny. In fact, we also had a shot in the arm for consumer durables. All the large screen TVs will now be charged at a much lower rate than earlier. And in fact, a lot of the other white goods as well, the likes of dishwashers, etc., would become cheaper. For that list, we have Upasna joining in. Upasna.
Big consumption boost announced by the government with the onset of festive season. Let us look at the key categories that will be in focus on the back of GST rate rationalization. Now, categories like ACs, large TV, dishwashers, here GST has been reduced to 18% from 28%. While on solar water heater, the GST is reduced to 5% from 12%. Now, lower GST directly stimulates demand for ACs and large TVs, expanding the market size for domestic production. Now, Elara Capital believes that on AC, RAC demand may rise minimum by 10 to 15% on the back of this. And it feels that the RAC OEMs like PG Electroplast, Ember Enterprises, EPAC Durable may see a spurt in volumes in the H2 FY26 onwards. On TV, the brokerage believes there is no direct beneficiary, but Dixon Tech assembles TVs for numerous brands in India and may see volume growth in H2 FY26. On solar water heater, the brokerage believes it is a growing market in India and key beneficiary here would be V-Guard and Havells. Coming to dishwashers, it is still a nascent category with an estimated market size of 700 crores. And the key beneficiaries here would be Voltas Beko and IFB Industries. Now, Blue Star believes that company was initially expecting a 15 to 20% growth this festive season, but on the back of this, it now expects a 30% growth thanks to GST rate rationalization. So overall, it's a positive move for consumer durable sector.
Upasana, thank you for that comprehensive wrap for the consumer durable space. The other major pocket that made headlines all through the day was insurance, and that is the individual health and life insurance is now exempt from GST. But the industry fears that the costs will rise without benefits under the inverted duty structure and the input tax credit. Yash is here with all of those details. Yash, over to you.
Well, Hormaz, let me just take you through the key headlines. As you said, GST exempted when it comes to both life insurance as well as health insurance. And as far as the reinsurance, which goes behind life and health insurance. Which categories under life insurance will see the exemption of GST? This would be term life insurance products, annuity products, ULIP policies as well as endowment policies. Which categories under health insurance? These would include your general health insurance as well as family floater. Now, two important caveats which came and which we have been reporting for quite some time now. First, there will be no benefits of ITC or input tax credit on when the GST moves to exempt category. Second thing, there won't be any benefits of inverted duty structure which insurance companies will be able to derive once the GST goes into exempt category. Now, what does it mean for policyholders? Well, certainly benefits will come for policyholders in terms of lower premiums in a situation where insurance companies pass on the entire benefit. For health insurance policies, the premiums could come down by 18%, which would be the cut from 18% to exempt category. For life insurance, two categories, ULIP as well as term life insurance, the benefits could be to the extent of 18% for policyholders. For endowment and single premium annuity policy, the benefits could be of about 4.5% to 1.8% because that's the current rate of GST on these policies. What does it mean for insurance companies? Well, the cost for insurance companies is expected to rise. First one, the reason being that there is no input tax credit available, which means on 100 rupees premium, if 70 rupees was the cost, the insurance companies could offset that cost by taking input tax credit, which now won't be available to them. The second reason, no benefits of inverted duty structure. Well, commission costs, claim costs, the inverted duty structure hasn't been corrected, which means that cost will come onto the books of insurance companies. Well, we've been speaking to analysts and working out numbers ourselves. The cost of health insurance policy for the insurance company could go up by 5 to 7%. For life insurance, that cost could go up by 9 to 11%. There are three scenarios finally which come out of it. First thing, the insurance companies could take this cost on themselves. The VNB could get impacted negatively. Loss ratios could increase. The second scenario is that they could share this cost with the distributor like Policy Bazaar because commission is not under the inverted duty structure or exemption category. Finally, they could partially pass on the benefits to policyholders and keep some to themselves. These are three scenarios that we're looking at, but certainly a big positive for policyholders as premiums expected to come down, not so much for insurance companies as the cost would go up.
All right, take that point, Yash. Thank you so much for that. With that, we'll take a short break. Now that we've told you all that needs to be known about the GST rate rationalization as a consumer and as a viewer, but importantly as an investor, how would this impact the markets? How should this impact your portfolios? What investment decisions you should make basis the announcements that have come by? Shreyas Devalkar, who's the head of equity at Axis Mutual Funds, joins in after this short break. Stay with us.
Still with us here on Markets Forward. As promised, Shreyas Devalkar of Axis Mutual Fund is now joining in. Shreyas, thank you for sparing time and joining us today. You heard the gamut of announcements that were made by the GST Council. You also heard our colleagues break it down for our viewers as well. Now, within this entire GST basket, be it FMCG, consumer durables, automobiles, insurance, where does your preference lie, and where do you think that investors should park their money or put money to work as of now? Because a lot of these moves were already priced in for a lot of these sectors over the last couple of weeks.
So, first of all, we should look at this development as a holistically. What it does is simplification of tax structure. It actually has, in the process, it has reduced tax on most of the items, and especially the items which are going to 5% category. Now, if you start looking at if there is a 5% GST, and if there are sectors, companies, where there is a competition from unorganized sector, and now suddenly versus that, now you're at 5% GST versus a 12% GST. So there are multiple such benefits wherein this kind of GST structure is going to benefit both because of simplification, both because of market share gain to some of these sub-segments. Now, coming to which category, per se, obviously, you have highlighted in your analysis the beneficiaries, which are obviously there in the automobile, then they are in the consumer durable, they are there in consumer staples as well. So the beneficiaries are going to be there everywhere. But point is that since it is going to be passed on, and one need to look at that where there will be the elasticity of demand. Such to give example, there is an insurance as well. But now whether there will be elasticity of demand in there, that one need to really check. Because some of the products are push products, some of the products are not. So there is more likelihood that elasticity of demand especially may come in the discretionary items more. Because in the staples category, some of these categories are highly penetrated. So it may or may not result in higher elasticity of demand based on the volume growth. While in case of consumer discretionary, yes, that has observed, historically it has been observed that there is some role it has to play. The pricing has some role to play in that. So I would look at from all these perspectives. So one is market share gain for organized. Second is elasticity of demand, where it is actually playing.
Right, so elasticity of demand is very high in some of the low ticket consumption items, and that's something that we saw in a couple of these stocks that did well today as well, the likes of Colgate, Britannia, etc. But mind you, these were stocks that were beaten down post their first quarter numbers as well. So it's not that they had already been doing well. Fundamentally, the performance was fairly weak for Britannia as well. Case in point, the volume growth was just about 2.5%. Do you believe that this rate rationalization holds the key for their volume increase from here on? Yes, margins will not improve because all the benefits will be passed on. But because it's so price sensitive, it may be volume positive. So to that extent, would you bet on any of these staples names because of what has been announced?
So it doesn't, your question actually doesn't get restricted to these. So if you look at even the auto growth was low, it was not that auto growth was high. Even cement growth has been subdued for some time. So whether this cut per se, and now if you look at the holistically the number and the kind of stimulus we are talking about, broadly from the central point of view, it is a 50,000 crore stimulus, including says it is additional 1 lakh crore. Then per se, this need not be the only reason to believe that there is going to be a sudden uptick in demand. So I think similar question came when there was a tax rate cut as well, and that was somewhere around 1 lakh crore demand boost, which actually government gave during the budget time. So one should look at this cumulatively and it impact panning out over next few quarters. So cumulatively in the sense there is a tax rate cut, there has been easy liquidity. Now there is this additional 1.5 lakh crore of additional stimulus, and this cumulative impact of this, along with the base effect of actually we have seen subdued growth for some time in some of this category. This combined impact, and then there is obviously the good monsoon which we are seeing now. This combined impact one should look at, and it's that impact may come in 1-2 quarters down the line. That's how I would look at it, rather than only because of the GST.
One such sector also about the elasticity of demand has been cement as well. You read a couple of brokerage notes that were mentioning about this. But for a sector like cement that hasn't done much over the last, say, year and a half or so, and now you are heading into the festive season where possibly there are hopes of demand picking up now that the monsoons will also head to an end. Does this GST rate cut also further add to the demand boost that is anticipated, thereby boosting volumes and then thereby boosting the financials of a lot of these companies?
The cement sector companies, actually, most of the companies' financials are good in this cycle so far. Most of them, obviously. In the context of the demand boost, actually, the cement demand is not too much dependent on the prices per se. So this GST rate cut in itself may not lead to cement growth as such, because cement is just one of the component of end product, whether it is a house or it is any infrastructure project. So here the demand, to expect that the demand will go up, volume growth may increase just because of this, is not the right expectations to have.
All right. And what do you make of the markets in general? Because, even as we are bombarded with good news after good news for our equity markets, be it, record SIP flows, be it something like the GDP data that came in, even the auto sales weren't particularly bad. There is the festive season ahead, and now there is the GST rationalization that has come in as a booster shot for consumption. The market's struggling at higher levels. In fact, even today it ended off the highs. So what are your thoughts on the market positioning right now? We've been underperforming the globe. So what explains this, and what do you think could change the triggers for us?
So one key factor here is definitely valuations that we should not ignore. The fact, see, we are sitting on a 3-year rolling return in mid and small cap of 23-25%. So in the large cap also, these rolling returns are high. So if not as high as 23, here the returns are somewhere around 15-16% or 17-18% odd in the large cap. I'm talking about 3-year rolling return. So when you're sitting on that kind of return, especially in the mid and small, and that's where you're seeing the mid and small is not moving much. So first of all, as when it comes to the consumption stories representation is more in the large cap. It is upwards of 70%, while consumption stories representation is less in the mid cap. It is around 50-55%. So, and that's where that impact you are not seeing commensurately in these two indices. Secondly, when we are looking at the valuations and very high gains what we had, definitely, even after some of these corrections which we have seen, the valuations are reasonable, but they may not be attractive. And thirdly, on the flows front, especially if you have seen that the flows from the domestic is definitely good, but FIS flows has had some challenges for some time. And that actually is also impacting the market returns. If you see, there have actually in last 1 year, some of the emerging markets have done much better, especially because of the flows and various developments in those markets, particularly. So these are the multiple reasons why the returns you are not seeing commensurate to the announcements.
All right, Shreyas, thank you so much for joining in. All things that we need to watch out for now is earnings pickup and perhaps some moderation in valuations, time correction, maybe if not price correction that we're seeing right now. But thank you so much for joining in with your views. With that, we'll wrap up on this edition of Markets Forward. Stay tuned to CNBC TV 18. We'll be back with more news and updates on the other side. A lot of commentary coming in on all things GST and from regulators, along with big voices in the markets, along with the big voices in Delhi.
Good evening. Thanks for joining us on this special broadcast. I'm Shireen Bhan. The headlines that we're tracking for you this evening. India gets ready to usher in a new GST regime from the 22nd of September. From daily essentials to cars and bikes, tax rates will be lowered for several items as the government hopes to boost consumption. The government estimates a revenue hit of 48,000 crore rupees. Automobile stocks hit the highest level in nearly a year as the GST cut on small cars and bikes lifts sentiment. The effective tax rate on SUVs and luxury cars will also drop to 40% as the compensation cess ends. But two-wheeler makers fear higher taxes on bikes above 350cc could adversely impact the segment. From soaps to toothpaste, majority of personal care and home care items will see GST drop to 5%. Textile and apparel industry will also benefit as key inputs and finished products will now fall under the 5% tax slab. In a bid to boost infra and construction, GST on cement lowered from 28% to 18%. Individual health and life insurance is now exempt from GST, but industry fears costs will rise without benefits under the input tax credit. The Sensex and the Nifty give up early gains to end flat after profit booking coming in late trade. Mid-cap see sharper cuts. The rupee weakens marginally against the dollar.
This reform is not just on rationalizing rates. It's also on structural reforms. It's also on ease of living. Rate rationalization, of course. We've reduced the slabs. There shall be only 2 slabs. And we are addressing also the issues of compensation cess. Ease of living, simplifying registration, return filing and refunds. Levied on common man's daily use items have gone through a rigorous looking into. And in most cases, the rates have come down drastically.
The union government and states have undertaken a massive overhaul of the country's goods and services tax regime in a bid to boost consumption ahead of the festive season. Prime Minister Modi had announced the next generation GST reforms from the ramparts of the Red Fort during his Independence Day speech. But here is what has finally happened. The GST Council, India's apex decision-making body on GST, has decided to scrap the 12% and the 28% tax slab. So now you have 2 main slabs of 5%, 18%, and a new slab of 40% for sin and super luxury good items. Now, the rationale is that this rationalization exercise of moving to a 2-slab structure will make compliance easier and will also boost consumption. So that 40% slab is for limited goods only. Finance Minister Nirmala Sitharaman, who is the chair of the GST Council, said that the call to cut rates was a unanimous one. There was no disagreement among states. While some states had raised concerns about revenue protection, but there was no disagreement. There was no voting. Remember, in the 8-year history of the GST, there has been all decisions taken by consensus, by unanimity. Now, here's what happens. Nearly 99% goods that were previously in the 12% slab are shifting to the 5% slab. So that's a big one coming in there for you. And items there will start to see the new rates coming in from the 22nd of September. The products in this basket will include daily essentials like toothpaste, footwear below 2,500 rupees, fertilizers, tractors, electric vehicles, finished textile products. So that is what happens to the 12% to 5% slab. Now let's focus on the 18% GST slab. Remember, the 18% GST slab is going to be the one where around 90% products that were earlier in the 28% bracket have been moved into. So close to 90% goods previously in 28% now move down to the 18% slab. This includes things like cement, small cars, televisions, bikes with an engine capacity of below 350cc, air conditioners, refrigerators, among a whole host of other items. So that is the 18% slab for you. Individual health and life insurance premia, which were earlier in the 18% slab, have now been exempt from the GST, but industry fears the costs will rise without the benefits under the inverted duty structure as well as the input tax credit. The centre is bracing for an impact of 48,000 crore rupees on account of the GST overhaul. Well, to take us through the impact in the near term as well as the medium to long term, we're joined by a panel of industry leaders who head various committees at the Confederation of Indian Industry. With us, Dr. Naresh Trehan, the chairman and MD of Medanta. Also with us, Madhav Krishna Singhania, joint MD and CEO of JK Cement, and Deepak Shetty, the CEO and MD of JCB India. Gentlemen, appreciate you joining us here. Doc, I can see you're driving your way from one point to another, but let's talk about what the new GST regime is going to mean as far as healthcare services are concerned. There's been a whole bunch of changes on drugs under the oncology bracket, on life-saving medicines, etc. The big impact for healthcare.
Okay, so this is a very, very positive move by the government. Basically, to be able to enable more and more people to be able to afford healthcare services. So, first of all, it falls into the insurance sector where premiums have been reduced or made to zero from 18% GST. So, if the public has to pay premium, they don't have to pay 18% extra tax on it, which is a big boon for the whole sector. So, what we are anticipating is that this will enable a lot of people to access healthcare, many more people. It will broaden the base of insurance companies, and many more people will come into the net for be able to afford healthcare from now on, which is a very good move for the public. The second thing that has happened is that critical medicines, which are cancer drugs mainly and other rare disease drugs, which are quite costly, are actually now going to be either exempt to 0% or more have been moved from percent to 5%. So this is again going to cost less in our ability to deliver healthcare to our patients. So this is another big move. Now the third is that on consumables and also on import of equipment and all that again GST has been reduced to 5%, which will enable us to be able to do the tests, diagnostic tests at a much cheaper price. So I think overall it has helped actually the healthcare sector, the insurance sector, and also the public at large, which is the main beneficiary of all these moves. So I must thank the government and the state for actually going along with it, and this was a long-standing need, which is now fulfilled. So I think this is all positive from our point of view.
A long-standing need, but Dr. Trehan, before I let you go, you talked about what this is going to mean as far as the end consumer is concerned. For instance, on account of the GST reduction on imported medical equipment, so the cost of diagnosis, the costs of tests, what can the consumer expect in terms of the benefit?
See, whatever benefit the providers are getting has to be passed on to the patient so that they feel the benefit of what the government has done. So in other words, we have to be very transparent in what benefits we are getting, and those have to be sorted out, factored in, and those benefits should be passed on to the public at large.
Right, Dr. Trehan, many thanks for joining us en route to a destination. But let me go across to Madhav Krishna Singhania, Joint MD and CEO of JK Cement. Mr. Singhania, many thanks for joining us. This was a long-standing demand of the cement sector. Why are we in the 28% slab? There's no reason for us to be considered either luxury or sin. And finally, that has been rectified now down to 18%. What do you believe the near-term implications and the impact will be?
So Shireen, firstly, thank you for having me here on this show. And I'd like to first congratulate the Honorable Prime Minister as well as the Finance Minister for undertaking such bold and transformative reforms. As far as the cement sector was concerned, it's been a long-standing demand to bring cement from the 28% slab to the 18% slab. But due to the revenue loss issues, for whatever reason, this could not take place in the past. I'd like to say that cement is probably one of the basic building materials for any nation. And by this rate coming down, the individual home builder will probably be the most benefited because his cost of construction will definitely marginally come down. There may not be a price elasticity gain, but it's possible that he may maybe build one more room or a little larger square footage of his house. The second is the cost of infra projects will definitely come down. So that is another big sort of boost because capex spending is something the government has been focusing on. And thirdly, a request which has always been there is to reduce the various types of cess and bring it as a part of so that the input credit on the same is available. And that has actually happened in terms of coal because while the GST on coal has gone up from 5 to 18%, but the compensation cess used to be there at 400 rupees a ton has actually been absorbed as a part of GST. So the input tax of the same is available to the industry. So, I would say even in terms of CII, what we've been advocating, 4 slabs to 2 slabs, ease of doing business, bringing down, consumer costs, boosting demand, as well as bringing the various cesses into GST is truly commendable.
Yes, that merger of the cesses into the GST rate itself has taken place across a whole bunch of sectors, from aerated drinks to, in fact, luxury cars. And of course, as you spoke there about coal as well. But, as far as the cost of infrastructure projects are concerned, Madhav, and that's what I want to discuss with you. You said that you expect, infrastructure projects to get more competitively priced on the back of the GST cuts that have been announced. What could we see in terms of reduction of costs?
See, Shireen, it depends from project to project in terms of what is the cement cost of that particular project. It's tough to, put a definite number there, but I would say definitely a few percentage points reduction is something which could be possible. And given the budget of, over 11 lakh crores, it will still be a significant number.
What about capacity utilization for you currently, Madhav? There's been a fair degree of consolidation as well in the cement sector, but if the hope is that this is going to boost consumption, how are you doing as far as production capacity is concerned?
So, Shireen, if you look at the industry in general, the industry demand has been quite good. Even in terms of the core sector demand this year, over the last 4 months, we've seen about an 8% demand growth. As a company, we have given a double-digit sort of, capacity growth in terms of our production and our sales. Even in terms of our capacity, we are, there was a huge debate around capex spends for private sector. But as far as JK Cement is concerned, we have actually gone from a capacity of about 14.5 million in 2019 to 30 million this year, and have already announced another 4,800 crore investment for a 7 million ton capacity enhancement. So as far as we are concerned, we are definitely, spending and a part of the private capex spend.
Okay, let me bring in Deepak Shetty, the CEO and MD of JCB India, to take forward where Madhav left off. Mr. Shetty, many thanks for joining us. On balance, the hope is that this is going to boost consumption demand and also investment demand. So what impact do you see? How are you preparing yourself for these changes?
First of all, thank you for having me here. And I would again start with congratulating the Honorable Prime Minister and the Finance Minister for their vision. As the Honorable Finance Minister said, this is a structural reform that they have introduced. It's not only about ease of living. I would say it is also ease of doing business. From multiple slabs moving into 2 slabs brings that amount of clarity. And here is particularly when I look at our MSME partners, people running the small industries, for them this sort of clarity really helps. There are 2 sectors. Madhav spoke about cement sector. I think the huge impact on infrastructure development with the reduction in the GST on various input parameters. I think general wisdom is around 40% of the cost of a project is contributed by, say, steel, cement, and other inputs. And this will certainly help improve the infrastructure sector. Last few years, the Honorable Finance Minister has been focusing on infrastructure sector. So that is certainly very positive. The second element and the focus has been on the rural economy. The reduction in input cost on from the rural side also will spruce up the rural economy. GST reduction on tractors will bring again a change. It will further enhance the use of mechanization in the agriculture sector, which again is very, very important for us to scale up the agriculture sector. So that is certainly very positive. And also the daily use items on which the government has focused. This puts more money in the hands of the consumer. So along with this, FMCG, also some of the other purchases. Just to give an example, 65% of the construction equipment is sold in rural India. So more than 70% of JCB machines are sold in rural India. And I'm sure the rural customers who get benefit of this, the GST, as you're rightly saying, the GST bonanza, they will use it not only to buy cars, but also buy construction equipment, which also creates jobs and also is a revenue generator. So overall, very, very positive for these critical sectors.
Positive sentiment there coming in across the board, and the hope is that this will spur demand. And remember, 22nd of September is when these new rates kick in. That coincides with the festive season, with the start of the Navratra period, and that is what the government is hoping will ensure that this is in fact a bountiful festive season for OEMs. But Madhav, Dr. Trihan and Deepak Shetty, many thanks for joining us here on the GST Centimeter to take us through what this means for industry and what it means for the consumer. We'll head into a break, but up next, an exclusive with the CBIC Chairman Sanjay Kumar Agarwal on the GST reforms. Key questions answered. Stay tuned.
So when we talk about the two key rates, they will now soon be a reality from 22nd of September. A key question that comes in from the industry is what happens to the existing stock? How will they exhaust the ITC and the backlog on these existing stocks?
Yeah, Timsi, these new rates will be effective from 22nd of September, except for few commodities like pan masala, tobaccos and cigarettes. As far as existing stocks are concerned, the rate applicable will be on the date of supply. So these are the provisions under the GST law. So if something is, say, supplied after 22nd or from 22nd September onwards, the new rates will apply.
So when we talk about the key rates, 5%, 18% and 40%, what was the rationale to come down to these three rates only, with two, the main rates, and 40% only for the limited items?
The basic idea was that this time we have to carry out a comprehensive exercise because GST is already 8 years old, and therefore there was need for redoing the rates and bringing down the number of rates, because number of rates, if we have multiple number of rates, then that leads to the classification disputes. And if the similar type of goods are classifiable maybe under two different headings, which may be attracting two different rates, that leads to the classification disputes. And there are unforeseen demands which have been raised, and especially we have analyzed the food sector and automobile sector. We found that in large number of cases on food items there were classification disputes, and that was leading to unnecessary demands on the sector, as well as on the automobile side also. Auto components used to attract 18% or 28%, and these disputes were ongoing, and therefore it was decided to bring uniformity in the rate. And on all food items now the rate is 5%, whereas on all auto components the rate is now 18%. This will lead to giving certainty and predictability to the industry, and there will not be any unforeseen demands. While determining that what should be the rates, so 18% rate is the main standard rate, and it was decided to do away with 12% rate and move the items under 12% to either to 5% or to 18%. So majority of the items were placed, which were placed in 12%, were already in the nature of merit goods. So most of the items have moved to 5%, and few items have moved to 18%. Similarly, there were items under 28% bracket, which were there in that because at the time of fixing these rates in 2017, revenue neutrality was the concept in mind. So the goods, the excise duty and the VAT, which the goods were attracting, that was the determining factor for the levy or fixing the rate on the goods. But goods actually should be, according to the nature of goods, should be maybe under some other rate. So this time this exercise has been carried out, and items which were falling under 28 have been brought down to 18%, which is the standard rate, barring few items which are in the nature of sin goods or ultra luxury goods.
So when we talk about services, a key change that was discussed in the council, what we heard was for e-commerce operators on local deliveries, including food delivery. Over there, we saw in the past a lot of cases were coming up where e-commerce operator was demanded to pay 18% GST, whereas e-commerce operator was saying that the delivery is being carried out by the delivery operator, there's a delivery partner, and if he's under the threshold, then he may not pay GST. What is the clarity that the council discussed on this?
Now it has been decided that the delivery services which are provided through ECU operators would be notified under section 9(5), and once it is notified under 9(5), the liability gets shifted to the ECU operator, and but this will require an amendment in the law, so it will take some time. But now there is certainty that local delivery services will attract the rate of 18% with the standard rate.
And this is without ITC?
No, it will be with the ITC.
And when we talk about the levy being shifted from delivery partner to the e-commerce operators, it includes food delivery, any local grocery delivery, everything?
It includes all types of local deliveries which are provided through ECU operator.
So when we talk about medicines, a lot of key medicines have been shifted to 5%, and in some cases, rare diseases and life-saving drugs, cancer drugs, they've come down to exempt. But APIs, the key raw material, is still at 18%. That is causing a lot of inversion for the pharma sector. What could be the way out for this inversion?
Actually, it is not possible to correct the inversion in all types of cases, because there are items which are maybe the goods of chemical industry, and when they are consumed in pharma industry, then the inversion may happen. So, but just because inversion is happening, we should not keep the rates high. Medicines deserve to be placed in 5% rate. Accordingly, medicines have been placed at 5% rate. And because of inversion, if there is any accumulation of credit, ITC, so that can be refunded. And in that case also, in the process reform, the government, GST Council has recommended amendment in the law so that 90% amount, claimed amount, can be provisionally sanctioned within 7 days on the basis of identification and risk evaluation by the system.
Hello and welcome to this special show on the GST Centimeter. I am Yash Jain. Now, in a major policy shift, the GST Council has decided to exempt individual life and health insurance policies from the goods and services tax starting September 22nd. Until now, premiums attracted a GST at various rates, with 18% being the highest. Brokerages say that policies could get cheaper by up to 18%, that is if insurers decide to pass on the full benefit to the policyholders. This means increased accessibility. So, what does it mean when it comes to health insurers? The policy cost would increase by about 5 to 7% as per industry estimates. When it comes to life insurers, their policy cost could increase by up to 9 to 11%. Now, why would there be a cost increase? This is because insurers will lose the ability to claim input tax credit to offset the cost incurred on reinsurance, commission costs, as well as claims costs for procuring insurance premium, hence putting pressure on their margins as well. Now, while the council has exempted reinsurance costs from GST, it only makes up for about 30 to 35% or one-third of the total expenses incurred by insurers, and most individual policies are not even reinsured. Another concern for the insurance sector is that inverted duty structure benefits will not apply. Insurers could consider sharing the cost with distributors by reducing commissions they pay to them. But the big question is that would the GST cut mean increased demand for insurance? Experts say that it may not. This is because insurance has always been a push product and not a pull product. Well, throughout the day, we've been catching up with top insurance players to get you a sense of what the GST cut means for the sector, that is insurance. Sanjeev Bajaj, the managing director of Bajaj Finserv, called GST cuts a big bang policy which will provide big stimulus for the manufacturing and the infrastructure industry. He also said that the fears that cost will rise without benefits under inverted duty structure and input tax credit.
I think this is one of the biggest reforms we have seen from the government since the 2017 introduction of GST. and we must commend the government for doing that. It is a big bang positive movement for the economy on multiple fronts. So if you think about it, big boost to households and rural income. I think it's between 1 lakh and 2 lakh crore, the benefit that should come out of this. Big stimulus for manufacturing and infrastructure. As we know, the cut in cement will be a big cut in construction costs, infrastructure costs, further accelerate investment and job creation. Particularly also, if you see the kind of items, tremendous support to MSMEs and employment intensive sectors. So overall, very positive, I would say, this kind of dramatic action that has been taken on GST rationalization, plus some of the rationalization moves beyond the rate cut, should just also help in formalizing, getting more MSMEs to come in, sign up under GST. So formalizing the economy as well. Even the operationalization of the GST appellate tribunal and simplification of structures should strengthen compliance and trust in the system and broaden the overall system.
Mr. Bajaj, on the lending side, we've spoken to a few analysts and they all agree that if there's one business most positively correlated to the consumption boost which these GST cuts may provide is your business. And I think the markets are giving a thumbs up. Could you give us I know, of course, I'm not looking for specific numbers or anything, but there will be a multiplier effect. And I mean, you're exposed to a variety of lines, lending lines there. Where will we see this coming up the most, in your opinion?
Prashant, as you correctly said, that any such dramatic change in the economy first impacts financial services disproportionately because it ends up supporting or enabling so much of the real economy. And that can work both ways. In this case, naturally, it is the positive step. So there is a hopeful positive move. I would directly look at both on the consumer side. Consumer spends should go up dramatically in the coming quarters. In addition, we have a large lending portfolio to MSMEs. That should benefit as well. And, over the last few years, we've been looking at what it takes to get private sector to bring in new investment. And while a number of factors have provided tailwinds, the larger external uncertainty and impact of wars, it has been external situations that has held private sector back. I think this kind of a boost should encourage a number of sectors now where they've reached significant capacity utilization to start looking at the next investment cycle very seriously.
As someone said, and I think that was an apt point to make, if on cars, for example, rates are cut, it's not necessary that the demand for, people will immediately start buying more cars. But the point is there is more savings in the hands of the consumers. So that category it's very difficult to put numbers to it, whether, a cut of 10% will lead to this much volume jump. But broadly, because it's happened on so many items across the board, more money in the hands of consumers. And that is a broader kind of call. But if I were to press you a little bit more, Mr. Bajaj, which lending segment, according to you, will you think do very well? You mentioned SMEs, MSMEs. Where else?
Very much consumer lending. Consumer lending is for Bajaj Finance one of our largest areas. So we should clearly see over there. And as you said correctly, Prashant, the money that gets saved now in the hands of both the rural and the urban consumer partly will get spent. And keep in mind that there was a negative emotion due to the external uncertainties, the trade issues. I think a large part of that can get resolved with this positive step. So if people were sitting on the fence and not spending in the last couple of quarters, hopefully many of them will get convinced to spend. For the rest, they will still be saving an additional amount of money. And as we have seen in the last few years, that additional money now is not just going into buying a second house or investing in fixed assets. It is going now into financial assets. Look at the monthly inflows into mutual funds. And this will help the economy as well. Because as we are trying to build the real economy over the next decade and more, we need a very solid financial services economy to fund the real economy. So I think this provides the start of very strong tailwinds for that as well.
Mr. Bajaj, let me ask you about on the insurance side, right? There it's not very clear. We've spoken with a couple of insurers since the morning that, getting the rate down to zero on policies, health, life, etc., will result in lower premiums. I mean, that math doesn't quite add up because of input taxes and, the ITC benefits not being available. Can you tell us what the thinking there is?
So our teams are just calculating the numbers. Of course, there will be some ITC credit that will not come, but I think net, first cut, and again, don't hold me to it, I don't have the numbers, but first cut, it should benefit positively. How much? This is something that we will know soon as we start calculating it.
You're saying it should result, I mean, at a headline level, there should be some reduction in premiums.
Yes, I would think so. Now, what it is, when it is, what products, prospectively, new products, these are details that the team has to work on. So I can't answer that at this point of time.
As head of the industry body as well, Mr. Bajaj, when the representations were made and you just said that the government has sort of agreed to most of it. On the insurance side, at least what we were picking up is that the industry did not want zero, because with zero under the current rules, you can't have input tax credits. It doesn't allow for it. So, a bit of disappointment there or no? Not really?
So you see the benefit of that ability to set off input tax credit would have gone completely to the consumer. So from that point of view, if he had been able to do that with maybe putting this into the 5% slot, that would have benefited the end policyholder that much more. But we still think that it's a big step from where we were till 2 days ago. And maybe this is something to keep in our pockets for the next time this gets rationalized.
In terms of in the order on the insurance business, Mr. Bajaj, life, general, health. I mean, how does it? Who benefits most and who benefits least? I mean, if you were to request you to order those lines of businesses, because it's different for different, right? On the health side,
Yes.
for example, the rate of reinsurance where ITC is available is lower. Whereas for other lines it is higher. So, I mean, just in terms of ordering of benefit, where would you place which one?
So the quick read that I've done, firstly, the cuts on life and health. Health can either be a standalone company or it's part of the general insurance company. Benefit will come on both. But as you correctly said, depending on what's the build-up on the ITC side, the benefit could be slightly different. I don't have those exact numbers right now. That's something that we are working on.
So it is not like one is making too much money or anything of that sort of profit. Terms like profiteering, etc. do not. Which insurance company is making crazy profits? And which distributor is making crazy profits? Right? As a percentage of premium. If the benefit is 18% and the cost is 5% or 10%, a benefit is going to the consumer, is it not? Right? Whatever the industry can afford, it will take.
If I have to give you just a guess, overall estimate in terms of how much is the overall cost, all input cost, assuming if it's 1/3 is reinsurance cost and the 2/3 is other cost. That's how we have divided this as of now. 2/3 is other cost, whereby we do not get the input credit today. We're not looking at anything which is giving on to the customer. We want to give this to benefit to the customer. We don't want to increase premium as of now. We still want to assess this, understand this in terms of what impact it has.
Well, those are some of the sections of the very interesting discussion we've been having since morning on what GST means for the insurance sector and what's the road ahead for the same. But with that, it's time for a very short break. Don't go anywhere. On the other side of this short break, we take a look at what the impact of GST rationalization would be on the other side, on the other sectors as well. Be there on the other side of this very short break for that discussion. Welcome back. The FMCG and the consumer durable sector were among the biggest beneficiaries of the GST cuts announced by the council. From soaps to toothpaste, majority of the personal care and home care items will see GST dropping to 5%. The industry certainly at this point of time seems to be welcoming this move.
It's indeed fantastic news because this will bring in a lot of benefits both to the producers as well as consumers. Now, half the products that we do or half of our turnover comes with 0% GST and the balance half with just 5% GST. So we as an organization, cooperative, believe in passing on the largest share of the consumer's rupee to the producer, which is already about 80-82%. And now with reduction in GST, we will definitely increase our share of the consumer's revenue to the producer in a much larger way. So benefits both producers and consumers, and we are really thankful to the Prime Minister and the Finance Minister for this great initiative.
However, on our stationery business, which would reap this benefit in the latter half or 6 months of the year. So now considering that 3 to 5, so we may think of say something between 1.5 to 2% volume increase on this account.
Well, from FMCG to consumer durables, that was the sector which also saw a big boost. Several white goods, including television, air conditioners and refrigerators, were shifted from 28% to 18% slab. Will it boost the consumption cycle? My colleague Upasna Bhatt decodes exactly that for us.
Big consumption boost announced by the government with the onset of festive season. Let us look at the key categories that will be in focus on the back of GST rate rationalization. Now, categories like ACs, large TV, dishwashers, here GST has been reduced to 18% from 28%. While on solar water heater, the GST is reduced to 5% from 12%. Now, lower GST directly stimulates demand for ACs and large TVs, expanding the market size for domestic production. Now, Elara Capital believes that on AC, RAC demand may rise minimum by 10 to 15% on the back of this. And it feels that the RAC OEMs like PG Electroplast, Ember Enterprises, EPAC Durable may see a spurt in volumes in the H2 FY26 onwards. On TV, the brokerage believes there is no direct beneficiary, but Dixon Tech assembles TVs for numerous brands in India and may see volume growth in H2 FY26. On solar water heater, the brokerage believes it is a growing market in India and key beneficiary here would be V-Guard and Havells. Coming to dishwashers, it is still a nascent category with an estimated market size of 700 crores. And the key beneficiaries here would be Voltas Beko and IFB Industries. Now, Blue Star believes that company was initially expecting a 15 to 20% growth this festive season, but on the back of this, it now expects a 30% growth thanks to GST rate rationalization. So overall, it's a positive move for consumer durable sector.
I anticipate that from September 22nd onwards, till the new year, it should be a great season ahead for multiple reasons. Significant reduction of around 10%. It is anywhere between 2,500 to 3,500 rupees, depending on the model one wants to buy. And never in the history there had been such an increase through one announcement. There is a energy label change that is coming up on 1st January 2026. Therefore, there will be a rush to purchase the products before the prices go up.
Well, that was a comprehensive roundup as far as FMCG and consumer durable sector is concerned. But on to the textile and the apparel industry, that sector will see benefits as key inputs and finished products will now fall under the 5% tax bracket. Vinny Motiwala takes us through the impact as far as GST cut on this sector is concerned.
Thanks so much for that. So yes, surely a GST boost that is coming in for the textile and apparel players, because previously these players had multiple rates, right? There was 5%, 12%, 18%, 28%. Now it's coming to two unified rates of 5% as well as the other rate of 12% is what we'll keep an eye out on. What does this mean? Rate reductions will lead to lower procurement prices for textile players, especially in terms of
key inputs. Now, inputs, whether you look at in terms of the value chain of yarn, whether you look at in terms of the threads that are made as well, all these will see a reduction. Man-made yarn, 12% to 5%. There was man-made fiber, that is from 18%, it's coming down to 5%. A unified rate now of 5% for most of these input products, which is positive for them as well. Now, other than that, finished products also are seeing a cut, right? 12% to now 5% is what's coming at. Bath linens are the products, carpets, rugs, all these finished products from textile players actually come into the 5% range now. Let's talk about apparels. Apparels, now we're saying that GST of 5% will be on apparel products not exceeding 2,500 rupees per unit. Previously, this 2,500 rupees was 1,000 rupees. So an increase in terms of that rate, that is what is coming in, right? So 1,000, now it's moved to 2,500 rupees, and a lot of companies will benefit from this as well. Some of the beneficiaries from these changes will be Wellspun Living, Indocount Industries, KPR Mills. Other than that, we also have Gokul Das Exports, Vardhaman Textiles, as well as Nitin Spinners among some of these gainers. And obviously, these unified rates is something that will give a boost in terms of the demand for the companies as well.
Well, auto stocks were in focus as these stocks hit their highest level in nearly a year as the GST cut on small cars and bikes lifted sentiment. Sudarshan tells us which companies are set to benefit with the changes in GST.
One sector that has come out as one of the major beneficiaries from GST Council outcome is the auto sector. So what are some of the major takeaways? First, GST rate has been reduced across the segment. Second, compensation cess or say GST cess goes away. Third, effective rate for even 40% slab would be lower than the earlier tax rate. Fourth, small cars, most selling bikes and auto parts will now fall in 18% slab versus earlier tax rate of 28%. Fifth, tractor and its parts will now fall in 5% slab. And sixth, EVs will remain in 5% slab. So which all companies would benefit the most? So first talk about small cars. So companies that would benefit the most are Maruti, followed by Hyundai and Tata Motors. Second, for bikes up to 350cc, the biggest beneficiary would be Eicher Motors, followed by Hero MotoCorp. Why would Eicher benefit the most? Because almost 90% of its total domestic volumes have bike with capacity of up to 350cc, exactly 349cc. Only 10% of its domestic volumes fall in the capacity that have more than 350cc, for which tax rate is increased to 40%. So it's a minor negative, but overall it's positive for Eicher Motors. Next is tractor. Biggest beneficiary would be M&M and Scott's Kubota. Apart from tractor, M&M would also benefit from SUV. Despite its best-selling SUV, that is XUV700, is being moved to 40% slab because effective tax rate will now be 40% versus earlier effective tax rate of in the range of 43 to 50%. Next is three-wheelers. So biggest beneficiary would be Bajaj Auto and TVS Motor. Next is tires. So Apollo Tires, MRF, Seat and Balkrishna Industries. Balkrishna Industries will also benefit because it's the supplier in the tractor segment and tractor tires will fall in 5% slab. And last is auto parts and biggest beneficiary would be Endurance Technology, Bellrise Industries, Sona BLW, Motherson and Carraro. So now after the GST Council outcome, the hope would be that if industry sees an increased demand and if we see an increased estimates for FY26 from current estimate of single-digit growth.
You know, if I have to summarize what's happened for the two-wheeler industry, I would say it's a tactical hit. This GST reduction is a tactical hit, but it's a strategic miss. It's a tactical hit because, obviously a big fillip for, let's say, almost 98% of the domestic industry with this significant reduction in GST. But at the same time, the 350cc plus motorcycles, where Royal Enfield and Bajaj are the biggest players, this is on the one hand just 1% of industry, perhaps about 4% by value. So both Siddharth and I had appealed to those concerned, that this is just 2% of the industry and let's have a uniform rate.
For auto sector specifically, we are seeing across the categories
there has been a significant reduction in GST. The 28 to 31% bracket rates have come down to 18%, and then 43% to 50% brackets have been brought down to 40%. So I think not only the reduction, but also the timing is perfect, just ahead of the festive period. And therefore, I believe that this will have a significant impact on the demand, which will be extremely favorable. So overall, I think it's a significant move, and this will have a significant demand creation and generation for the auto industry in all the categories.
Well, moving on to the health sector, the GST on medical equipment such as diagnostic kits, blood glucose monitors and surgical devices has been reduced from about 12% to 5%. Meanwhile, GST on 33 life-saving drugs used in the treatment of critical illness such as cancer has been cut to zero. Here's what Polymedicure and Metropolis said about the GST reforms.
I think, we have three different structures, 5%, 12%, and 18%. Everything gets collapsed to 5%. So I think this will spur demand, especially for essential healthcare products, so especially used in, home care, area like thermometers and glucometers and all that. And for hospitals, the cost for medical devices will come down from, let's say, with a reduction in GST. And as they are nil rated, so they don't get any benefit for higher GST rates. So once the GST comes down, I think the cost of treatments for patients will also come down. So it's very, very positive for the industry.
See, this is a landmark reform that the government has done, and frankly, at Nat Health and obviously from all of us, we've been pleading with the government for a long time, saying because we don't charge GST to the consumer, we have all these input costs with no actual offset. So this actually gives an opportunity now to to be able to have a lower GST input cost. Because medtech has come down and reagents and chemicals, the GST has come down from 18 to 5. That will certainly expand access for the industry. It will create a fairer competition playing field between the unorganized and the organized.
Well, that's all we have on this special broadcast, GST Centimeter. Many thanks for watching.
this reform is not just on rationalizing rates. It's also on structural reforms. It's also on ease of living. Rate rationalization, of course. We've reduced the slabs. There shall be only 2 slabs. And we are addressing also the issues of compensation cess. Ease of living, simplifying registration, return filing and refunds. Levied on common man's daily use items have gone through a rigorous looking into. And in most cases, the rates have come down drastically.
Hello, welcome to this special broadcast. I'm Parikshit Luthra. The Union government and states have undertaken a massive overhaul of the country's goods and services tax regime in a bid to boost consumption ahead of the festive season. Prime Minister Modi had heralded the dawn of next-gen GST reforms from the ramparts of the Red Fort during his Independence Day speech. So here's what happened. The GST Council, India's apex decision-making body on GST, has decided to scrap the 12% and the 28% tax slabs. The Council's rationale remains that this rationalization exercise of moving to a 2-slab structure will make compliance easier and boost consumption. There is a tax slab for 40% GST as well, but it would be limited to sin and super luxury goods. Finance Minister Nirmala Sitharaman, who is the chair of the GST Council, said that the call to cut rates was a unanimous one and that there was no disagreement among states. Nearly 99% goods which were previously in the 12% slab have been now shifted to the 5% slab. The new rates will apply from the 22nd of September. Now, this is the important date. It is the start of Navratri. These products include daily essentials like toothpaste, toilet soaps, footwear below 2,500 rupees, fertilizers, tractors, electric vehicles, finished textile products. Now, let's focus on the 18% GST slab. Around 90% products that were earlier in the 28% have been moved to 18% slab. This includes cement, small cars, television, bikes with engine capacity below 350cc, air conditioners, refrigerators, among others. Individual health and life insurance premium, which were earlier in the 18% slab, have now been exempt from GST. But industry fears costs will rise without benefits under the inverted duty structure. Input tax credit. The centre is bracing for a revenue impact of close to 48,000 crore due to this overhaul. To take this discussion forward, I'm now joined by a panel of current and past FICCI executives. Anand Goenka, Vice Chairman, RPG Group, Nenalal Kidwai, Chairperson, Rothschild and Company India, and the India Sanitation Coalition. Also on the program with us is Manish Sharma, Chairman of Panasonic Life Solutions, India and South Asia. Thank you very much for joining us. Ms. Kidwai, let me begin by asking you, overall, how does this improve sentiments, unleash the best festive spirit, and also will this lead to a greater private capex cycle in the coming months and years as well?
Parikshit, thank you for having us on the show. I can only say that the mood has been celebratory, as you have heard from last night, and with due cause, because what it suggests is consumption goes up. And to your question on capex, if consumption goes up, capacities of industry get filled, and therefore capex goes up. So the big boost that comes to consumption and demand will drive the capex cycle, will drive demand, will in fact hopefully also drive sentiment, whether across markets or in individual pockets. I think beyond just what it does to the demand and capex cycle is the simplification that comes with this. Less confusion, less appeals, and even if there are appeals, the declaration of an appellate tribunal to ease whatever discrepancies still remain. But I do think that this is a huge move to what is primarily a two-tiered structure, barring the 40% sin goods, and the simplification across the board, or an attempt at that, is definitely cause for celebration. So yes, bodes very well for festival spirits going forward.
Right. Anant, if I were to ask you, what kind of an uptick are you expecting in terms of demand? You know, especially when it comes to the entry-level buyers, the sentiment had been rather muted for the past many months. Are you now bracing for an uptick in the festive season and a sustained uptick in the wedding season as well?
Absolutely. I think the timing could not have been better. We have the end of the month and end of quarter coming in after the 22nd of September. Anyways, about 50% of sale happens in the last week of the month. So to that extent, we will see a big uptick towards the end of September. Then you have Diwali and you have the marriage season. So with all of that combined, I do think quarter three should be far better. Putting in 10% in the hands of the customer is a huge amount when you're looking at many duties coming down from 28% to 18%. So to that extent, with that much money or price reduction happening, it will make a big difference in demand going forward.
Right. But looking at the current economic situation and high US tariffs as well, will companies be ready to pass on the benefit immediately?
No, absolutely. I think it is our duty to pass on the benefit. We will pass on the benefit to the consumer. The government has clearly mandated that this is for the customer. So as soon as possible, the benefits will be passed on. There is some inventory that may be with trade, so there could be some delays in terms of a few weeks, but at least from the company side, we will be passing on the entire amount. There are certain areas such as, sachet prices for FMCG products, which are priced at 1 rupee, say for the last 15, 20 years. What will happen to those areas? I think they're talking about volume increase, which they've done in the past where GST rates have got changed. So I think those are some sticky areas where pricing is very sensitive from a consumer mindset perspective. But otherwise, the intent is to pass on everything on day one.
Right. And Manish, if I were to come to you, when I look at the list of electronic items, I think a majority of them now come in the 18% bracket. How will this lead to a drop in prices? How and where all can customers expect price cuts in the weeks to come? And what is the average percentage of price reduction you're looking at?
I think the average percentage of price reduction will be about 7 to 7.5%, which will be the cascading impact logically of the 10% reduction which has happened. And I'm looking at this as a unlock, which was much due. And if you carefully look at all the consumer durables, I believe barring 32 inches and below, almost all were falling in 28% bracket. And the argument always was such that how do you look at unleashing this huge potential? Air conditioners, for instance, still continue to be about 7.5% penetration ratio in the country. So in my opinion, this is going to unlock that potential. And second, this whole process is not only going to be like products being more affordable for people. I think a lot of people will look at upgrading their whole lifestyle. In the situation where 32 inches and below were falling into 18% and the higher screen sizes were 28%. So that is getting bridged. So people would rather upgrade themselves to higher screen sizes and better energy efficient air conditioners for their purchasing decisions. So from my point of view, I think this is going to be a significant milestone when we will look back after a few years to unlock and unleash this whole potential, which always was ahead of us.
Manish, when it comes to consumer goods, what was the segment of the population which you felt was not coming to showrooms to make these purchases or big ticket purchases, those who were holding back and which you now hope to tap?
It's very clear. If you look at last 10 or 15 years and look at the spread month-wise, which happens on an annual level, while the sale is starting to become more flatter, there used to be a time people used to wait for their bonuses to get dispersed, and therefore Diwali used to be like very peak of the annual sale. With the advent of e-commerce and more reasons for people to make their purchasing decisions, the sales is becoming more flatter during the year. And there used to be people, there's a very large segment of consumers who would be like fence sitters, if I can use that term, during a summer season. And if at all the weather patterns are such that they can postpone their purchasing decisions to the next summer, I think those are some of the consumers who I believe would look at pulling their purchasing decisions up. So as I said, I think at the level of penetration where the country stands for majority of these products, this will be a huge unlock. And this is going to have a cascading impact on the supply side also. If you look at electronics, I mean, into televisions, into air conditioners, there are electronic controllers. And with rising economies of scale for all these products, country will be in a better position to like backward integrate at a faster speed. So I think this is going to have cascading impacts in the time to come.
All right, a cascading impact in the times to come. And Ms. Kidwai, if I were to ask you about how does this improve the investor sentiment when it comes to India? Now, reducing GST, reducing the number of rates, simplifying GST, making it a good and simple tax, that had been the demand of the industry for the past 8 years. This has now finally happened. The eventual ask is maybe have one nation, one rate. But how will this improve sentiments in the near and medium term?
Anything that improves or there's an expectation that it will improve the bottom line of companies improves investor sentiment. And I think what we're hearing here is that demand goes up. So you see top lines increasing. There's cost inputs which look well contained for other reasons, including the lower inflation. And except for the shocks that might come from the tariff regime, domestic industries that are not impacted by exports are certainly going to gain. And if the bottom line improves, so does investor sentiment. I think there's a second angle here, which is interesting, which is the GST impact on infrastructure. The green sectors, all of these benefit from a lowering of GST on cement, on construction materials, on input costs in very critical sectors for the country. So to that extent, even input costs for projects, affordability, housing projects, real estate, which inevitably also drives growth, also impacts investor sentiment positively.
Right. The other question that I'd like to ask you, though the government has made it clear that this exercise of GST reduction was not linked to US tariffs in any way, but does this offset the impact to some extent, Ms. Kidwai?
I believe it does in terms of sentiment. Unfortunately, it may not impact sector for sector completely, because we know that some sectors, textiles, diamonds, leather, those that were largely export oriented out of the country to the US, and we do have other markets other than the US, fortunately, but those folks are clearly still struggling to understand how to cope with the impact of tariffs. They will benefit from the GST reduction because for many of their goods in terms of domestic GST rates, it has come down. So maybe some level of relief will come to them to the extent that the domestic market buoyancy makes up for the loss of export. But it's going to really be a case of wait and see whether the full impact can be made up to them. The timing in terms of announcements, I think these two things were moving in parallel. But if it pushed our government to make this announcement early, then it's very laudable because it does negate what was the negative effect of tariffs offshore. And it shows that our government is serious about looking across the economy and ensuring that buoyancy that we have been seeing comes back and comes back full force.
All right. Anant, if I can come back to you. Now, when it comes to seeking clarifications, there is a concern among, say, automotive dealers for that matter, that what happens to the compensation cess that they have already been billed for. You know, while they're buying inventory from car companies, they have paid the GST, they have paid the compensation cess. Now, customers are not going to buy those vehicles or may not come to buy those vehicles at least till the 22nd, till the GST changes are implemented. And they could lose out on that compensation cess, and that could be to the tune of 2,500 crores. So there is concern what happens to that. Would there be any clarifications that you are seeking from the government right now?
Yeah, it's too early to say specifically on that, but I think we will work with the dealer body, and if there is a need to make a plea to the government, certainly we will do so to get some clarification on that matter. But just a point at a bigger picture level, what is really exciting is that we think that this is a very critical point in India's reform journey. I think it is a very big step that has been taken, and there are various other steps that have been announced, such as the 1 lakh crore innovation fund or the national manufacturing mission. So where the investor confidence or business confidence comes in is that Now, a lot of what was announced is coming into action, and there is a higher sense of urgency that we are seeing to take quick action and big action. And therefore, in my view, this is just the start of large reform that can come in for businesses.
Right. Manish, to ask you, when you spoke about supply side improvements, do you expect consumer goods companies like yours to start investing more in capacity, in market expansion as well? Because you will have many more buyers now coming into the system and penetration of consumer goods also increasing.
Yeah, Parikshit, the answer is yes. If you look at the decade gone by, I mean, when it comes to Panasonic, we have invested into at least 5 greenfield factories, air conditioners being one, refrigerators, washing machines, and 2 wiring devices. And so is the case with our industry peers as well. And again, from a policy standpoint, if you look at last 10 years, I believe that a structured approach has happened. Initially came policies like MSIPs, which were providing capex oriented subsidies, and subsequently came incentives to do component manufacturing like specs, and then finally came PLI. And we have to look at this from a bigger or a distance which defines such that this is a holistic action plan in place, both on the supply side and the demand side. And if you look at last 5 years, for example, again, I'll take the example of air conditioners. The weighted impact of PLI in air conditioners was about 5% to 4.5%, which led to significant value creation happen in the country from a level of 20% domestic value addition in 2021. Today, we stand at 65% domestic value addition happening in air conditioners industry. And then when you couple that potential 4.5% impact on air conditioners cost coming in through such incentives, with another 7.5% odd going as a price benefit to consumers, I think both coupled together will lead to a very good output.
All right, Manish Ahuja, Nayanlal Kidwai and Anand Goenka, thank you very much for joining us on the program. It was a pleasure speaking to you about the GST reform and how this will boost sentiment and also the investor view on India. We're taking a short break. On the other side, we will be joined by FADA President CS Vigneshwar and TVS Motor Company's two-wheeler business president Gaurav Gupta to discuss the impact of GST rate cuts on the auto sector. Stay tuned. Welcome back. Let's now focus specifically on the auto sector. Automobile stocks were in top gear today, hitting the highest level in nearly a year as the GST cut on small cars and bikes lift sentiment. The effective tax rate on SUVs and luxury cars will also drop to 40% as the compensation cess will go away. Two-wheelers with engine capacity below 350cc will become cheaper as they move to the 18% category. However, two-wheelers makers fear higher taxes on big bikes could adversely impact the segment. Joining us right now are CS Vigneshwar, President of the Federation of Automobile Dealers with us, and TVS Motor Company's Gaurav Gupta also on the program. Remember, TVS has announced the launch of the TVS N-Torque 150, which it claims is India's quickest hyper-sport scooter. I'm going to go to our guests one by one. Let me go across to Gaurav Gupta first. Gaurav, a big launch by TVS. You've got the new N-Torque, which has hit the market. How do you see this coinciding with the news of GST reduction from 28 to 18% for two-wheelers?
Well, thank you, Parikshit. It's a special day for us. The N-Torque 150, brings in our racing DNA and racing heritage into the performance. And rightly said, it is the quickest scooter that is there in India, going up to 0 to 60 in about 6.3 seconds. I also want to take the opportunity to talk about what it brings as a great package in terms of, fantastic styling. Which is built by the stealth aircrafts. It's got an arrowhead front. It builds in, motorcycle-inspired handlebars. It's got a, telescopic headlight. It's got a specialty rear lamp as well. Great performance in terms of, I talked about the speed, but it also brings in, higher technology levels in terms of it's got, TCS, it's got traction control, it's got ABS, it's got a cluster which has got 50 plus connected features. So overall, a perfect hyper scooter overall. And to answer your question, it is a special day for everyone, I would say, across the country today. The bonanza, the gift of the government of India is really, really applauded and we respect it. And exciting times, and especially for us, a new launch as well as a new terrain going forward.
Right. Gaurav, now coming specifically to the question of GST, what is the kind of price reduction you're looking at across your portfolio? By when do you expect to announce any price changes, if any, that you decide?
I think, let me put this way, that the entire big step of the government of India is really, really encouraging. This will really boost growth. It will empower a higher buying power in the hands of the middle class customers in the country. And more importantly, will accelerate the journey towards Viksit Bharat, the vision of the Honorable Prime Minister to 2047. And in line with that, whatever has been outlined by the GST Council, we will, of course, follow the same guidelines and take it forward to our customers. The effective date is September 22nd, and we will follow the same as well.
All right. So you will follow 22nd September, which is a Navratri date for any new prices that may kick in. Let me now get in CS Vigneshwar on a very important issue. Gaurav, I'll request you to stay with us. Mr. Vigneshwar, now, on the issue of compensation cess, this is going to be an important one for automotive dealers, especially those at the top end segment. Is there any appeal that has gone out from FADA to the government? And could you just explain us the problem that some of the automotive dealers are facing? You're on mute, sir.
Yes, thanks for having us over. I really appreciate it. The issue of compensation cess is something which is very important, and we probably need to look into it. We are writing to the government as we speak, and we are seeking clarity there, because compensation cess at the end of the day was supposed to be paid by the end user, and we are in the middle of the channel and we can't bear the brunt. So as you mentioned before, the compensation cess, roughly, it's upwards of 2,500 crores right now with dealers. And honestly speaking, we can't afford it. Our business is a wafer-thin margin business, as probably even Gaurav notes. And we really can't afford these huge cesses, especially on large vehicles, if they're charged on dealers. So the government needs to look into ways in which this can be mitigated, and we need to move on. Because this new GST regime is fantastic. It's great for the medium term and the long term, in terms of the aspiration customer being able to afford vehicles. And we also been having a lot of headwind in the entry-level two-wheeler, four-wheeler segments. And with this price reduction, I think it brings the vehicles closer to a customer owning them. But the compensation cess at dealerships is huge. It needs to be mitigated by the government.
Right. So if we understand correctly, you've already paid GST for your inventory, for every car, every scooter that you have bought from your OEM. And on top of that, state level cess or segment level cess that was also applicable. And now, if you don't sell these vehicles that are already there in your inventory till the 22nd of September to the customer, you will not be able to retrieve and get back the cess amount.
Absolutely, you're right. In case we're not able to get the cess amount after the 22nd, the government has to find a way wherein which we can be credited this amount, because it's going to be quite catastrophic for dealers. And when we're starting off a new journey, especially with this milestone GST reform, I don't think we can start off with a limp. We need to get off the blocks running. And but this cess, if not compensated at the dealer point after the 22nd, would be a sandbag on our shoulders.
Right. And could you give us a sense of whether you're looking to make a representation to the government? Have you already sent a representation to the finance ministry?
We'll be sending a representation by end of day. We're working on that.
All right. So FADA, they're saying they will be sending a representation to the government to resolve this compensation cess issue. Let me now go back to Gaurav at this stage. Gaurav, two questions. One, can OEMs and dealers find a way out? Because compensation cess, as they're pegging it, of around 2,500 crores is not a small amount. This is going to cause a lot of burden on dealers across the country. Can OEMs and dealers find a way out around this?
I would say, Parikshit, this would need to be studied, and the implications have to be understood better, depending on the category and the kind of scale and size where it has impacted. And I'm sure that the respective authorities will come together to find the right solution and then take it forward. But at this point in time, to give a clear direction on what this is will be difficult. But I'm very optimistic that the affected parties, the stakeholders will come together to resolve this.
Gaurav, now just to ask you about the kind of immediate uptick you're expecting in the two-wheeler segment, especially the entry-level commuter segment, which had seen subdued demand. Could you give us a sense, a ballpark figure that you're expecting an uptick in the festive season and also for the full year fiscal?
No, I would say, Parikshit, we were looking forward to the festive season because, the macro fundamentals were supportive. The monsoons were encouraging. The reservoirs have good water storage. The repo rates were all supporting the momentum. And this special Diwali gift will really accelerate the entire growth and, more importantly, bring in and make two-wheelers more accessible. At the same time, also help people upgrade their choices. So overall, it is definitely the right direction. I would say that more than numbers, I think the entire momentum, the euphoria, it will not just be a great Diwali, it will possibly be the best Diwali ever, as well as a continued Diwali is what I feel will be there for the industry. And I'm looking forward to it. Our industry is looking forward to this. And I'm sure all the consumers in the country as well are looking forward to this. So really, in all ways, is the right step forward. Simplification, encouraging growth, and boosting demand.
All right. So continued Diwali is what you're saying, and hopefully there will be a resolution to some of the concerns that Federation of Automobile Dealers, especially Mr. Vigneshwar, their president, has also made. We leave it there. Thank you very much for joining us. That's a wrap on this edition of GST Centimeter, but don't go anywhere. Our special coverage continues on the other side. Hello and welcome to our special GST Centimeter on the auto sector. I'm Parikshit Luthra. Let's also now get you the focus on the auto sector, which was in top gear today, with stocks hitting the highest level in nearly a year. Here's why. GST cut on small cars and bikes lifted sentiment. Small cars and two-wheelers below 350cc will now attract a GST of 18%. SUVs and luxury cars will now be taxed at 40% GST, with the cess component being done away with. I caught up with R.C. Bhargav, Maruti Suzuki chairman, to get a sense of what it means for their company and the sector at large.
Well, I think this major reform by the government is going to make not only a big difference to the automobile industry, but is going to make a big difference to the economy as a whole. Certainly, the small car segment is the big beneficiary. It will, I assume, from the 22nd of September onwards, our expectation is that we will start getting into about 10% growth a year instead of the current stagnation and decline. I believe the automobile industry, as a result, will also move away from its 1%, 2% growth and get into a 6-7% growth as a whole.
Right. So you're saying you're expecting 10% growth in FY26?
For the remaining part of 26.
Right.
The first 6 months are gone anyway.
So overall, how do you expect FY26 to finish, sir?
Well, if I take first 6 half to have zero, actually we are at a decline, then overall for the year we should get, for the small car segment, a growth of maybe between 4 and 5%.
Right. That indeed is an important point. Now, when it comes to the policy clarity, do you think the government has also now clarified the policy intent that EVs will be at one rate, 5%? Beyond that, if you have a small car, either in CNG or petrol or hybrid or any other alternate fuel, that will be taxed at 18%. Large cars, large SUVs, hybrid, alternate fuels would go in 40% bracket. Do you think the policy intent is now clear?
Very clear.
On hybrids, sir, do you feel that the cost advantage that hybrids may have had marginally earlier, for example, a large hybrid car over 1500cc had a 28% GST and a 15% cess, and maybe a large SUV or a luxury car would have had a 50% tax rate if we look at a 22% cess. Do you think that benefit has now gone?
Certainly gone, because both are going to be at the same rate.
Does this impact the sale of hybrid cars?
Not very much, because at that end of the market, Parikshit, the market is very small. You're talking of a price range of around 40-50 lakhs. It's a very small market there. So the impact, theoretically, there's an impact, but overall, in terms of volume, it's not going to make much of an impact.
Right. I would also like to ask you about the reduction in prices. We were just speaking to Mercedes-Benz, and they said they expect prices to come down for luxury cars in the range of 5 to 8%. As a veteran of the industry, sir, what is the estimate, or what is the good news you could give to consumers?
Well, we expect that at the entry level, let's say the Alto level, I can't give you an exact figure, but I think the reduction in retail price for the customer will be between 8.5% and 9%.
That's an important aspect. So you believe that for entry-level cars, 8.5% to 9% to even 10% could be the price reduction?
I don't think it can become as much as 10% because the tax benefit is 10%. And there are costs like transport costs and dealers' margins and such some extra costs, which don't get into the GST calculation. So it'll always be a little bit less than 10%.
Right. What about the rest of your segments, be it sedans, be it small SUVs?
The price will all reduce in all the vehicles because the minimum in the bigger segment was 43%. that comes down to 40%. So 3% reduction in tax will translate into roughly a 1.5% change in the retail price. Some cars went up to 45%, including cess. So 5% reduction would mean roughly 2.5% reduction in retail price.
Right. So 2.5% price reduction across the portfolio.
For those which are in the 45% bracket.
Right. That indeed is an important point, sir. Is Maruti Suzuki going to ramp up production now?
We hope that the demand will increase substantially and that we will be able to increase production, yes.
Right. Now, in terms of the future portfolio for Maruti Suzuki, now that this rate rationalization exercise is over, what do you think will be the product mix that Maruti will focus on?
You know, our strength has always been the small car market. I believe that the demand for small cars is going to pick up again because there has been a suppressed demand for years. Customers have been waiting for relief. This year, the government has done a number of good things which have combined to give the customer a great feeling of optimism in the future.
All right. So that was the stalwart of the Indian auto industry, R.C. Bhargav, in conversation with CNBC TV 18. Let's move on and get you a conversation with Anish Shah, Group Chief Executive Officer and Managing Director of the Mahindra Group. He said he's confident that the GST cut will boost demand with the start of the festivity. Adds that this will come as a cheer at a time when markets had seen a slowdown in the last few quarters. Let's listen in.
The overall impact on the economy, and to me that is the biggest factor in this change. It is a very dramatic one. It ushers in a new era of simplification and possibly a new era of ease of doing business as well. It will have a very significant impact on consumption, and this is something that should in some ways create that momentum that we were looking for in the economy. A lot of the fundamentals have been in place, but I think this is a very significant move that will create that momentum and propel India to an 8 to 10% growth rate overall. So that is the reason why we feel it is a very important milestone for our economy and sets it up in the right way. I'll let Rajesh cover the details from an auto perspective in specifics, but from an overall economic standpoint, this is a very, very positive move.
Fair enough. You're very positive in terms of the overall economic impact. Rajesh, if I can ask you then the specific bit, what percentage in the 18% slab and what percentage in the 40% slab? And of course, we will get to the tractor GST rate reduction as well, which I think is a big positive for Mahindra. Go on.
Yeah, so Prashant, like Anish said, we're delighted with the news overall. It's a huge enabler to demand and consumption. Markets have seen some kind of a slowdown over the last few quarters, and I think this will be a very good boost, timed very well with the start of the festive season. To the specific of your question, I actually want to, you got to see the auto and farm business, which is key part of the M&M Limited company, as a sum of three key segments. The tractor segment, which is tractors and farm machines, the commercial vehicle segment, and then the SUV segment. So tractors gets a big boost, 12 to 5%, which will lead to prices coming down 40 to 60%. And that on an average basis, we do about 35 to 40,000 volume a month. Then we have the pickup portfolio, which is LCVs less than 3.5 tons, which will move from 28 to 18, which is about 25,000. So I'm just giving you these broad numbers so that you get a context of the volume. Our SUV portfolio is in the region of 45,000. Roughly 40% of that will be in the 18% and 55-60% will be in the 40%. But we have to keep in mind that we also have EVs, which will be in the 5%. So overall, if you kind of, were to leave out the 40%, we have a very large chunk of volume, pickup plus SUVs in the 18%, and then we have tractors and EVs in the 5%.
Rajesh, around 40% in the 18% overall. Would I be okay in the ballpark?
No, it'll be higher when you add the pickups, the commercial vehicles. So it'll be almost 65% when we add the commercial vehicles as well.
In the 18%
So when we report
slab.
our auto numbers, it includes commercial vehicles as well.
Mr. Jejurikar, if I could ask you, I know it's very early, but maybe your team has already done the back of the envelope calculations. If we talk about the full revenue of the automotive segment, let's leave aside farm equipment. So if you talk about full year revenue, then is there a way of gauging that, what part of the portfolio, with the volume breakup that you just gave us, what part of the portfolio or what percentage of that revenue gets a positive leg up because of the reduction to 18%? And what part perhaps, which will be few, which go into that 40% category. So that percentage of the revenue, perhaps you have to see how the volumes play out.
No, every part of the portfolio will get a volume up, Surabhi, because 40 is also benefit of 8%. So what was in 40 was 48%, including the cess. So even there's an 8% benefit. So every part of our portfolio gets a leg up. EVs are unchanged, but everything else gets a leg up between 8 to 13%.
Going back to the overall point, to what extent, I mean, how should we, interpret or imagine the sort of boost and, whether it's going to be a lasting boost to consumption and specifically to the auto sector that these cuts will yield? I mean, say, given your monthly run rate, of course, there'll be an immediate bump up, I guess, all the pent up demand, maybe in the next 2-3 months, especially in the festive season. So by how much more than the average anticipation would you expect your volumes to go up? And then is it a one-time bump up? I mean, or how should we look at the longer term impact of this?
So the basic impact should be is the fact that with prices coming down, demand should go up. In terms of specific numbers for us or for any particular company, it is going to be difficult to say, but it will be a longer term impact. What I could say is from a macro basis, I'd expect this to take our growth rate as an economy to greater than 8%. And for us to be somewhere between 8 and 10% over the next few years.
Okay, so so we're going to take that and pull that flash out that Mr. Shah thinks that the GST cuts can take India to 8% growth rate in terms of an economy. And again, Rajesh, if I could ask you the question, so if you were expecting X as your festive sales number, will it be X plus 20% now, X plus maybe 25, 30%, just so that we can wrap our heads around the size of the impact?
Yeah, you clearly don't give up, Surabhi. So
just trying.
I think, Surabhi, the reality, as Anish said, is there is limited time to capitalize the upside in the festival period. We are literally 20 days away from the festival period. We can't increase capacities or production outputs. Festival period is a 30-40 day period. So I honestly don't think we're going to get a wholesale billing upside in the short run. This is more a long-term game.
And time for us to slip into a short break. Up next, Rajiv Bajaj calls the GST cuts a great move, but explains why he feels the rates are a tactical hit but a strategic miss for the two-wheeler sector. Luxury car maker Mercedes-Benz gears up for what it could be the best festive season for the auto industry ever. Welcome back. Rajiv Bajaj, the managing director of Bajaj Auto, has lauded the GST cuts as a great move for the auto industry at the right time. He, however, said that while a rate cut for the two-wheelers below 350cc was a tactical hit, not cutting rates for bigger bikes was a strategic miss. Listen in.
This has been long in coming, I would say, and it's a fabulous change and it's great timing. So it's wonderful.
Right. Does this also help in creating demand for two-wheelers on a sustained basis?
I think so personally, and I think that's really the more important part, because season is anyway peak time, and most of us are anyway up to capacity at this time. So what's really important is what happens after that, from November onwards. November, December are usually the weakest months of the year, but that will not be the case this time. And I think, more importantly, the two-wheeler industry that never really recovered post-COVID, I think finally will now head to a new high.
So new high for the two-wheelers segment. Are you now going to be ramping up your production in anticipation of a strong festive season?
Well, production is already planned to be ramped up this month, Parikshit, obviously to stock up for the season, because the season starts towards the end of the month. And in October, due to the vacations, we all have fewer working days. So this will be the biggest month of the year, I'm sure, for everyone of this financial year, and so also for Bajaj Auto.
Right. Does this also help three-wheelers and commercial vehicle sales? Are you looking at a strong uptick?
Yes, absolutely. It will equally help three-wheelers, and obviously that's really important to us, because we are now just in the domestic market, clocking in excess of 40,000 three-wheelers every month, ICE and EV included, with about 80% share. So that is very meaningful to us.
Right. Downside for the segment above 350cc?
Yes, I think this is what you and I discussed last week as well, and therefore, if I have to summarize what's happened for the two-wheeler industry, say it's a tactical hit. This GST reduction is a tactical hit, but it's a strategic miss. It's a tactical hit because obviously a big fillip for, let's say, almost 98% of the domestic industry with this significant reduction in GST. But at the same time, the 350cc plus motorcycles, where Royal Enfield and Bajaj are the biggest players, this is on the one hand just 1% of industry, perhaps about 4% by value. For Bajaj, I can tell you this is about 3% by volume and about 7% by value. It would perhaps be a little more for Royal Enfield because they are the leader in this market. So both Siddharth and I had appealed to those concerned, that this is just 2% of the industry, and let's have a uniform rate. From a strategic point of view, because although it may sound like 2%, but in terms of volume, it is getting closer to 200,000 motorcycles per year. Now, that is not small when you consider that the global volume for such products is well under 1 million. So here you have two Indian OEMs with a very significant global footprint. In our case, almost half of what we make is exported. If this rate had been applied uniformly, it would have further helped us to scale up in this 350cc plus segment, which is, I think, very important for the future because it's great for your brand image, it's great for the bottom line. With the scale that we would have got here, or more specifically our supply chain partners would have got here, we would have been, in a very cost competitive position to take our brand and our products overseas. There, I can tell you, in recent times, the Chinese are making very, very significant inroads at the expense of American and European brands, the same as what's happening in cars. So in that sense, I would say this is a strategic miss because
I anticipate that in a few months' time, we will realign most, if not all, of our portfolio to under 350cc, which means this segment will be practically dead. The 350cc plus segment, will be practically insignificant in India, and I don't think that is good for the long term, because OEMs will find it very difficult to develop products solely for export markets. When the domestic market doesn't support it. So I think that's unfortunate. And frankly, nobody wins. Everybody loses here. The consumer loses, the manufacturer loses, and certainly the government loses when there is no volume to be multiplied by that 40% figure.
Right. So does this mean that, as you said, your portfolio will now get aligned to bikes equal to or less than 350cc? Are we going to see more future launches under 350cc now?
I think it's inevitable because I think let's look at it like this. The single cylinder motorcycles that are over 350cc are typically up to 450cc. I think most, if not all, will get realigned over the next few months to under 350cc by appropriate engine development. Twin cylinder motorcycles or multi-cylinder motorcycles that are bigger than that obviously will remain in the higher space, but those volumes are tiny, minuscule. And therefore, yes, I think even new developments will be largely restricted to under 350cc.
All right. There is also some tax cheer for luxury cars and SUVs. While the tax rate has increased from 28% to 40%, the government has decided to do away with the cess. This will reduce the effective tax on these vehicles from nearly 50% earlier to a flat 40% rate. Santosh Iyer, the CEO of Mercedes-Benz, is confident that this would be the best festive season for the industry.
I think it's a no-brainer. This is a great move because reducing taxes was long awaited always. India was one of the highest tax countries when it comes to luxury cars and products. So I think this should for sure drive consumption. But on the other side, I think the biggest outcome is also simplification. Today, earlier we had for EVs, combustion engine, and even for hybrids a different cess. Now all of that is at 40%. So we used to have combustion engine at 48 to 50, including the cess, and a strong hybrids at 43. Now with this standardization, everything comes to 40. I think it's also a very clear direction that it's either EVs or ICE, and hybrids are part of the combustion engine portfolio. So in that sense, it also gives a vision of government's decarbonization agenda to say we don't confuse now too much with taxation, and it's up to now consumers and OEMs to see how to price their cars. But in general, reduction of prices is expected. We are still calculating how much exactly for the customer, and we will pass on whatever is in terms of taxes to the market as well.
Right. I would also like to ask you, to what extent do you expect the prices now to come down for luxury EVs, including Mercedes-Benz?
So for EVs, there won't be a change because the GST was at 5% and the EVs are continuing to be at 5%. So the EVs will continue to be the same. The biggest change is in combustion engines where our sedans were close to 48%. The SUVs were having a tax of 50%. So technically the tax incidence has come down by 5 to 10%. And the pricing impact will be 6 to 8%. That's what we are seeing for all the car lines. But I think we are trying that by late night, we should be able to come out with a new pricing for all our car lines so that it's also easy for customers to then make their purchase decisions.
Right. Could you also give us a sense of how this impacts already built inventory? Dealers right now are worried about a cess loss of 2,500 crores as well.
Yeah, exactly. That's, I think, the biggest thing. But yesterday in the FAQ itself in the evening, it was clarified that the finance ministry will come back on the mechanism, because I think the positive is the government is aware of it, that now with the reduced prices and with the accumulated GST and cess, both, how do you set it off? And that's not going to happen in the near future. So, and this will block working capital also for our dealers and retailers. So this is something now, hopefully before 22nd, before this new changeover comes in, the government is clarifying so that removes anxiety among the entire dealer community as well.
Right. I would also like to ask you that when it comes to hybrids, all hybrid cars will now come under the 40% bracket. Do you feel that government also has made its intent clear that they want to promote electric mobility, and the rest of the technologies will be there in either the 18% or the 40% bracket.
Exactly. It's much more simpler. So it's not based on the powertrain option is only between an EV and ICE, and there is no third element of hybrid now. So that makes the policy making quite clear from at least from the central standpoint that, and now we have to look at states because some of the states were thinking of registration charges separately for hybrids compared to EVs or ICE, etc. So that's still to be sorted, but at least from the center's viewpoint, it's ideally full decarbonization with an EV at 5% and then cars based on size and engine capacity at 18 and 40. So things are simpler, also shows the clear direction what the government wants to steer the industry for.
Right. What kind of uptick do you expect in the festive season?
If with this momentum, because we had a lot of customers who also postponed purchases in end of August, so we had this entire anticipation of the GST rates coming down. I am damn confident this would be the best ever festive season for the automotive industry ever witnessed. One, also because of a bit of pent up demand coming from August, but more so also with the reduced prices. I think overall there is also more money in consumers' pocket because it's just not automotive, across the categories where the disposable income should ideally increase because the shopping basket prices should come down. The ability to pay more EMIs goes up. And 80% of cars are bought with installments, and that should definitely help I can't call it animal instincts, but yes, a very strong purchasing sentiment during the festive period.
All right, with that, it's a wrap on this special edition of GST Centimeter. Thank you for watching. Goodbye.
Javed, of course, has come many times. But a good place to showcase to the world how India is evolving. 22. As long as you're not writing any snippet anywhere, it's okay.
No, I think there's a story to be done on the changing face of Indian government offices.
वो कर्तव्य भवन में करो.
Yeah, we'll start with that, and उसमें भी ये भी डाल सकते हैं. But it tells you something. It tells you the government is becoming. That is the idea also.
Do it in कर्तव्य भवन इसको. क्या हाल है बॉस? Sexy purple and all that. क्या बात है? You were to do it the first on Sunday or Saturday sometime. पर उस टाइम पे फिर ये मसाला नहीं मिलता, ये मसाला आ जा गया ना. That day I couldn't speak. I was having a fever for 3. गणपति 27 रात को है. Full night I was awake. So 28 के बाद 3 days I had a bad time. Even when Thani came, I could not sit through all the meetings full time. So sometimes I used to go in between and rest. We had 2 days in office meetings, but a lot of.
But you still you have to really do it, right? You have to go for your constituency visit.
Yeah, that is Ganesh Visarjan tha 5 din ka. I did 17 Ganesh that day. That by the time I came back, I had again got fever, high fever. And next day was Thani. That fever continued the whole day.
Very tough on you.
But work has to go on, and I had a lot of work with him. So 12:30 baje tak first night we continued.
Yes, sir. You start. Who can be aggressive with him? Yeah.
More focus on that.
GST, yeah. First 4-5 questions on GST, Atmanirbharta, Swadeshi, etc. Then we'll move to you. Yeah.
And end again on this.
Okay. ठीक है. Yeah. Sorry.
Okay, sir.
Yeah.
All these beauty salon items are getting cheaper by the way.
I don't use anything, but sorry, yeah. Piyush ji, thank you so much for giving Network 18 this exclusive interview.
welcome to the show.
Thank you.
What a day to be interviewing you. You know, historic reform in GST rationalization. You've been in the center of news for so long, so it's a great time to be interviewing you. My first question, all this started with the Prime Minister's address on the 15th of August, Independence Day, when he spoke about Atmanirbharta. He framed it in the context of Swadeshi, he framed it in the context of quality drive, and he also, you know, so that is where it all started, and it has led to this. He gave a hint to us on that day that big reforms are coming. So here it is, your first reactions on this GST rationalization.
Well, I'd like to compliment Prime Minister Modi for taking this bold decision. I see this as the most transformative step the nation has seen possibly in the last 50, 60 years. This is a journey that Prime Minister Narendra Modi started right in 2014. Back then, he spoke about making in India. He was conscious that ultimately we will have to become self-reliant. Atmanirbhar banna padega. He promoted Digital India, he promoted Startup India. Swachhata was at the core of his working.
Yes.
He started the concept of trusting the people of India. Remember, one of the first decisions was you don't need to notarize a document.
Right.
It was crazy. A Xerox copy needed a notary and you spend money, go and sit before and plead with somebody. For him, ease of doing business is the pathway to a developed economy, and ease of living is a commitment to the people of India to ensure wider prosperity and inclusive growth. And these decisions yesterday have happened over a sustained 11-year journey of taking a broken, fragile 5 economy to become the top 5 economy of the world, soon to become the 3rd largest by 2027. An economy that was low on growth, high on inflation, an economy that was starved of foreign exchange, with a completely broken banking system, an economy where there was no hope, investments were falling,
right.
Our passport had no respect anywhere in the world. Inheriting that from the Congress, Prime Minister Modi, brick by brick, step by step, brought reforms, brought changes, showed that he trusted the people of India, focused on better quality of life for the poorest of the poor, through various initiatives, brought social security into their lives, got 25 crore people out of poverty, faced the crisis of COVID admirably, without letting the economy collapse as happened in many other developed nations. In fact, bouncing back so well that for 4 years now, we are the fastest growing large economy. Last quarter was 7.8% growth,
yes,
with only 1.55% inflation. Who could have imagined, if you look back at 2014, Rahulji,
yes,
that in a decade, this country will transform so rapidly,
right,
so beautifully, and a foundation will be created on which a $4 trillion economy aims to become a $30 trillion economy by 2047. That, I think, is Prime Minister Narendra Modi's very astute handling of the economy, and this transformative steps that he had alluded to in his 15th August address, of course, is a labor of love. It's happened over many months of hard work.
yes,
The Finance Ministry, Nirmala ji, the groups of ministers from the states,
absolutely,
the groups of secretaries, all working, recognizing that now compensation cess will no more be required. We got the elbow room to be able to give this huge bonanza,
right,
and give our consumers the opportunity to spend more and give a boost to the Indian economy.
So we'll discuss all these points one by one, but first let's stay with GST for a moment. How do you think there was also, income tax cuts, for the bonanza for the middle class in the last budget, followed by now rationalization of GST, a long-standing demand. Like you said, it's taken months of, work on it. Are you sure that this is, how confident are you that this is going to spur demand, spur consumption, and also eventually investment?
It's very logical, Rahulji. Take, for example, the reduction in cement from 28% to 18%.
Yes.
It suddenly brings down the cost of real estate and building a home. Prime Minister Modi has already provided a free home to 4 crore brothers and sisters, families in the country, another 2 crores more in the coming 4 years, 4-5 years. A reduction in cement price also helps the middle class now get the ability to own an affordable home. When you reduce the price for tractors, tractor parts, all other farm equipment, you are helping the farmer modernize, helping him improve his productivity.
Right.
When you make the two-wheeler cheaper or a small car cheaper of 1200 cc, the aspirational middle class, the young man and woman who wants to have a two-wheeler, gets encouraged and is able to afford to buy a two-wheeler, with interest rates also simultaneously coming down,
yes,
thanks to low inflation and loans becoming cheaper and easily available,
right,
in a strong banking system that we have today, not what we had in 2014. When the housewife goes out into the market, almost every product of daily use, all food products, all processed goods, foods, all material that is required for her kitchen, foodstuffs, utensils, everything will see a transformational reduction in prices. And industry has committed to us that they will make sure that the full benefit is net of input taxes is passed on to the consumers. So consumers are in for significant gain, and I'm very, very confident.
And how are you sure of that? How will you ensure that the industry
There
has
are
passed?
enough tools.
There have been cases of profiteering in the past. So.
Few and far between. Otherwise, our experience is you can trust industry. Okay. Prime Minister Modi's biggest strength has been that he has trusted industry and they've never let him down. Similarly, the people of India have trusted Prime Minister Narendra Modi and we have never let them down. So I think it's a two-way trust. Industry has, across the country, every sector, assured the government that they will be with the government. They recognize lower taxes, lower prices will give buoyancy to demand, and higher demand leads to higher taxes, and ultimately higher demand also promotes more investment because the demand leads to more manufacturing in India. So it's a virtuous cycle of growth, and the multiplier impact is what will give India a big boost.
Okay. Let us also talk a little bit about the revenue implication or the revenue impact that this might have. You know, by one estimate, about 48,000 crore would be the revenue impact. Do you see that, you know, we will be able to take care of this, and, you know, any kind of fiscal slip that you see, you know, going forward?
Rahulji, we are currently collecting nearly 2 lakh crores every month. And with this boost in demand, the revenue will probably go up rather than being a revenue
So
loss.
you're expecting some amount of revenue buoyancy as a result of this. So
it is always so. And I think that every theory,
right,
economic theory suggests that.
Right.
And for that matter, in 2 lakh crore a month, so 24 lakh crore, 22 lakh crore collected in a year.
Yes.
This is hardly a very consequential amount.
Right. You know, if you look at the Q1 GDP numbers at 7.8, you know, it's a 5-quarter high. How do you react to these numbers, especially in the context of, you know, someone calling it a dead economy?
Well, I think Mr. Rahul Gandhi has been a naysayer and a person who could never understand economics. We have seen that over the years. He sees ghosts where there are none. He cannot appreciate that the people of India are seeing significant improvement in their lives. He has not yet been able to reconcile that the people of India have voted him out 3 times in a row. It's a rocket that somehow seems to fail every time it tries to take off. Mr. Rahul Gandhi actually hurt the sentiments of 140 crore Indians who can see the improvement in their lives, who can see that Prime Minister Modi has reduced their income tax, who can see that Prime Minister Modi is providing 80 crore Indians, even after they have come out of poverty, with free food grains. who can see that the fertilizer prices haven't gone up in 11 years. Because Prime Minister Modi has made sure that any burden of increase in tax prices, and there has been a huge increase in fertilizer price, is borne by the central government. Prime Minister Modi is a sensitive human being, very, very concerned and caring for the last man at the bottom of the pyramid. Right from day one, he worried about their social security. Right from day one, he committed his government to the poor, to the marginalized sections, to the unbanked sections of society. After all, what was Jan Dhan account? He made the bank doors open for every citizen of this country.
Right.
What was Ayushman Bharat? And finally, even everybody above 70 getting free healthcare. So today, 62 to 65 crore brothers and sisters, and everybody above the age of 70 included, is eligible for free healthcare. With the reduction of premium GST on premium on life and health policies from 18% to 0.
Yes.
It's a massive reduction.
Yeah.
The middle class will get an ability to buy more insurance and secure their future, their health, and an unfortunate incident in their lives or anybody in their family's lives. So I think it's a very concerted effort over the years in a very smart fashion, while making sure the sanctity of the fundamentals of the economy remains strong, while making sure we don't slip back,
right,
but only power on for a brighter and brighter future for every Indian in India. I think Prime Minister Modi has clearly shown that good economics can also be equal to good politics. The old adage of the Congress, which itself used to always be looking at very, very low ambition ideas, which was full of scams and scandals, the Colgate, the telecom scam, the Commonwealth Games scam, the Antrix Devas, the list goes on and on. Prime Minister Modi in 11 years has run an honest government, and honest government will always have money to spare to give benefit worth over 2 lakh crores in one shot through the reduction of GST.
So will it give some comfort to the markets as well? They have been slightly soft over the last few quarters. Do you think it will also give market men a reason to celebrate because bold reforms are on the way, that this government is not hesitant to take risks?
I think very clearly the market recognizes that we are in safe hands. They recognize that a decisive, strong leader like Prime Minister Modi will always keep national interests ahead of everything else. And therefore, if you see, while they've been a little soft, but they've been range bound.
Yes.
Between 24,500 and 25,500, the Nifty has moved.
Right.
But I'm very confident that this and the impact of this starting on the first day of Navratri on 22nd September will give a big leg up to the economy, to GDP growth, will ensure that Indian investments continue to power on, will attract more people to set up base, because ultimately when there's demand,
yes,
there will be interest in investment to meet that demand. And a growing demand means growing jobs,
right,
growing number of people required in the supply chain. More investments will lead to jobs in the manufacturing side. Right. Services is already growing in a double-digit level. You saw the numbers, the services PMI is at an all-time high almost.
Right.
So I think all in all, India is poised for a very bright future. I assure you our exports also this year will be higher than last year.
Let's come to that. So I think, let me rewind a little bit and, come to what you've been dealing with, and you've been at the center of all of it. Till about July 6th or 7th, things seem to be going fine with in our negotiations with the US. Then in a matter of weeks, we had a tariff of 25%, then another 25% on top of that. What went wrong in these few weeks?
Well, I think the US-India relationship is one of the most consequential relationships on the globe today. We are two very large democracies. We believe in the rule of law. We are allies and friends for long. We have had certain blips, like we had the sanctions post the nuclear tests in 1998.
Yes.
I look at this only as one more situation which will pass as there's a deeper understanding of the reality of the situation. And I'm very confident this relationship will only strengthen in the years to come.
And how soon do you expect things to resolve?
It could happen soon enough. It may take some time. Irrespective, we will continue to be friends. We will continue to be engaged with the United States. And I'm sure we will continue to have greater economic relationships, defense relationships, greater interest in a safe, fair and secure Indo-Pacific. In some sense, it's a very multi-dimensional relationship where we contribute to each other's economies in different dimensions and will continue to do so.
It's comforting to hear these words from you. And we also picked up that you said somewhere that things could happen as soon as November. Is that a correct?
Well, if you recall when Prime Minister Modi and Honorable President Donald Trump met in February, they had tasked the two teams to conclude the first tranche of a bilateral trade agreement by fall of 25, which is about November 2025. And I'm sure we will continue to be engaged to try and find solutions to reach that outcome. If at all it's give and take a few days, a few weeks, a few months, in a nation's history, such small periods will not define long-term objectives and goals.
I think what surprised and even shocked some people was the erratic and incendiary language that was used by some of the officials of the Trump administration, calling it Modi's war or, a laundromat of Kremlin. I mean, how do you react to this? I mean, are conciliatory noises coming from the other side now?
I think there could be either some misunderstandings or some personal opinions that may be reflected in that. I do not think that deters the US and India from continuing to maintain our strategic alliance and partnership. Our friendship is far stronger than a few comments that may be made by a few people.
China in the beginning had retaliated with retaliatory tariffs. Would India do anything like that?
Well, India is a patient country and I believe we should give it every effort to come to a better, deeper understanding within the framework of international trading laws. And therefore, I think we have always believed in dialogue, in diplomacy, and an effort to strengthen rather than weaken relationships.
So President Trump has recently said that, India has offered to cut tariffs to zero and time is running out. What do you say to that? Do you agree with...
I never negotiate such agreements and free trade deals with the media. We negotiate behind closed doors. And once the negotiations are complete, we'll certainly come back to you.
Okay. So what are the red lines? Which are the no-go areas for you? Things that we will not compromise on.
I think any issue that can hurt national interests, that can hurt the interests of our farmers, our fishermen, our MSME industry, issues which are sensitive with religious sensitivity, those would be broadly the issues where India would need a more understanding when we finalize the framework of our agreement. And we will never compromise on the interests of our farmers, our fishermen, our MSMEs, or our religious sensitivities.
Okay, thank you. A US court has recently ruled that President Trump has no authority to impose tariffs, including on India. How would that impact our talks going forward?
Those are internal processes, legal processes in the US, and will be sorted out by the US government. We have no role to play in that. But ours is an effort to reach a far more sustaining and long-term, fair, equitable and mutually beneficial agreement and partnership, and we continue to be focused on that.
Okay. Piyushji, let's move to some of your priority areas. Take us through your thinking, some of the things that you are doing. For instance, the Jan Vishwas bill. Can you throw some light on that? What is priority for you and the government at the moment?
Rahulji, the Honorable Prime Minister, from day one, has been focused on making the life of businesses and common people simpler and easier. If you recall, a simple thing like notarizing a Xerox copy. He removed the need to go to a notary and get a stamp and a signature and pay him 25 rupees to get that certificate. I don't know what that achieved. Prime Minister Modi just did away with it. He said, I trust my people. If they're signing that this is a true copy of the original, I trust them. If you recall, there have been so many scandals and people have been in jail for scandals around government jobs.
Yes.
In Prime Minister Modi's regime, no such scandals because he simplified and made the whole process totally transparent. For example, now the class 3 employees don't have to go through an interview. It's on merit based on their written exam and their academic performance that they can get a job. The whole nation today has the confidence that when they, or those who desire to have a government job or a job in the rails or a PSU will not be discriminated against. Nobody has to use influence or any rent seeking to get a job. This honesty in government has helped us earn the trust of the people, and Prime Minister Modi has always trusted industry, business, entrepreneurs, the youth, the people of India, the citizens of India. And therefore, throughout his tenure, he has tried to decriminalize laws. For small misdemeanors, you don't need to go to jail. You know, there used to be a law at one point of time that if an employee of the Delhi Municipal Corporation, a sewage cleaning employee or an employee was involved in Swachhata in the Delhi Municipal Corporation was absent for 1 month, he could go to jail for that. Right. Now, those kind of obsolete laws needed to be addressed, and he's removed over 1,500 obsolete laws. We have identified many more which we plan to remove. He has decriminalized several sections and provisions of the law through Jan Vishwas Bill 1, which is working admirably. Yeah. Now we've come out with Jan Vishwas Bill 2. And Jan Vishwas is a two-way Vishwas. The government trusts the people of India because the people of India trust the Prime Minister Narendra Modi and his government. And it is that trust which encourages us. The second Jan Vishwas Bill already has 355 provisions being decriminalized. And he has directed us to look for many more. And you'll be happy to know my department has already identified 500 more, which can be decriminalized. Similarly, we are looking at reducing compliance burden, making